Let us read this problem. The following rating and valuation structure are available from the market. Instruments, rating and benchmark rate are given, and there are three ratings given: AAA, AA and A. An investor is buying a 5-year ₹1,000 face value A rated security which pays a coupon of 16%. The security is trading in the market at ₹1022. Calculate the yield to maturity and comment on the valuation of the security. Very popular problem, already asked in the exam. It has got coverage of how to calculate the bond price, how to calculate YTM, how to know whether a bond is undervalued or overvalued. Therefore, it is a very important problem from the exam point of view. Let us see how we solve this problem. We calculate bond price using the formula C into PVIFA K, N plus BN into PVIF K, N. Now this is same as C upon 1 plus K, C upon 1 plus K the whole square, C plus Bn upon 1 plus K raised to N. But this will be faster. Now let us see what is given to us. C is given as 16%. Bn is a face value, is given as 1000. N is 5 years. So we have C, we have N, we have Bn. Now what is K? So K is given as, so K is yield of singly rated bond. But singly rated bond is given as AA plus 3. But AA is given as AAA plus 3. And AAA is given as T-bill plus 3. And T-bill is given as 6. So we got K as 15%. So when we calculate B0, C is 16% or 160. So 160 into PVIFA K, 5 plus 1000 into PVIF K, 5. So we have to calculate the discount factor for 15%. So here PVIF factor 15%. And total also we need. So we round off to 3 decimals. 1 divided by 1.15, 0.870. 0.756, 0.658, 0.572, 0.497, 3.353. So we get 3.353. So this will be 160 into 3.353 plus 1000 into 0.497. 160 into 3.353 and 497. 1033.48. So at this stage, you must verify this. C is 16%, K is 15%. So C is in numerator, which is higher. K is in denominator, which is lower. So the answer has to be greater than 1000. Greater than 1000, since C, or I'll write K is less than C. Now we have calculated theoretical price 1033.48. The market price is 1022. So clearly the security is cheaper in the market. Therefore we can say security is undervalued in the market. Therefore security's price in the market is lower than theoretical price of 1033.48. Therefore it is undervalued. Now our next objective is to calculate yield to maturity for that 1022. Remember, the term yield to maturity is connected with market price. So whenever we have market price, suppose this is B0 market, then this K is yield to maturity. So they are asking yield to maturity, means they are telling you to substitute 1022 here and asking you how much is this. So for yield to maturity, we have to match market price. Therefore 1022 equal to 160 into PVI of A K, 5 plus 1000 into PVI of K, 5. So we have to find this. Now this can be done by two methods. One is the approximate method, other is the interpolation method. So let us do first method. Method 1, approximate method. This is similar to the formula which I learned in IPCC on cost of, how to calculate cost of redeemable debenture. So the formula what we are going to use is YTM equal to K equal to coupon plus Bn minus B0 divided by n, Bn plus B0 divided by 2. So this is 160 plus Bn is 1000 minus 1022 divided by 5 upon 1000 plus 1022 upon 2. When you calculate, you get 15.39% or 15.4% approximately. So this is a simple method. This is your, in IPCC you would have learned this interest, this RV, SV. So similar formula, and this method you can do in the exam. But I'm going to tell you another method, that is interpolation method. For interpolation, we need two values, and in bond market chapter we will take one value as coupon rate, because when yield equal to coupon, B0 will be same as Bn equal to 1000. So this you need not calculate at all. So one value can be coupon rate. Now this is 1000, this is 1k equal to C. Now when k is greater than C, k is in the denominator of bond pricing formula. You can see here it is in denominator. So k is in denominator of bond pricing formula. So when k is less, bond price will be more, and when k is greater, bond price will be less. So when k is less, you will have greater than bond price, and when k is greater, you will have less than bond price. So here I want to find for 1022. So we can see we have to go in this direction. So one rate I will take k equal to C. The other rate I will take k less than C. So two values I will take. One k equal to C, another k less than C. So less than C, let us check. We have already calculated for k equal to 15%, and that value we have got 1033.48. So we can use this value. Since B0 is 1022, we use k equal to 16%, that is same as C, and k equal to 15%, that is less than C. So understanding this part is very important. So this will decide which two values you should take. So now we write the lower value, 15%, higher value 16%. Now unknown, I don't know rate. Now when it is at 15%, what is the price? 1033.48. I write 2 times. For what price you want to calculate? I want to calculate for 1022. I put a dash in the second column. This is a method. Actually, you can do by other methods also. Then here I put a dash and write 1000, because when k equal to 16, you get 1000. So when you subtract 11.48, 33.48, therefore this rate k equal to YTM equal to lower value plus delta 1 first column. Delta means difference of column 1 upon difference of column 2 into H minus L. L is 15%. This is delta 1 11.48. This is delta 2 33.48 into 16 minus 15. So when you calculate, $15.34. Just verify once again. $11.48 divided by 33.48. So we get this 15.34%. And approximate method we got 15.39%. So the difference will be there. Interpolation is a more approximate answer or more correct, you can say. So this is how we calculate YTM and decide whether the price, whether security is overvalued or undervalued, which we do by comparing theoretical price and market price. Hope you understood this problem. Let us read this problem. Calculate the duration of a 4-year semi-annual ₹1000 face value bond whose market price is ₹925. It is quoting at a yield of 14.5% in the market and pays 12% per annum. Calculate the theoretical price and duration. Use 3 decimal for P factors and work answer in 2 decimals. Now, couple of things. First of all, it is a semi-annual bond. So one must know the concept of semi-annual bond. Second, one must know how to calculate duration and how one has to adjust the final answer by dividing by 2. And one must always give importance to the additional remarks in a question, like use 3 decimal P factor, work answer in 2 decimal. You should not be violating that. So let us see how we solve this problem. Duration by the table method. So we write period, then we write cash flows, then we write PV factor, we'll write the percentage shortly, then we write PV of cash flows. Now this total will give you the bond price. Then we will do, now let us call this as W. So W into PV of cash flows. So here periods are used as weights. So therefore we have put the term W for period. And this we will get this total. Suppose I call it as A, I call it as B. Therefore, duration will be B upon A. So we can get both the answers simultaneously. So table method is preferable when they ask both theoretical price of the bond and what we call as duration. One more thing we want to find out is we should know that it is a semi-annual bond. So semi-annual bond, we will always get the answer in half years. Remember, I am actually going to write, it's a 4-year bond. So I am going to write 1, 2, 3, 4, 5, 6, 7, 8 periods. Remember, this each period is a half year because it is a semi-annual bond. So each period is a half year. So our answer will be half years. And if I want to convert duration to years, then I must divide the answer by 2. So we can first calculate, let us put the information in the table and arrive at the required answer. Now let us take step by step all the information provided to us. It is a 1000 face value bond and coupon is 12%. So BN is rupees 1000. Therefore, C in rupee terms is 12% into 1000 divided by 2. Why divided by 2? Because it is a semi-annual bond. Annual bond will give 12% into 1000, 120 rupees. Semi-annual will give 120 divided by 2, 60 rupees. So each cash flow will be 60 except the last period when we will get our face value back. Now PV factor. Now yield is given as 14.5%. But we want semi-annual yield. This is very important. Now semi-annual yield will be 14.5% upon 2, 7.25%. So this will be 7.25%. So we take P factor of the yield, that is 7.25%. They have given that use 3 decimals. So what we are going to do, we are going to take 3 decimal P factors. Now this table method is also beneficial because if you do by formula method, then you have to write the P factor separately on the right hand side of the page or show it as a working. Here P factor is a part of calculation. So 1 divided by 1.0725 raised to 1. So when we do it, we will get the following P factors: 0.932, 0.869, 0.811, 0.756, 0.705, 0.657, 0.613, 0.571. Now we have to calculate PV of cash flows. So we multiply 60 with 0.932 and so on. And remember, they are given work in 2 decimals. So usually all these terms will be, because we have 60, 10 is there. So we will automatically get the answer in 2 decimals. So 60 into 0.932, 55.92. Then next 52.14, 48.66, 45.36, 42.30, 39.42, 36.78, 605.26. When you press memory recall, we get 925.84. So this is the bond price, theoretical price of the bond. Remember, they have given market price of bond. Now market price is rupees 925, very close. Now you should be wondering which price I must use to calculate duration. Now here is a very important thing you must know, that this B what we are getting, we can take it from here, but this A, I should be taking this as A. Now this is A market, this is A theoretical. So whenever market price is given, we should take A market. Answer is almost same, no change at all. Why? Instead of dividing by 925.84, we'll divide by 925. Doesn't make big difference, but that concept will, you'll get or lose 1 mark for that. Okay, now market price should be used in the duration calculation, but they are asking theoretical price, therefore we have calculated this. Now last column, weight into PV of cash flow. So 1 into 55.92. So again you do 1 into 55.92 M plus, then 2 into 52.14 M plus, 3 into 48.66 M plus, 4 into 45.36, again store in memory M plus, 5 into 42.3, again do M plus, 6 into 39.42, again you do M plus, 7 into 36.78, this also is stored in memory, and 8 into 605.26, 4842.08, again this also is a, now you do memory recall, you get 6035.18. So when you do this, 6035.18 divided by 925, 6.52 half years. That's 6.52 half years. Therefore, duration in years will be 6.52 divided by 2. So 3.26 years. So the correct answer is, theoretical formula is this and duration is 6.52 half years. Remember, if you want to state in years, it will be 3.26 years. Theoretical price, duration in terms of half years, and duration in terms of years. I repeat, whenever we are asked to calculate both, I repeat both, theoretical price and duration, the table method is slightly shorter. But I am not telling that you should do only by this method. What is the other alternative? Other alternative, if you are fast in the formula method, we can do that. What is that? We first calculate B0 is equal to C upon 2 into PVI of A K upon 2 comma 2n plus Bn into PVIF k upon 2 comma 2n. In this case, you will get 60 into PVIFA 7.25 comma 8 plus 1000 into PVIF 7.25% comma 8. So you'll be reading the P factors in a column and then do the calculation, and you will arrive at the same answer, 925.84. Then you do the duration calculation, 1 divided by B0, and we will use this formula, summation of T into cash flow T 1 plus K raised to T. So this will be 1 divided by 925. Remember, I should use market price because they are given market price. They are given market price. Therefore, I should use market price into 1 into 60 upon 1.0725, 2 into 60, 1.0725 square, 3 into 60 upon 1.0725 cube, 4 into 60 upon 1.0725 raised to 4, 5 into 60, 1.0725 raised to 5, 6 into 60, 1.0725 raised to 6, 7 into 60, 1.0725 raised to 7, plus 8 into 1000 plus 60, 1.0725 raised to 8. You will get the same answer as 6.52 half years for 3.26 years. You will get this answer and then you can write this. So here in this method duration calculation is extremely fast. Suppose they ask only duration, then you prefer formula method. But when they are asking theoretical bond price and duration, so then you need to be smart. Table method, that is this method what we have done, will be faster. Hope you have understood this. Let us read this problem. The following data are available for bond. Face value 10,000 to be redeemed at par on maturity. Coupon rate 8.5% per annum. Years of maturity 5. Yield to maturity 10%. Calculate duration, modified duration, volatility, convexity of the bond. If there is a decrease in the YTM by 200 basis points, what will be price change? Okay. This problem was asked in November 2020. For the first time ever, a question came on convexity. When it was there in 2008, since 2008, now 12 years have passed. Not a single time question came on convexity. As if all the problems which have not been asked before, and all the lengthy problems, they were all loaded in November 2020 exam. According to me, it was one of the toughest paper ever in CA final. And according to me, those who would have gone with high hopes, with less preparation, they would have definitely opted out or succumbed actually. This problem also, this is third A problem and only for 7 marks. It was combined with another lengthy problem from mutual funds for 10 marks. All in all, whoever would have attempted the third question, 3 ABC, 7 plus 10, 17 plus 3 marks theory, they would have consumed a lot of time. Let us solve this problem. Except for the question on convexity, others were fairly simple. Still, some of the other things were also, students would not have learned or not known. They would lose marks, as only 7 marks for this. Let us solve the problem. First question is on bond price. So we know the bond price formula. B0 is equal to C into PVIFA A comma N plus Bn into PVIF A comma N. C is a coupon, K is yield to maturity or expected rate of return, N is maturity, Bn is a face value. So let us substitute. It is a 8.5% bond, so 850 into K is 10%, so PVIFA. Maturity is 5 years. Face value is 10,000. So this is another trap. Now generally we are used to solving problem Bn equal to 1000. So C is 8.5% of face value, that is Bn. So 8.5 upon 100 of 10,000, so comes to 850, and this is what you have used here. Since we are used to doing problem of 1000 face value, there is a danger of writing 85. Because you have been seeing something regularly, day in day out. Suddenly something different comes, So you think, this I know, every day I am seeing. So this is a trap. So this trap was there in this problem. 10,000 into PVIF 10,5. So the P factors are given to us. So when you substitute, we get 9431.50. So this is the first question. There is 1 mark because 7 mark problem, 7 questions are there. B. They are asking what is duration. So duration is 1 upon B0 summation of T plus 1 plus K raised to T. Sorry, I'll just put not T plus 1. T into cash flow T. T plus 1 would come in convexity, not in duration. So T into cash flow T means first year cash flow multiplied by 1, discounted once. Second year cash flow multiplied by 2, discounted twice. Third year cash flow multiplied by 3, discounted thrice. Same logic. So 1 upon 9431.50 into 1 into first year cash flow is coupon and K is given as 10%. So 2 into 850, 3 into 850, 4 into 850, 5 into 850, and plus 5 into 10,000. Because you have to multiply the 5th year cash flow. So face value and coupon both you are getting. So when you calculate this, I have done the calculations already. You can easily verify. Comes to 4.25 years. So you can see the formula, application of formula. If you know duration, if you know face value, everything you can do. You can see the trap of 10,000. That's a trap. So here 1 upon B0. Now I'll tell you, B0 usually we are used to writing face value because K equal to C. B0 will be par value. Suppose you are in the habit of writing that, then you would have written straight with 10,000. In fact, it is 943150. Okay. So this carried 1 mark. And they use the word Macaulay's duration. I've already said in the class that Macaulay, on this name only we have got this measure, Macaulay's duration. So this D, the name of the duration. So one must not be wondering what is this new duration. It is same as D, what we calculate. Next they have asked volatility. This we have done. D upon 1 plus K. So when you do 3.86. Remember, do not erase the value in the calculator because usually it will be used for the next calculation in most of the times. Okay. So you should be unnecessarily, it saves some time for you. D. So this again you get 1 mark. Now comes convexity. Convexity formula is similar to, is actually second derivative of bond price equation. First derivative of bond price equation is duration. Second, suppose you take differentiate against once more with respect to B0, you get convexity. So convexity formula is 1 upon B0 into 1 plus what we can do is, I'll write here next line. Okay, now I will write the bracket first and I'll tell you how to remember the formula. In duration we have T into cash flow times. So here we will have T into T plus 1. T plus 1, sorry. Into cash flow. So we have got T into T plus 1. In duration we discount once, discount respectively. So here also we discount. And in duration we don't do 1 upon 1 plus K, but here we have to do 1 upon 1 plus K square. In duration we divide by B0, here also we divide by B0. So what are the changes? Changes is this. So duration convexity problem changes. So we have T plus 1 in the numerator and 1 plus K the whole square in the denominator. So if you do this, we get 1 upon 9431.5 1.1 square into 1 into first year, 1 into 1 plus 1. 1 into 2 into 850 discounted once. Second year. 2 into 2 plus 1. 2 into 3 into 850 discounted twice. Third year. 3 into 4. 3 into 4 850 discounted. Fourth year. 4 into 5 multiplied by 850 discounted 4 times. 5 into 6 850 plus 10,000 discounted 5 times. So when you solve this, I calculated already 19.91. So you have to remember this. Now that they have started asking convexity, you can get in the exam. Unfortunately, they gave only 1 mark for this also. So this is the fastest method. Table method will be very lengthy, and therefore this method can be preferred. If you want to do in table form, I'll just show you. So we write here, or just writing table method. Now because there are students who feel this method is better, so we write here period. Remember, period is our T. Then we have got cash flows. Then we will have PV factor. Now we will have PV of cash flow. Then we will have T plus 1. Or we can write here, for duration, let us split up T into PV of cash flows. Then T into T plus 1 into PV of cash flows. So we'll be doing 1, 2, up to 5. In 5th year, you can show, now this is 850. 5th year, you can show 10850. And then you will be taking a total here. Now this total will be PV of cash flow. This will be B0. This is your answer for A. Then this total you will get. So let us call it as X. Let us call it as Y. Then Y upon X will be your duration. This will be answer for B. And if you take the total of this, let us call it as Z. Then you should do Z upon X into 1.1 square. This will be your convexity. This will be C. Answer for not C, answer for D. So if you want to do by table method, then you will get like this. You may say, sir, I am saving time. And according to me, in table you have to be very alert. Suppose one wrong calculation, all three will be wrong. That is one danger. Second is, you must know how to divide what by what to get the duration, what by what to get convexity. If you do T into T plus 1 into PVCF, the summation sign is taken care of. Then you should divide by X and you should also divide by 1.1 square. So table method, I would not do, but if you are finding it convenient, please do it. But be confident, prepare well, and then implement in the exam. Okay. Anyway, coming to the next one. Next question they have asked is, what will be the change in the bond price? They have asked by two methods. Now, using duration. Using duration, now we calculate delta B0 percentage is equal to minus D into delta K upon 1 plus K. So minus 4.25 into, now rates are going down by 2%. So minus 2% upon 1.1. So minus into minus is plus. So we get 8.5 upon 1.1. That is 2 into 4.25 is 8.5 upon 1.1. So that will give me 7.73%. We'll check once again. 8.5 divided by 1.1, like 7.727, 7.3%. So prices, therefore prices rise. Plus 7.73. This was using duration, straight away we calculated. Remember, this is percentage, this also percentage. So this you should remember, this is percentage, this also percentage. Don't convert into decimal. If you convert in decimal, then left hand side answer will come in decimal. Then you have to make it percentage. Very, very important. So delta K percent. So I wrote here 2. I didn't make 2%. I did not write 0.02. If you make 0.02, then left hand side you will get the answer in decimal. Okay, so a very important point here. If I use bond price, if I use direct calculation, now direct calculation. Direct calculation means what? BN 10,000, C 8.5%, K 10% minus 2% equal to 8%, N 5 years. Therefore, B0 equal to C into PVIFA KN plus BN into PVIF KN equal to 850 into PVIFA 8,5. Instead of 10, we should take 8. Why? The interest rate has fallen now. Plus 10,000 into PVIF 8,5. This will give 850. The given the P factors. Okay. And this, if we substitute this, we'll get the answer directly. 10204.15. Now we are, what they are asking, they have to calculate a price. So here we have to write, therefore the new price will be 9,431.50 plus 7.73%. If we do 9,431.50 plus 7.73%, 10,160.55. 10,160.5. And here we are getting new price 10,204.5. Now you can see the difference. They didn't ask in the exam. So you can write A and this B. They are not asked why. Why price calculated using duration formula and direct price, they are different. They are different because of the concept of convexity. Okay, so it's a very lengthy thing, but just for information you can write A and B are different due to convexity, you can write. The duration believes linear relationship between yield and maturity. Actually, the relationship is convex. It is not linear. Therefore, we are finding the difference. Anyway, they didn't ask this, but this is for information. So this lengthy problem came just for 7 marks. Hope you have understood this. Let us read this problem. An investor is desirous of earning the prevailing market rate of 10% and needs rupees 10 lakhs after 7 years. There are 2 bonds available in the market. A 5-year 1000 face value 10% coupon bond quoting at par with duration of 4.17 years and 10-year rupees 1000 face value 8.275% coupon bond quoting at the same yield as 5-year bond. For immunization, to what extent the investor should invest in the 10-year bond? It's a very classic problem of how the money should be divided between 2 bonds, where we calculate the duration of the liability and duration of the asset, that is our bonds, and match it. Very, very important problem, and already the similar problem has been asked twice in the past exams. Let us see how we solve this problem. Now, for investor, there are 2 parts: his money and his investment, which is going to make. His money is, we can consider this as liability, and his investment as an asset. In such kind of problems, we have to match duration of liability with duration of asset. So when we match duration of liability with duration of asset, then we are taking care of 2 risks simultaneously. They are price risk and reinvestment risk. Now, in this problem, it is given that investor needs 10 lakhs at the end of 7 years. Now there is a gap of 7 years from investing X rupees minus X and getting 10 lakh at the end of 7 years. Some amount is investing, and is investing at the rate of 10% per annum over a period of 7 years. He needs 10 lakhs. So there is one inflow and there is one outflow separated by certain number of years. When there is one inflow and one outflow separated by a certain number of years without any intermediate inflow or outflow, then the duration is the number of years of that investment. So the duration of this liability, in the exam we can write directly duration of investors' money within bracket liability. Please understand, for an investor there are 2 hands: giving money, investing. Investing is an asset, so that is a liability. So duration of investors' money liability is equal to 7 years. In bracket you can write since inflow of 10 lakh at the end of 7 years and outflow today is separated by 7 years. So therefore we have found duration of liability is 7 years. Now if I want to immunize, for immunization means protecting our investment from risk. We have to match duration of liability with duration of asset. Now duration of liability is 7 years. So therefore duration of asset should be 7 years. So this is an important thing. So I have to match duration of asset is 7 years. Now asset, I am going to invest in bond. How many bonds they are given? They are given 2 bonds. So duration of my investment in 2 bonds should be 7 years. So since we are investing or we are thinking of investing in 2 bonds, they are not given the name, so we can give the name, say 1 and 2. We can or we need duration of 1 into proportion of investment in 1 plus duration of 2 into proportion of investment in 2 should be equal to 7 years. So we have to ensure that D1W1 plus D2W2 should be 7 years. What is D1? D1 is duration of, they are given 5-year bond. This they are given directly 4.17 years. What is D2? D2 is duration of 10-year bond. This we don't know, so we can call it as D2 itself as of now. We can say working note 1. So we will calculate this below. Now what is W1? And W1 is proportion of investment in bond 1 and W2 is proportion of investment in bond 2, and we are interested in calculating this only because they are asking to what extent investors should invest in 10-year bond. So we have to calculate W2, and we know that also W1 plus W2 is equal to 1 because our entire investment is going to be only in 2 bonds. Therefore W2 is equal to 1 minus W1. Now let us see this. D1 we know, D2 we can calculate, so we can mark it as we know that. Right hand side is 7 and we know W2 is equal to 1 minus W1. So you can call it as equation number 1. Therefore we can write 4.17 W1 plus D2 into 1 minus W1 equal to 7. Now what we do is we calculate D2 and then substitute there, which will give us answer of W1 and W2, and we can say how much we can invest in bond, 10-year bond. So now let us calculate duration of bond 2. So working note 1, duration of bond or 10-year bond. Now in this case we don't know the price. Since we don't know the price of the bond, the table method will be very useful. So in the table method we can calculate the price, we can calculate the duration both. If price is known, then the formula method will be faster. So let us calculate the duration, and since we need the price for duration, so we calculate duration using this table method. Let us write down the features of the bond. BN is 1000, C is equal to 8.275%, N equal to 10 years, and K is equal to, it is given that this bond is quoting at the same yield as 5-year bond. Now let us see what they have given about 5-year bond. A 5-year 1000 face value, 10% coupon bond is quoting at par. So since five-year bond with C equal to 10% quotes at par, we have K equal to C equal to 10%. When a bond quotes at par, yield is equal to coupon. So we got 5-year bond yield as 10%. Now here they are given 10-year bond is also quoting at 10%. So therefore K is equal to 10%, same as 5-year bond. So we have got all the requirement to calculate duration. BN, C, N and K. B0 can be found out when we draw the table. So we do this calculation now. We have year, cash flow, PV at K, that is 10%, then PV of cash flow, then weight into PV of cash flow. So we write 3, 4, 5, 6, 7, 8, 9 and 10. Now 8.275% on 1000, 8275. And last year we get our face value back. So 108275. P factor for 10% we can calculate using 1 divided by 1.1 equal to now PVF cash flows, multiply this. So when we multiply this, and when you multiply, you should be putting an M plus, so that when you get a memory recall, you get the total, and that will be the bond price. So this B0, when you press memory recall, you will get 894.42. Now again you should do weight into PVF cash flow and memory plus, and keep on doing memory plus, and memory recall will give you the total of the final column. So this will be 75.22 into 1, 68.35 into 2, and when you do memory recall, you get a total 6262.9. Therefore D2 will be 6262.9 divided by 894.42. 6262.9 divided by 894.42. Get 7 equal to 7 years. I'm getting 7.00 something. So now we don't write more than 2 decimals. So 7 years we are getting. So we are getting D2 is equal to 7. We substitute it in the above formula. We get 4.17 W1 plus 7 into 1 minus W1 is equal to 7. So 4.17 W1 plus 7 minus 7 W1 equal to 7. 7 cancels. So we get 2.83 W1 equal to 0, or W1 is equal to 0. Therefore W2 is equal to 1 minus W1 equal to 1. Therefore invest entirely in bond 2, that is 10-year bond. So we are getting the required answer that one must invest entirely in 10-year bond. No, it is not at all magic, it is simply evident. Once you got the answer 7 years, we have to immediately think what is the duration of our liability. Duration of our liability is 7 years. Duration of asset has to be 7 years. And one single bond is available. Why to go in search of 2 bonds? Invest entirely in that single bond whose duration is also 7 years. This kind of investment of investing in a single bond for the purpose of immunization is called bullet immunization. So bullet immunization aims at investing in a single bond where duration of asset automatically matches with duration of liability. So this immunization problem, where we thought that we should be investing in two bonds, has been converted to investment in a single bond, since that single bond has the duration same as that of liability. So this is a classic case of bullet immunization. You need to see this particular video where I have spoken about so many concepts 2 or 3 times, and then it would be quite easy for you to run through the concepts. Hope you understood this. Let us read this problem. We are given a table of face value, interest rate in percentage, maturity years, and current price. We are able to see that 4 years maturity, 1, 2, 3, 4. For 4 different years, information has been provided. Calculate the forward rate for year 4 approximately. So this is a classic problem of calculating forward rate of a bond. And we will be doing this activity 4 times. We will start with the first one, calculate for year 1. Then take the second row data, calculate for year 2. Then year 3 and year 4. Okay, let us see how we solve this problem. We have B0 is equal to C upon 1 plus K plus C upon 1 plus K square plus C upon 1 plus KQ plus C plus Bn upon 1 plus K raised to N as a typical bond pricing formula. Bn refers to face value, C refers to coupon, C refers to coupon, K refers to yield to maturity, and N refers to term to maturity, and B0 is the price of the bond. So there are totally 5 parameters in bond pricing formula. But here we don't want yield to maturity. They are asking us forward rates. So we have learned the concept of forward rates, and the formula is slightly modified. Forward rate is for 1 year, remember. So every year will have its own forward rate. First year forward rate, let it be R1. Second year forward rate R2, and so on. So we don't have a single K for every year. We have individual forward rates for each year. So this formula, as we have learned, B0 is equal to C upon 1 plus R1 plus C upon 1 plus R1, 1 plus R2. So in the second term, we can see instead of 1 plus K square, we have R1, R2, R1 for first year, R2 for second year. C upon 1 plus R1, 1 plus R2, 1 plus R3, plus C upon 1 plus R1, 1 plus R2, 1 plus R3, 1 plus R4. Remember, we are asked only up to year 4. So we will put a stop. We will write the face value in the last term. Now they are asking us to calculate R4. So we want to calculate this. remember, we don't know R1 also, R2 also and R3 also. Nothing is given. But what we are going to do, we are going to use the first row, that is zero coupon bond information, and calculate R1 first. Then you're going to use the second row data. We are having 2-year bond. We will calculate R2 using that, because R1 we already calculated using the first row. So using the second row 2-year bond, we will calculate R2. Using the third row data, 3-year bond, we will calculate R3. So like that we will do 4 times. First time using first row data, calculate R1. Again we start, write the bond price equation, calculate R2. Again we write the bond price equation, calculate R3. And finally, using the fourth row data, we write this formula and calculate R4. So it is slightly, mathematically you can say, if you want to talk of calculation, it may be lengthy calculation provided you don't know the technique. So let us see how we go about. So first, let us write for the first data. So we should write here year 1. So it is a 1-year bond and we are given zero coupon bond. So we know the formula, B0 is equal to, there is no coupon, so C is 0. So it will be, usually we write like this, C plus Bn upon 1 plus R1. Now but C is 0, okay, given. So what is B0? So they are given 909 equal to Bn. They are given the face value as 1 lakh upon 1 plus R1. When you calculate this, very simple calculation, we get R1 equal to 10%. So now we know R1. Now we can use the second row data to calculate R2. So then we write year 2. We write B0 is equal to C upon 1 plus R1, C plus Bn, remember it is a second year, 1 plus R1 into 1 plus R2. Now we can write B0, they are given as 10046 is equal to, now coupon, it is a 10.5% of 1 lakh. 10.5% coupon bond. 10.5% into 1 lakh is 10,500 upon 1.1, because we have calculated R1 as 10%. Then 10,500 plus 1 lakh upon 1.1 into 1 plus R2. Now this calculation, troubles many students. But if you are good in using memory functions in the calculator, it will be extremely easy. So how we do this? We actually store, remember, we want to find this. So first we have to simplify this box. Now what we can do is, we will store this in memory plus first, and when we store this in memory minus, so the entire thing will be available here, memory recall. So you store this in memory plus and memory minus will be memory recall. So this will become, this we need not write in the exam. So memory recall, so whatever we have simplified this is equal to 10,500, or we can straight away write 1,10,500 upon 1.1 into 1 plus R2. Therefore 1 plus R2 is equal to this upon 1.1 into whatever we have got in memory recall. Therefore, R2 is equal to 1,10,500 upon 1.1 into whatever we are getting in memory recall. So what we do, 1,10,500 input in the calculator divided by 1.1 divided by memory recall minus 1, and this will give us the answer, and you will get the answer as 11%, or you will be getting 0.11 approx, so that will be 11%. So this will give us R2 from the second year data. Similarly, we proceed to calculate R3. Year 3 is equal to B0 is equal to C upon 1 plus R1, C upon 1 plus R1, 1 plus R2 plus C plus Bn upon 1 plus R1, 1 plus R2, 1 plus R3. Price is given as 100,180 is equal to, coupon is 11%, so 11,000 upon 1.1 plus 11,000 upon 1.10, 1.11 plus 1,11,000 upon 1.10, 1.11, 1 plus R3. Again we put this memory plus, we calculate store in memory minus, we calculate store in memory minus. This entire thing will be available to us in memory recall. Therefore, we will finally get memory recall, whatever we have, entire thing will be 1,11,000 upon 1.1, 1.11, 1 plus R3, or this will simplify to R3 is equal to 1,11,000 divided by 1.1, 1.11, and whatever we have in memory recall minus 1. Now only this step, this memory recall, we will not be writing in the exam, but I am telling you how you should be calculating, because I have seen many students taking a lot of time to calculate this. The drawback of this problem is the time of calculation. So this is what you should be practicing 3-4 times, and remember, see on the last day also that this technique can save a lot of time for you. Then automatically this problems becomes very easy. So when we substitute this, and we will be getting the answer as 12%. Finally, we come to the required answer, that is year 4 calculation. So we will be writing B0 is equal to C upon 1 plus R1, C upon 1 plus R1, 1 plus R2 plus C upon 1 plus R1, 1 plus R2, 1 plus R3 plus C plus Bn upon 1 plus R1, 1 plus R2, 1 plus R3 and 1 plus R4. So we substitute, we get last is 100,440 is equal to bond 11,500, 1.1, 11,500 upon 1.10, 1.11. Now you can see when I am writing the second term, though I have written 1.1 here, I am writing this 1.10 just to safeguard the silly error which we might commit while calculating. So we are able to see 1.10, 1.11. Now is quite important because these are all very small techniques which you should actually practice while doing revision. Plus 11,500 upon 1.10, 1.11, 1.12 plus 1,11,500 upon 1.10, 1.11, 1.12, 1 plus R4. So again, you put this in memory plus, memory minus, memory minus, memory minus, and in the exam we should show this substitution, and straight away we can write by solving. We should be writing like this: by solving we find R4 is equal to 13%. So in the exam at the CA final level, they don't want to verify whether you know 2 plus 3 is equal to 5. This calculation, very important is you have to write the formula. Secondly, you must show correct substitution. So this step is very important. So this is important, this is important, this is important, and finally this is important. So you need not show the intermediate calculation steps. But if intermediate calculation steps involve some substitution in the given data, suppose they are given exponential value, you have to show substitution, then one more step will come. Otherwise we straight away write this. So we get R4 equal to 13%. So the required answer is 13%. So this is problem from bond market chapter where we have calculated forward rates using multiple data given to us. Hope you have understood this. Let us read this problem. ABC 8% rupees 1000 face value convertible debentures quote at a conversion premium of rupees 2.50 in the market. The convertible offers 40 shares per debenture surrendered for conversion. Dividend of rupees 1.50 per share is payable to shareholders. Calculate the premium payback period. Now this has a presence in your material, study material, but yet to be asked in the exam if I am right. Though there are so many things about convertible debenture, this is a very important aspect or very important part of convertible debenture. So this problem will help you understand the concept of calculation of premium payback period. Let us see how we solve this problem. Before we do all this, we must know certain basics of convertible debenture formulas. First one is conversion premium. It is given as rupees 2.50. Now conversion premium is the excess an investor would pay over and above the value it deserves. So when an investor is buying a convertible and it is stated that rupees 2.50 is paid. Now why you are paying extra 2 rupee 50 paisa? You expect that by the time conversion offer materializes or when you actually convert, you will be able to recover this 2.50. Means you surrender the convertible, you get the shares, and when you sell the shares, per share you will be easily able to recover this 2.50. So therefore based on that bet you are paying rupees 2.50 today. But conversion is some years away. Till then what happens? Suppose you are buying a convertible today and conversion is say 6 years away. Now you have to recover this premium paid. Now are you going to get any money? Let us see what are the considerations you must make. First of all, you have a bond. It is actually 8% coupon bond. $1,000 face value. 8% 1,000 face value bond. So till the conversion happens, bond is going to give you coupons. So you are going to get income from coupon equal to 8% into 1,000 equal to rupees 80 per annum. So you have bought a convertible, you paid premium 2.5, and till the conversion happens, which may be some years away, you are likely to get rupees 80 per annum. Now, had you converted into shares, how much income you would have received? Suppose you can do conversion today itself. Suppose you get conversion today itself, then one bond will give you 40 shares. It is given that 40 shares will be given. So per bond, the conversion ratio is equal to 40. Therefore, if we convert today, we would get rupees 40. Sorry, we would get 40 shares. Now, if you are having shares, are we going to receive any income from the company? Yes, it is given that dividend of 1.50 is payable. Then we receive dividend equal to rupees 1.50 per share. Therefore, what is the dividend? Total dividend. So total dividend, so rupees 1.50 per share into 40 shares equal to rupees 60. Without conversion, you are going to get 80 per annum. With conversion, you are going to get 60 per annum. And therefore, what is a favorable income? Favorable income per share means by holding the bond, what is the increase in income on per share basis? Suppose you hold the bond, you are going to get rupees 80. And if you hold the shares, you are going to get rupees 60. Now 60 is calculated on 40 shares. Therefore, you are going to get incremental 80 minus 60. But I want to calculate per share. Remember, 60 rupees is on 40 shares. Just see, we have multiplied here. 1.5 into 40 shares. So per bond you will get 80 as coupon. Per bond converted to 40 shares you will get 60 as dividend. Increment is 80 minus 60, 20 rupees, and divided by number of shares will give you incremental income which is popularly called as favorable income per share. So this will be rupees 20 upon 40. This is per annum, or I will write here per year. Per year. So this will be equal to rupees 0.5 per year. So by you have bought a convertible, you paid 2.5 as a premium and you are holding the bond. So if you want to calculate incremental income of holding the bond, you are going to earn rupees 0.5 per annum. So like that, how many years you have to hold? Then you will recover your premium paid. So 0.5, 0.5, 0.5, 0.5 and 0.5. Total 5 years you have to hold. If you hold for 5 years, every year you will get 0.5. So 5 into 0.5 is 2.5. At that stage, you would have recovered the premium which you have bought, which you have paid while buying the convertible. So therefore, payback period, remember payback period is in years, will be equal to premium paid divided by favorable income per share. See, premium paid, this also per, right? You can do like this, favorable income per year. So this will be rupees 2.5. This will be rupees 0.5 per year. Remember, the year is denominator of denominator. We go to numerator. So you will get the answer in years. 2.5 by 0.5 is 5. So payback period is 5 years. So what we have learned in this problem? First one, convertibles are traded in the market and we have bought the convertible and paid 2 rupees 50 paisa as premium. Now this premium we must recover. Is it possible to calculate whether we can recover 2.5 before the date of conversion? And that's what this problem addresses. Though I have paid 2.5, though I expect that by the time conversion happens, share price will be extremely high, but I am verifying whether I am able to recover before conversion date. How we go about? First we find conversion ratio. It is given directly in the problem, 40 shares. Then I consider, if I hold the bond, what I will get? If I hold the bond, I will get coupon. How much coupon? 8% on 1000, 80 rupees. 80 rupees I will get every year. Okay. Had I not held the bond, had I bought the shares, converted into shares, how many shares I would have got? 40 shares. How much dividend I would have got? 60 rupees. 40 into 1.5, 60 rupees. Therefore, what is the incremental income by holding the bond? So I am getting 20 rupees per share upon 40 shares equal to 0.5. So how much premium I paid? 2.5. What is my recovery rate every year? 0.5. So how many years it will take? It will take 5 years. It's a very important problem. Usually comes for 5 marks. And this concept, favorable income per share has been asked, but premium payback period is yet to be asked. It's a very important problem. I hope you understood this. Let us read this problem. Sunil Limited is considering offering a new rupees 50 million bond issue to replace an outstanding rupees 50 million bond issue. The firm is in the 40% tax bracket. The outstanding bonds have a rupees 1000 par value and a 12% coupon interest rate. They were issued 10 years ago with a 25-year maturity. They were initially sold at a rupees 20 per bond discount and a rupees 2 lakh flotation cost was incurred. They are callable at rupees 1100. The new bonds would have a 15-year maturity, a par value of 1000 and a 10-year 10% coupon interest rate. It is expected that these bonds can be sold at par for a flotation cost of rupees 5 lakhs. The firm expects a 2-month period of overlapping interest while it retires the old bonds. If the firm uses its after-tax cost of debt of 7% to evaluate low-risk decisions, the net present value of the bond refunding decision will be how much? Okay. So given PVIFA 7% 15 is 9.108. So this is a popular problem. In fact, it is a comprehensive problem involving everything. Means discount. Bond is issued at discount. Then whenever you are, then there is a call premium. Then there is a overlapping interest. Okay, generally when the problem of reissue of bond was asked in the past, discount was not there, overlapping interest was not there. So this problem encompasses everything, all examinations. Very, very important problem. Let us see how we do this. It relates to reissue of bonds. Very popular problem which comes in say around once in 5-6 attempts. And this problem is an exhaustive problem covering every aspect of reissue, including issuing a bond at discount, including payment of overlapping interest. I would tell briefly about this bond. This bond was issued 10 years ago for 25 years. So it has got 15 years to go. This company, Sunil Limited, has found that the interest rate has fallen in the market. So it wants to replace the old bond which was paying 12% with a 10% bond. Why? Interest rates have fallen. So why I should give my bondholders 12%? So I want to reissue bond at 10%. Now, when you want to reissue bond at a lower rate, you have to compensate the old bondholders because you are throwing them away. You are telling that, I am going to give the bonds, I am going to give your face value back. So you have to pay them premium. So whenever you are calling back the bond before scheduled maturity, you have to pay premium to the bondholders. Now, when Sunil Limited issued bond 25 years ago, it attracted funds by giving 20 rupee discount per bond. Now this discount is a cost incurred, so it can be amortized. Similarly, flotation cost can be amortized. Now in the process of making a decision whether to go for reissue or not, Sunil Limited will have to write down all the benefits. It has to write down all the costs. And when the benefits exceed cost, the bond can be reissued. So let us see all the considerations which Sunil Limited has to make. So I have broadly written down the features, whatever I said just now. It is a 50 million bond issue. The face value is 1000. Therefore, number of bonds is 50 million upon 1000. That will be 50,000. Number of bonds are required for two purposes here. They are given call premium per bond and they are given discount per bond. So I need number of bonds. Now call premium is callable at 1100. So therefore I have to pay premium of 100 rupees per bond. Old coupon is 12%, new coupon is 10%. So you are replacing high interest 12% bond with low interest 10% bond. Bond issues happen when interest rates fall. Therefore, investors who are investing in a higher coupon bond should watch the market carefully. When interest rates start falling, you will suddenly get a letter from the company that give the bond back, take your money, because companies reissue bonds with low coupons when interest rates fall. Now, when the old bond was given, 25 years were there. So you are at this stage when you are planning to replace the old bond with this new bond. The new bond is going to carry 10% coupon. So 15 years, usually the new bond tenure will match the leftover tenure of the old bond. It never, then only you will be able to make proper comparison. Old bond incurred a protection cost of 2 lakhs, new bond 5 lakh. Discount of 20 was offered to old bond holders. Now, what are the considerations Sunil Limited has to make? Sunil Limited has to write down all the benefits and it has to write down all the costs. Now, what are the costs and what are the benefits? First benefit you can write 12% is going to be replaced by 10%. So 2% benefit Sunil Limited is going to get. So, and it is going to get for 15 years now because bond has got another 15 years to go. Every year 2% benefit. Interest paid on bond is tax deductible. So we can say that on 50 million issue, you are going to get 2% benefit. And this is going to be tax deductible. And this is going to be available every year for next 15 years. But I have to, since I am making decision today about reissue, I want present value of all those benefits. Therefore, into PVIFA, after tax cost of debt is 7%, 15 years. So this is present value of interest savings. So this we can calculate. This will be 50 million into 0.02 into 0.6 because T is 40% into the given P factor 9.108 5464800. This is the first big benefit or the main benefit for which the company is going for issue. Now when you are calling back the bond, you have to pay a premium. So that premium you have to pay today itself. So cost of premium post tax equal to 50,000 number of bonds into, it is callable at 1100. So 100 rupees a premium into rupees 100 into Now this is a cost. Company can claim tax deduction. So therefore the actual cost is not this much. Actual cost is 40% less. So into 1 minus T. This will be 50,000 into 100 into 0.6. This will be 30 lakhs. So premium cost is a big amount actually. Now this discourages many companies from going for reissue. They're going to eat away. You can just see interest saving is coming, though we are having other adjustments which are more accounting. This is a major thing. We'll put one for cost also. We can put separate serial numbers. Second is flotation cost of new bond. It is given as 5 lakhs. Now this flotation cost can be amortized. It's a new bond. New bond is having 15 years. So how much I can amortize? Now I can amortize 5 lakh. So 5 lakh divided by 15. Every year I can amortize this. So I can amortize 5 lakh divided by 15. Why? Cost is incurred today. Bond is having a tenure of 15 years. Therefore, bond benefit is available for 15 years. Cost is incurred in time 0. Benefit available over 15 years. Therefore, amortize the cost over 15 years. So 5 lakh upon 15. I am going to get tax benefit of 40%. Now 5 lakh upon 15 is every year. So for 15 years. But I want present value. Therefore, into PVIFA, 7%, 15. This will be 5 lakh divided by 15 into 0.4 into 9.108. 121440 rupees 121440. 1,25,440. So what we can write? This is, I am taking present value. PV of what? PV of amortization of what? Of flotation cost of new bond. Now writing the narration for every calculation is equally important, because examiner has to understand what you have calculated. So the flotation cost of new bond I have amortized. I have taken PV. Therefore, PV of amortization of flotation cost of new bond. Third, now that old bond you incurred 2 lakh flotation cost. So I'm writing 2 lakhs flotation cost, and you are eligible to claim amortization 2 lakh divided by 25. So 2 lakh divided by 25, if you do simple calculation, 8,000 rupees you could amortize every year. So 8,000 rupees you could amortize every year. So like this you did for 10 years. That is gone, forget. But another 15 years is there, yet to be amortized. So into 15 is yet to be amortized. So this much amortization is left. So what you will do? today, that is when you are reissuing a new bond, you will amortize this entire thing. So you will get a big benefit of 0.4. 40% of this amount will be your benefit. But accounting norms do not permit the firm to take this benefit. It says that had the company done amortization normally, what would have been the present value of it? Let us write that. Had the company done normal amortization, then it would have amortized 8,000. It would have got 40% tax benefit, and the present value of it would have been this much. So this is the present value of amortization of rotation cost of old bond. Had it gone through the normal course, this would have been the benefit. So if I call it as A, if I call this as A and this as B, please understand the difference between A and B. A is instant amortization of leftover flotation cost of old bond. Because I am going to issue new bond, old bond is going to be killed, it's not going to be there. So whatever amortization cost, whatever flotation cost of old bond was left unamortized, you would amortize at once. That is A. But you don't get that benefit. What is B? B is present value of flotation cost of old bond done in normal course, and tax benefit is available to the extent of A minus B. So you can get only this benefit, A minus B. So we write here present value of, or we can write here incremental benefit from amortization of flotation cost of old bond. So when you do this calculation, is equal to 2 lakh divided by 25, that is 8,000 into 15 into 0.4 m plus. Then the next one, we are getting 18,854.40 rupees, 18,854.40. Now flotation costs was incurred when the old bond was issued. Similarly, company incurred another cost. What is that cost? Discount. To attract funds from investors, it offered discount, 20 rupee discount on 50,000 bonds. So that is 10 lakh rupees. So 10 lakh rupees was the money spent by the company in offering discount. So 10 lakh is a cost. So like flotation cost, you would amortize that because you are giving a discount today. The benefit of the bond is available over 25 years. So here also, in the same way, you are done for flotation cost. So 10 lakh was the cost incurred, and you are eligible to amortize per annum 10 lakh divided by 25, that is 40,000, and 15 years amortization is left today because bond has crossed only 10 years. Another 15 years is left. So 10 lakh upon 25, that is 40,000 rupees into 15 is still left. And tax benefit on this today would have been this. But you are not permitted to take this. Had you done normally, how much benefit you would have got in present value terms? You would have got, had I done normally, I would have got 40,000 into 40% into PVIFA 7%, 15, and this will be equal to, this will be approximately 5 times. Still we'll calculate. Nine four two seven two. So you can see that it is 5 times the flotation cost, because flotation cost is 2 lakh and this 10 lakhs. So incremental benefit, you may write the word tax benefit, incremental tax benefit from amortization of discount of old bonds. Now all the benefits have been taken. Now we have got one more cost. Now that one more cost is overlapping interest. So let me explain below here. This is time 0. Ten years, 25 years. Now this is old bond. Now new bond. Now when the interest rate is falling, you are writing letters to every old bond holder. Dear bond holder, we were paying 12%. Now we are not in a position to pay 12%. We will pay 10%. Please return the bond. We will give you money. But you will give money, but where is the money? There is no money. So Sunil Limited will have to issue new bond first. So new bond will be issued first. Money collected. And to collect the money, do the processing, it will take 2 months. So first issue new bond, and from the date of issue of new bond, 2 months will take for the entire amount to come in the company's account. While you have written letters to old bond holders, return the bond. So even that will take time. Every bond holder will return the bond, you will process it and keep it. And then you will give them the face value. By the time the new bond proceeds would have been collected. So you are going to pay interest to new bond holders from this date. You are going to complete all the processing of old bond and new bond only on this date. So on this date only you are going to refund your face value back with premium. So 1000 plus 100 rupees you are going to give only on this date. So we can see this period this period of 2 months, you are paying to old bondholders also. You are paying 12% to old bondholders. Bond has actually ended on this date. But since you are paying the money, actual money 2 months later after calling the bond, so you have to pay 12% interest to old bondholders for 2 months. Remember, we have compared this difference on interest saving from this date. So we have compared this for 15 years. So this has been taken into account. So while you are writing letters to old bondholders, the actual 1000 plus 100 you are paying only 2 months later. So for the 2 months, you have to pay overlapping interest. That is 12% you have to pay. So third, overlapping interest cost rupees 50 million into 12% into 2 by 12 into, you will get tax benefit 1 minus T. So 12% per annum for 2 months, so 2 upon 12. So this will be 50 million into 0.12 into 2 divided by 12 into 0.6, 6 lakhs. So you calculate benefits 1, 2, 3, 4 and cost. Let us do the cost benefit analysis. So total cost, so we will write the total cost here. So this total benefit when you add all the benefits, five six nine nine 366 5699 366.40 and total cost 35.41 lakhs. So net benefit we have. So net benefit is equal to 15,99,366.4. So since we have net benefit, the company should go for reissue. It's not a difficult problem, but it's better that you practice 3-4 times, because you can do it very quickly in the exam if you have practiced well enough. Hope you understood this. Let us now start the next chapter, portfolio management. One of the most important chapters. It comes under section 2 of CFNL, and though it consists of lots of formulae, fairly easy as compared to many chapters. A student can expect anywhere between 8 to 16 marks in the exam. Section 2 has a quota of approximately 28 marks, of which you can expect 16 marks from this chapter max. Sometimes it can exceed, but you can expect at least 8 to 16 marks. Now what kind of problems we can see in this chapter? Let us see that first. Now there are various subtopics in portfolio management. So we have basics of risk and return. So we can say you can expect problems from basics of risk and return. Then you can expect problems based on CAPM. And when I say CAPM, I will also include, pricing using CAPM, means using DDM and CAPM. You can expect problems on beta, calculation, characteristic line, etc. Portfolio beta, those kind of problems. You can expect problems on sharp single index model. You can expect problems on asset beta, project beta, etc. You can expect problems on asset allocation. And others. Now, when I say others, we have exponential moving average. We have Sharpe's portfolio optimization model. These are all the things you can expect in this chapter of portfolio management. Now, such a vast chapter actually. So many things to learn. I have missed out one more thing, that is APT. Now, whatever I have written, see, of this, the most important is this. 80% of the times, I repeat, 80% of the times you get questions on this. Now, if you do this chapter, you have to do completely. As I told you, if you take any chapter in section 2, then you should do all the chapters of section 2. Now, that is wise and makes sense. It is not, institute never tells that I will ask, suppose they will ask 28 marks in section 2. But they may ask 0 marks in portfolio also. And they will ask remaining in valuation of DDM, preference share valuation, convertible debenture, bond market. So they can include 28 marks from there. Nobody can stop. But it generally doesn't happen. So if you are selecting a chapter to do well, ensure that in that particular section you do every chapter well. So that will protect you. It's not that if it is not done properly, it doesn't harm you, but sometimes it can backfire. So this CAPM beta sharp single index model, they form the heart of portfolio management. So you expect problems from these three. So you should ask yourself whether you know this better and do all the problems wherever these are involved. Sometimes problem come from here, so we can say around 5%. Sometimes problem come from here, say around 5%, 5%, and remaining 5%. So you can say that other problems do come, but I told you it is left to institute. They have every right to test a student on any part of the syllabus, and nobody can question, and absolutely fine. If we are good at portfolio, we must be good at every part of the portfolio chapter. So let us see what are all the things you must learn. So there is a formula video after this chapter summary. There you might find so many things I am repeating, and that is required. Revision means what? Revision. So you will again see, but let you just go through the process. Then only you are actually fortifying or strengthening your case to pass with flying colors. So let us see. The first thing, Now we have historical data. Whenever we are given historical data, they can give prices or they can give returns. Remember, with prices I cannot do anything. I repeat, with prices I cannot do anything. First I have to calculate return. Calculate returns. Now how to calculate return? Now return using historical data, we write RA bar is equal to summation of RA divided by N. Remember, it is historical data, so I may give 5 year, 10 year, 11 year, etc. Suppose I got 10 prices, 10 data, so you will get 9 data of returns. Suppose I got 3 prices, I can calculate only 2 returns, 1 less. So from prices you have to calculate return, and once you calculate return, you have to calculate a mean, and this is return. Then you can calculate risk. Risk is nothing but your standard deviation. This is standard deviation. Is given by the formula summation of deviation. Deviation from what? Deviation from mean. So deviation from mean. Now this is your mean. So deviation from mean. Then you have to standardize. Standardize means you have to take a square. Standardizing means you have to take a square. And then you have to divide by n. And finally you have to take a square root. So this is your sigma A. So we can write as SD also. Standard deviation. So this is your return and this is your risk. So when you are given historical data, we can calculate return and risk like this. Now square of standard deviation will be sigma square A. This is called variance. Now you must know certain facts about return, risk and variance. So I am going to tell that, listen carefully. Now returns are calculated in percentage. Returns are calculated in percentage. Suppose I have prices 10, 12, sorry, I'll write like this, 10, 12. So this is a price. How I calculate return? You must know this. Assume it is P0. This is P1. How to calculate return of stock? Return of stock RA is equal to 12, that is P1 minus P0 plus D1. What is D1? D1 is a dividend. Stock can give dividend divided by P0. So this is your capital gain. This is your income. This is your investment. Into 100 will give you RA percentage. So we are calculating return in percentage. So if it is a stock, we calculate return like this. What about index? If it is an index, return of index. So again I am using the same word RA equal to, so I can write I1 minus I0 divided by I0 into 100, because index does not distribute dividend, but index dividend yield can be given. So plus dividend percentage. So in the case of index, we use the change in index levels. So this will be in percentage plus D percentage. See the difference in the formula. So again RA, we are getting RA percentage. So we can see that this is percentage. Remember, whatever is the unit of return, the unit of risk will be same. Suppose the original data is inch, then standard deviation will be inch. Original data is rainfall in millimeter. Standard deviation of that data will be millimeter, like that. Same unit. But when it comes to square, it is percentage square, is it not? But we don't write percentage square. Let me explain. Suppose I got, if sigma A equal to 3%, sigma square A will be 3% into 3% equal to 3 upon 100 into 3 upon 100 equal to 9 upon 10,000. No, 9 upon 10,000 is not 9%. Percent means per 100. What is the meaning of the word percent? Percent means per 100. Cent stands for century. So is it is it 100? No, it is not 100. So sigma square A is not written as percentage. Neither it is written as percentage square. Sigma square A, or you will write here, sigma variance is written as number or decimal. So here it will be 9 or 0.0009. So this you have to remember. So variance will never be written as percentage. I'm extremely sorry to inform that in the examination, couple of examinations, institute did put a percentage sign for variance and created confusion in the minds of students. So then what happens is students also tend to believe whatever institute has stated is correct, and they do it, and they end up with wrong answer. Now some of my students got 0 marks by wrongly interpreting it. They couldn't do anything. They were not given marks as a compensation. So just ignore it, finish. Mistake has happened, ignore it. But never take percentage for variance, because when returns are percentage, sigma A is percentage, sigma square A is not percentage. I've explained with an example here. Okay, let us go ahead. Now, if the data is not historical. So if the data is not historical but predicted future with probabilities, suppose the data is not historical. Now suppose one user is coming, sir, how you like this stock? Sorry, I don't have history because the stock got listed just now. So I don't have historical data, but I can predict this way. The stock can give 10% return. Chances are 40%. Stock can give 20% return. Chances are 60%. So probabilities will be given. Or we will say if the situation is normal, stock will give 10% return. If the situation is abnormal, it will give 20% return. Normal percentage is 40% and abnormal percentage is 60. Like that, they will give probability. So when the probabilities are given, then return. So we are at RA bar is equal to summation of PI RAI. I stands for every situation. Suppose they give 4 situations and I will be 1, 2, 3, 4. So there will be 4 data. So RA bar will be PI RAI. Risk in that case would be, again our normal definition, risk means standard deviation. Standard deviation. So deviation means RAI minus RA bar. So this is the deviation. Standard deviation. Now deviations, they don't occur every time. They have certain percentages given by probability. So PI. So here we have to multiply by the respective probability and put a square root equal to sigma A. So the formula is similar. Instead of divided by n, we have multiplied by pi. So this is sigma square A, variance is same for both. So if the data is not historical, we use it. So return risk for historical and predicted. We have seen what is the meaning of the word variance. We have seen how variance can be expressed. Now in a portfolio there are more than 2 stocks. You don't have just one stock, You talk about portfolio manager, you have 50 stocks, 70 stocks. So the 2 stocks, any stock in the portfolio will have some behavior with the other stock. When I say behavior, suppose you become CA and you buy 2 stocks. Say one is Cipla, other is Reliance. Cipla is a medicine making pharmaceutical company. Reliance is a petrochemical and geo, etc. All those things. Totally different business. So the 2 companies' returns will not be same. The way returns behave, in 1 year Cipla returns will be high, Reliance returns will be low, and vice versa. So the behavior of the returns of the 2 stocks will be different. So the behavior is very important. So having passed CA, you bought these 2 stocks. It is not necessary that both the stock will continuously go up. There will be sometimes it will go down, etc. So how to measure the behavior of returns? So that is given by covariance and correlation coefficient. Covariance is written as sigma, but I write A, B. Remember, it is behavior between 2. Co means behavior between 2. So therefore I am having 1, 2. Similarly here also correlation coefficient is given by rho AB. Now this is your sigma, Greek letter. This is rho, Greek letter. So again you have here 2. That is correlation. Co means between two. So sigma AB and rho AB. These two are behavioral terms. They are behavioral terms. Very useful in portfolio. Ultimately, having bought two stocks of totally different type of companies, you must know no, how they will behave. Otherwise, what will happen is one will continuously go up, other will continuously go down. You will not make any money. So you should know their behavior. So therefore, these two indicators these two measures are used. So how we define this? Sigma AB we can also write as AB, covariance, product of deviations. What is that? Product of. But remember these punch lines actually. Product of deviations. So there are two stocks. Deviation 1, RA minus RA bar. Deviation 2, RB minus RB bar. So product means multiply. Divided by N summation. Very simple formula. So when you remember, if you start by-hearting the formula without any sense, then this chapter is not your friend. But if you understand the formula like this and remember product of deviation is covariance, then this chapter is the best chapter to score. So RA minus RA bar into RB minus RB bar upon N is your, remember I am writing for historical data. If it is a predicted data, if it is historical, what we did, we divided by N. Predicted definition doesn't change. See, RAI minus RA bar, RBI minus RB bar. Instead of divided by N, I multiply by PI. That's all. So, for historical, we generally take a product divided by N because there will be different data. In predicted also we will have different data, but each will have its own probability. So multiply by the respective probability. And rho is given by, I hope you are writing and building the notebook because that is very important. Last day you will go through all this. Understand, I am writing everything and I am writing in such a short manner so that you are able to easily complete after your FR paper, entire book. Easily complete. So this will be sigma AB upon sigma A into sigma B. Covariance upon product of deviations. Now certain important things about covariance. Covariance. Number 1, can have values from minus infinity to plus infinity. Means you can get any answer, minus 1 lakh, minus 20, plus 44, 0, anything. Number 2, expressed as a number like variance. See, variance is what? Sigma square, sigma into sigma, is it not? What is covariance? Product of deviation. Again, it is a sigma square type. So covariance and variance always expressed as a number. Remember this, do not forget. Sorry. What about correlation? Can range from -1 to +1 only. So lowest value is -1, highest value is +1. So you can say minus is there, here also minus is there, plus is there, here also plus is there. But this is infinity. So infinity means unbounded value. 1 means bounded value. So therefore correlation as a boundary. 1 this -1 this side, minus +1 this side. And covariance has no boundary. So therefore it is better to have correlation information. We'll have some proper understanding. Okay, if correlation is -1, I can say the stocks are behaving exactly oppositely. So we write that if covariance or correlation is positive, means stocks behave similarly. If it is negative, then stocks behave oppositely. If it is 0, no predicted behavior. So no predicted behavior means can't say. Understand, in statistics there is one big rule. The result is as good as the data. What do you mean by that? Suppose I got A, or B. Remember, there is no place for price at all. Everywhere it is written. Suppose we have period 1, period 2. In period 1, RA gave 10%, RB gave -8%. In period 2, RA gave -5%, RB gave +12%. Now you can see the period, when RA increases, RB decreases, and vice versa. So your answer will be 0. Because one time this is going up, other is coming down, and vice versa. So answer will be, so it is not predictable, unpredicted. So we can say there is no correlation. But if it is like this, +10, +8, +15, +12. So you can say yes. If RA is positive, RB is also positive, though it is slightly to a lesser extent. So they are moving together. So with the data you have -12, so -10. So they are moving together. So when they move together, our correlation and covariance will be positive. If they are moving oppositely everywhere, suppose this is minus and this is plus, and like that we have 20 data, then you will get negative. Whenever they go up, this come down, like opposite behavior. Now with 2 data, 1 plus 1 minus, it depends on the data whether the answer will be coming close to 0 or showing negative. So it depends. Don't take just 2 data as a proper information. So what I'm trying to say is, the data, the result what we get depends on the data. So in statistics there is a rule that data is the result is as good as the data. So if your data is good and covers a large period, then your result will be more beneficial for your future action. If you take just little data and you get a skewed result or a poor result, then that will not give proper, that will not be useful to make proper decision. So now then there is a particular word. If rho AB is equal to plus 1, remember when I say rho AB, it is to be read like this: correlation between returns of stock A and returns of stock B. Remember, returns everywhere, no prices. So correlation between, when I say rho AB, it means correlation between returns of stock A and returns of stock B is plus 1. Then we call it as the two stocks are perfectly correlated. So the two stocks are perfectly correlated. Now if it is minus 1, then we write perfectly negatively correlated. So we write it as perfectly negatively correlated. So they may give an exam. The two stocks were perfectly correlated. So indirectly they are given rho is plus 1. Now one particular aspect which they tested in the recent exam is coefficient of determination. Now as a fund manager, when I was working, we used to report to SEBI something called R square. Now rho AB square, it is called R square. It is coefficient of determination. So always positive. Being a square, it is always positive. So instead of giving the value of rho AB, they wrote coefficient of determination is so and so. So when they give determination, then you should take square root. So we'll write here. Therefore, rho AB equal to, is very important. Square root of R square. So coefficient of determination, coefficient of correlation, covariance, they all depict the behavior between returns of two stocks. They are very useful in understanding how the stocks in the portfolio will behave once the actual market prices will move. Okay. Couple of things you must know about rho. The interpretation of rho is so important that if you understand rho, though it is not going to help you immensely in the exam, but knowing everything, knowing anything correctly is of vital importance. So what is rho? Now if you see, I can tell with an example. Rho AB is say plus 0.4. It means returns of stock A and returns of stock B, they move together because plus sign is there, so they move together 40% of the times. So rho AB equal to plus 0.4 tells that returns of stock A and returns of stock B move together 40% of the times. So the data reveals only this information. What is happening in the remaining 60% of the time, that is not answered. So row AB plus 0.4 means 40% of the time they move together, that's all. If row AB is, suppose if row AB is equal to minus 0.8, it means the returns of stock A and returns of stock B move in opposite direction 80% of the times. So it gives you information, okay, if I have these two stocks 80% of the time, my portfolio, one stock is going to eat away others' returns. So you know that. So that is the interpretation of row. Another point you must remember is about covariance. Now row AB is defined as product of deviation, so which we wrote sometime back, upon n summation. Suppose I replace this with A, means covariance of stock with respect to itself. Then what will happen? I will replace this with A because B is replaced with A. So this will become equal to summation of RA minus RA bar the whole square upon n, because both will be RA minus RA bar. This is nothing but your variance, because variance is sigma square. In sigma we have a square root. Remember, sigma we have a square root. So variance, there is no square root. So we can say that covariance of stock with itself. Now we write covariance. Actually, we should be telling in detail covariance of returns of stock with returns of itself, like that. But we generally, in normal language, we use this. So covariance of stock with itself is equal to variance. So so many things. This is important to know. This is important to know. Similarly, row AB. So we wrote row AB is equal to sigma AB upon sigma A sigma B. Therefore, what is row AA? Now instead of B, let me replace. So this will be sigma AA upon sigma A into sigma A. Now sigma A just now we wrote. It is sigma square A. And denominator also we have sigma square A. Cancel, equal to 1. So therefore, correlation of stock with itself is equal to +1. So this is also important. So row AA 1, row BB 1, row CC 1, like that. Okay. Another last important thing what you must know before we go to the next CAPM and beta. Now we write the risk of the portfolio and then go to CAPM beta. Now before we do that, we must know one more fact. Sigma A, what is the formula? RA minus RA bar the whole square upon n. Now this one is a square, so they're always positive. So therefore sigma A always positive, it cannot be negative. Why? It is calculated using squares. The square of a negative number is a positive number. Square of a positive number is a positive number. Therefore square can never be negative. Therefore sigma is always positive. When sigma is positive, sigma square A variance is also positive. Remember, so these are all very, very important things. Sigma cannot be negative. Okay. Now we move on to return and risk of portfolio. Had it been a regular course, entire thing I would have derived. But being a rapid revision course, we must write the formula. So let me first write return. Return of the portfolio is equal to how much you have invested in each and what is the return given by each. How much you have invested in each stock and what is the return given by each stock. Just multiply that proportion into return. So this is your proportion. This is individual stock returns. What about risk? Risk we have for 2 stocks and 3 stocks only. 2 stock portfolio risk. Remember, if I invest in 2 stocks, so I will be having WA, proportion invested in stock A, WB, or let us say W1, proportion of money invested in stock 1, W2, proportion of money invested in stock 2, sigma 1, risk of stock 1, sigma 2, risk of stock 2, rho 1, 2, correlation between stock 1 and 2. So if we know all this, we can calculate sigma p, risk of 2 stocks portfolio, is equal to W1 square sigma 1 square, W2 square sigma 2 square, plus 2 W1 W2 sigma 1 sigma 2 rho 1 2. Now since rho 1 2 equal to sigma 1 2 upon sigma 1 sigma 2, therefore sigma 1 2 equal to sigma 1 sigma 2 rho 1 2. Just cross multiply. This is by definition. So you can see that this is here. So I can replace. So I can have a formula W1 square sigma 1 square plus W2 square sigma 2 square plus 2 W1 W2 sigma 1 2. So this is the risk of portfolio. You can see P for portfolio. Of how many stocks? Only 2 stocks. So either you can write in terms of correlation or you can write in terms of covariance. So you must know each other, the relationship between each other. Now there are some special cases. If rho 1 2 equal to plus 1, mean this. So I am going to put this as plus 1. Then equation will be simplified. It will be W1 sigma 1 plus W2 sigma 2 the whole square root equal to W1 sigma 1 plus W2 sigma 2. So it will become A plus B the whole square type. So if rho is if rho 1 2 is plus 1 directly use this. So no need to put the lengthy formula and take a square root. Calculate directly this. Similarly, if rho 12 is equal to minus 1, we use sigma p equal to W1 sigma 1 minus W2 sigma 2. So again, you need not use the entire big formula and square root. This is extremely important, do not forget. Couple of times it has come in the exam, so you must know that you should be smart to use this formula directly. And remember, note so I will call it as equation A. In equation A, even if sigma p is a negative value, write as positive value. Now for some combination you will get negative value. Means suppose W1 sigma 1 is less than W2 sigma 2. Then this will give you a negative value. This will give negative value if W1 sigma 1 is less than W2 sigma 2. Then you are not supposed to write negative value. You should change the name of the stocks. Change the name of first stock as stock 2. Change the name of second stock as stock 1. Then automatically answer will become positive. So that's how it is. So never write sigma negative. See, we wrote sigma is always positive. We wrote here, correct? Sigma always positive. Extremely important. So never write the value of sigma as negative. So standard deviation is always positive. Next we come to risk of 3 stock portfolio. It is same format, W1 square sigma 1 square, W2 square sigma 2 square, W3 square sigma 3 square plus all the 5 elements will be there. See, remember in 3 stock portfolio we have combination 1 3 3 1, 1 2 2 1, 2 3 3 2. Okay, so when I derive I can write a lengthy thing, but this is beyond the scope because we have short time to learn. So we write W1 square sigma 1 square, W2 sigma 2 and plus 2 W1 W2 sigma 1 sigma 2 rho 1 2. So 2 W1 W3 sigma 1 sigma 3 rho 1 3 plus 2 W2 W3 sigma 2 sigma 3 rho 2 3 square root sigma 3. So what is the difference? Now this is for 3 stock. Now 2 stock. Let me take this formula so that you can see what is the difference here. Now why I am telling all these things? Because these are the things which will flash in the exam. See, if it is a 2 stock, you can see I am having this. This is a variance term. stock 1 variance. I am having this. It is a stock 2 variance. Then I am having 5 parameters: weight 1, weight 2, risk 1, risk 2, correlation 1, 2. So here also you have sigma 1 square, sigma 2 square, sigma 3 square. There are 3 stocks. So we have 3 variances. Now here we have just one combination, 1, 2. See, 1, 2. Here we have 1, 2 combination, 1, 3 combination, and 2, 3 combination. But we have all the 5 parameters: 1, 2, 3, 4, 5, 1, 2, 3, 4, 5, 1, 2, 3, 4, 5. So we have got total 3 combinations. So this is the difference between the portfolio risk of 2 stocks and 3 stocks. Again, I can write this as sigma 1, 2. I can write this as sigma 1, 3. I can write this as sigma 2, 3. So that is possible. Okay. Sometimes they will express these terms in matrix form. One, two, three. 1, 2, 3. This is called covariance matrix. Now covariance of 1 with 1, covariance of 1 with 2, covariance of 1 with 3, covariance of 2 with 1, covariance of 2, 2, covariance of 2 with 3, 3 with 1, 3 with 2, 3 with 3. Now we know very well covariance of stock with respect to itself is variance. Covariance of stock with respect to itself is variance, and here also variance. So the diagonal elements are variance terms. Secondly, this will be same. This will be same. This will be same. So they will give you in matrix form and tell you please calculate the risk of a portfolio. So we should pick. See, variance. Just see, I can get variance. So this I can get, 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 this I can get. So with W1, W2, W3 and variance matrix, covariance matrix, I can calculate everything. So variance, this also you have to remember. Now final thing in this is minimum risk portfolio. Suppose I know 2 stocks, 1, 2, and I know sigma 1, sigma 2 and rho 1, 2. or sigma 1 2. Then least risk portfolio will have weights W1 equal to sigma 2 square minus sigma 1 2 upon sigma 1 square plus sigma 2 square minus sigma 1 2, W2 equal to 1 minus W1. So very important formula. And one thing I want to tell you, they are having it in practice manual, material, everywhere, not a single time asked. Very, very important. So if you know two stocks 1 and 2, if you know their standard deviation, if you know their covariance or correlation, then I can calculate W1 and W2 like this. In a regular course, generally I derive this formula. When you differentiate the portfolio risk formula to stock portfolio risk formula with respect to W1, then we get this answer. Okay, so this completes the basic part. If I go to first page, so this part is over. Now we move on to this part. What is the equation for CAPM? Very popular equation you have learned in IPCC also. Return of stock. Now this is a theoretical return. As per theory, also called fair return, also called equilibrium return. Now these are all the words which institute uses. Is given by risk-free rate plus beta of stock. Remember, when I am writing stock here, I write here into RM minus RF. Now RM minus RF is called market risk premium. RS minus RF is called stock risk premium. So CAPM states that investing in stock S will get risk-free return plus risk premium. Now RM minus RF is called market risk premium. So beta into RM minus RF will be total premium which you will get. So this is a popular equation for CAPM. Now what is beta? Beta of stock is defined as rho SM sigma S upon sigma M. Remember, sigma is always positive. This is always positive. This can be negative or positive. Rho can range from -1 to +1. Therefore, beta S can be negative also. Because in one exam they gave the problem where beta was negative. Suddenly one would, if somebody doesn't know the concept, how beta can negative? because I have done 1000 problems, all problems beta was positive. Now this doubt should not come. See the concept. So beta can be negative. Okay. Now if I write this, so beta s equal to sigma sm upon sigma s sigma m into sigma s upon sigma m. This cancels, will give you sigma sm upon sigma square m. Another formula for beta. Very commonly asked, this both the formulas, this and this. Now if I have a portfolio of 20 stocks, what is the beta of the portfolio? Beta of the portfolio is summation of WA, proportion of stock in the portfolio, multiplied by beta of the portfolio. So beta of the portfolio is given like this. Now what is actually, what is beta? Now when we draw a graph of RS RM, and we have this line which is called characteristic line. Now the slope, so in 11th standard or 10th standard we would have studied slope of a line is y2 minus y1 upon x2 minus x1. Means y in the numerator, x in denominator. Change in y numerator. What is slope? Slope is change in y upon change in x. Now what is y? Y is your stock return. What is x? X is your market return. So this will be equal to, I will write delta S percentage upon delta M percentage. That is rate of change of stock with respect to rate of change of market. This is nothing but beta. So we got another formula for beta. So we wrote three formula here, right? You can see here. Formula number 1. Formula number 2. So you can see here 1, 2, 3. So we got three formula. Now what is the equation of line? General equation of line. Equation of line, again you have learned in 11th standard, y equal to mx plus c, where m is the slope. So we can write, therefore, what is y? This is y axis. What is x? X is Rm. What is c? C is this intercept. Y intercept is your c. And this is called alpha. Okay. So we can write y equation of characteristic line is equal to y equal to mx plus c, and y axis is rs, m slope is beta s, x axis rm plus alpha s. So this is the equation of characteristic line. So equation of characteristic line is this. Very popularly, asked very frequently in exam, and it's a popular question. Calculate beta, write the equation of characteristic line. So we do, first we calculate beta using the formula. So one of the two formulas can be used. Let us see how we calculate beta. Now, method 1 depends upon historical data or predicted data. There is slightly different formula. The way we have covariance, just see here, beta of a stock is equal to covariance of stock with market upon variance of market. If it is a historical data, then it is summation of RS minus RS bar, RM minus RM bar upon N divided by summation of Rm minus Rm bar the whole square upon N. But if it is predicted data, summation of Pi into RSI minus RS bar, RMI minus RM bar divided by summation of Pi into RMI minus RM bar the whole square. So the difference between the probability and this method 1. Method 2, regression. Beta of the stock is equal to N summation of xy minus summation x summation y divided by N summation of x square minus summation x the whole square. Now what is x and y? You have to understand. See, when we draw a characteristic line, our x-axis is Rm, our y-axis is Rs. You are drawn here, you can see this. X-axis is Rm, y-axis is Rs. So we have the same thing, so we have to keep in mind. Therefore, our x is represented by Rm, y is represented by Rs. So if it is regression, then I will make this x column, y column, xy column, x square column. Then I take the summation. Now you can see this summation of x. So this will go here. Summation of y, summation of x will go here also. Summation of y will go here. Summation of xy will go here. And summation of x square will go here. You can see that regression is extremely fast. Whenever you are getting some odd number, decimal, minus sign, prefer regression method. So for odd means decimals, prefer regression. Minus sign, negative sign, prefer regression. Now suppose mean is coming negative, so deviation will be negative, subtracting negative will be a problem using this method. So when it is a proper positive numbers with positive mean, then you use method 1, otherwise prefer method 2. Okay, so it's better that you write this and learn properly and be prepared for both. Because this will consume time. Method 1 will consume time if the data is odd, having negative mean, etc. But method 2 will not consume time. So you have to just take total summation, total of x, total of y, total of xy. You can do in calculator extremely fast. The regression is reliable. Okay. Now, this is how we calculate beta. We already said that beta can be negative. Now we come to one concept that is called security market line. Security market line is the equation of CAPM. So when I say it is equation of CAPM, then it is RS equal to RF plus beta into RM minus RF. So when they ask write the equation of security market line, so you may have to calculate this. Suppose this is 8, suppose this is 5. Then we write, therefore equation of SML will be RS equal to 5 plus 8 beta. So this is what we do when we actually draw. These things will not be asked, but I'm just giving an idea. This is beta. This is your R. Okay, beta equal to 0. This will be RF. So the graph will be like this. So this is security market line. You can see 5. So therefore we have this RF. So any return is RF plus something. RF plus this. Okay, had it been a normal course, we could have talked at length, right? So security market line, just remember it's a equation of the, you have to remember this. It's nothing but the equation of CAPM. And we write in this format. So we have to find market risk premium, with whatever information given, we have to substitute risk-free rate and then write in this format. Okay, next. So have we written the formula for beta of the portfolio? Beta P is equal to summation of Wi beta I. This is beta of the portfolio. I think I have written, nevertheless, no problem. Writing again is not a sin. Okay. Now, a concept. Let us check Nifty. What is Nifty? Nifty is an index. This Nifty has got 50 stocks. 50 stocks are from diverse sectors of the economy. Steel sector, banking sector, pharma sector, IT sector. Now all the sectors are contributing to Nifty. So there are 50 stocks. So all the sectors form the entire market. Because in the market, which are all the sectors are there? Who is the leader of those sectors? They only will be Nifty. If Infosys is leader of IT, TCS is leader of IT, they are in Nifty. If Sun Pharma is leader of pharma or Division is leader of pharma, they are in Nifty. So every sector leader is in Nifty. So can we say that Nifty encompasses all the leaders of various sectors? So we can indirectly say that Nifty encompasses the entire market. Therefore, Nifty is used as a proxy for market. So if I want to find RM percentage, I can get from Nifty. I can get from Nifty. Therefore, Nifty is proxy for market because it has got all the leaders of all the sectors contributing to the GDP of the economy. Now, before we proceed more about Nifty, let us understand beta formula. Beta S equal to sigma Sm upon sigma square. Suppose I replace this with market, means I want to find what is beta of market. I want to find what is beta of market. So S I replace with M. So here also I will replace with M. Then what happens? It is covariance of market with market. That is nothing but variance. We have learned covariance of stock with respect to itself is variance divided by sigma square M. Cancel equal to 1. So beta of market is 1. Since beta of market is 1 and Nifty being a proxy of market, beta of Nifty is also 1. So this they have tested many times in the examination. They said, they gave information on Nifty and asked students about market. They give information about Nifty and they will ask questions on market. Nifty is market. So Nifty is a proxy for market since Nifty is an index, a consolidated index consisting of all the companies. Now beta of market is 1. So we have to write a punchline. Beta of market is equal to 1. Nifty being proxy for market as beta equal to 1. Very, very important. Now if a stock has beta of 1, now let us take a Capm formula. Consider Capm formula. Now whatever I am writing down one by one, you write down. See, when you write down, it doesn't take much time to study. You listen, write. Consider Capm formula. What is the formula? RS, expected return of a stock is equal to risk-free rate plus beta of stock RM minus RF. So this is the Capm formula. Now if RF equal to 5, RM equal to 12, beta of stock equal to 1, how much return stock will give? Let us see. Therefore ERS is equal to 5 plus 1 into 12 minus 5 equal to 12% equal to RM. So when beta is 1, stock is giving same return as market. So therefore when beta of stock is equal to 1, RS equal to RM. A very, very important principle. When beta is greater than 1, RS will be greater than RM. You can easily substitute and see. Suppose I substitute 1.2. Now 1.2 is greater than 1. So in this case I will get 784, 13.4. So I will get 13.4, which is greater than 12% RM. So we can easily verify this. Similarly, when beta is less than 1, RS less than RM. So beta is a very important criteria that will decide as whether you are going to earn return more than market or less than market. If you are invested in a stock whose beta is 1.5, then you are going to earn more than market. If you are invested in a stock whose beta is 0.8, then you are going to earn less than market. If your beta of a stock is exactly equal to 1, then you are going to earn as good as market. No, beta, what is, in some of the questions I have seen, questions that come like this: calculate risk with respect to market. It's nothing but beta. So when they give calculate risk with respect to market, see what is beta formula? Beta is equal to sigma sm upon sigma square m. So are you not finding the covariance of stock with respect to market? So you are finding covariance of stock with respect to market. So beta is actually risk with respect to market. Now another concept, what is the difference between beta and sigma? Now beta represents what kind of risk? Now let us now understand this very clearly. Sigma means total risk. That is our standard deviation. Now understand this. Suppose I am having 1 crore rupees. I invest in Reliance. Entire money Reliance. Some negative news comes, Reliance price falls. I wonder why I should invest entire Reliance. Let me put 50% in Infosys, 50% in Reliance. Now some bad news comes in Infosys. So Infosys falls, but Reliance doesn't fall. And I said, why to actually put 50% large money Infosys? Let us make 1/3. Reliance, Infosys, Sun Pharma. Then bad news comes in Sun Pharma. My portfolio value falls. Then I divide further. Fourth, I am taking the fourth stock. Okay, Tata Steel. So now what is happening? Bad news comes in Tata Steel. When bad news comes in Tata Steel, only Tata Steel is affected. Neither Reliance, nor Sun Pharma, nor Infosys. Then what I am trying to tell you, that any event specific to that stock affects only that stock. It doesn't affect other stocks. So these, whenever any event strikes a particular stock, assume that mean return of Reliance is, say, RS bar equal to 10%, and some negative news comes in a stock. As a result, the stock return falls to 7%. So 7% minus 10% is minus 3%. So there is a deviation created. So an event has happened, stock return has fallen, and the deviation has been created with respect to mean. So we are finding this deviation is caused by an event which is affecting only Reliance, not the other stocks. So this risk, which is contributed by the deviation, which is contributed by the event happening only in Reliance, is called unsystematic risk. So unsystematic risk is also called unique risk. It is also called stock specific risk. It is also called diversifiable risk. Means I can eliminate it by spreading my money across many stocks. If I spread my money across, say, 25 stocks, and one bad news happens in Reliance, in the 25th stock, Some good news might take the share value up. So if you have sufficiently distributed your money across 25-30 stocks, means you are said to have diversified. Therefore, this risk can be eliminated by diversification, by spreading your money. Therefore, this risk has got a name, diversifiable risk. You can eliminate it by diversification. It is also called residual risk. Now, in one of the exam institute asked, calculate residual risk. The residual risk is this risk. So, unsystematic risk, unique risk, stock specific risk, diversifiable risk, residual risk. Now assume that I created a portfolio of 30 stocks, and one event in any company in my portfolio is not affecting the portfolio at all. But when finance minister increased the corporate tax rate, all the stocks fell. I tried to diversify, then also nothing, everything fell. So this risk, which is affecting all the stock without any bias, is called systematic risk. And in CAPM, beta measures systematic risk. Why so? William Sharpe gave capital asset pricing model. He said, if there is a single event happening and your stock is getting affected, then you can diversify it away or eliminate it by spreading your money across many stocks. So that single event should not affect your portfolio because you can always eliminate it. But this other event, which is called macro event, like increase in decrease in GDP, increase in inflation, increase in interest rate, increase in tax rate, all those macro factors which will affect all the companies in the portfolio without any bias, that risk cannot be eliminated. Therefore, if you are assuming that systematic risk, you will get reward, and that reward is only this one: RS equal to RF plus reward. Please understand, if you invest in Reserve Bank of India, we get RF. Reserve Bank of India pays me RF. There I am not taking any risk because Reserve Bank of India is government's bank. I give money, it gives RF. RF is what? RF is the compensation for time value of money. Reserve Bank is paying me because it is compensating for the time. I gave money for to the Reserve Bank for 3 months. RBI is paying me for using the funds for 3 months. So when I am investing in a stock, I must get something extra apart from risk-free rate, and that is reward. And that reward is given by beta into RM minus RF. So this is the reward. William Sharpe says you will get reward only for systematic risk, which is contributed by, which is known as beta. So beta is a measure of systematic risk. So an investor will say, I have invested in only one stock. Sorry, you will have unsystematic risk, you will have systematic risk both. For the unsystematic portion, no reward. For the systematic portion, you will get reward as per Capm formula. Another investor comes, I have invested in 50 stocks across various sectors. Good. You are carrying only systematic risk because you have eliminated all unsystematic risk by spreading your money. So systematic risk is always going to be there, whether you diversify or not. But unsystematic risk will be there only if you are not diversifying. So our sigma total risk has unsystematic risk USR and systematic risk SR. So sigma has two branches, systematic and systematic. Unsystematic can be eliminated. Systematic, you will get reward as per CAPM. Okay, this concept I have done deeply because you have to understand the question. Till now, very intelligent questions which will test students has not come, don't worry. Okay. Now, alpha of a stock or portfolio. Now, what is alpha of a stock or portfolio? Suppose stock gives return equal to RS or portfolio gives return equal to RP. CAPM says, according to CAPM, stock should give ERS. According to CAPM, portfolio should give ERP. So according to CAPM, according to its beta, we know how to calculate beta. Suppose you calculate beta using stock returns and market returns, because in beta we have this formula, sigma SM upon sigma square M. So you can see stock returns and market returns. So suppose you calculate beta and you calculate ERS and to compare with RS. If RS greater than ERS means what? The actual return of the stock is greater than the theoretical return required by CAPM. Then alpha equal to RS minus ERS greater than 0. So alpha is actual return minus CAPM return. Okay. If RS is less than ERS, if RS is less, alpha will be less than 0. So in market, we are supposed to invest in a stock whose alpha is positive. Alpha positive means what? The stock is giving better return than CAPM. What is CAPM? It is a theoretical return. Theoretically, I know it must so much return should be given. Okay. Next. So this alpha. There are problems covering whatever you are speaking. Almost every concept you will have problems where I will explain again. But this is for your writing so that you know sometimes you will find it difficult to write from a problem. So therefore I'm just revising. Now let us find out the price of theoretical price of a stock. So we can see that P0 assume perpetual model, assume dividend discount model, perpetual. So what is the formula? P0 equal to D1 upon K minus G. So this is the formula. P0 equal to D1 upon K minus G. Now this K is expected rate of return. So this is given by CAPM. K equal to expected rate of return is equal to risk-free rate plus beta S into RM minus RM. So you can see that CAPM helps us to find K, which ultimately helps us to find B0. So whenever they ask price of a stock and they have written perpetual model, then we have to find K first if it is not given. How to find K? K you can find using Capm formula, as you can see in red written. And once you find K, substitute in dividend discount model formula and get the fair value or theoretical value of a share, right? Okay, so this completes our second part, this one. Now we come to sharp single index model. Remember, there are only 3 formulae to be learned. Only 3 formula. Number 1, portfolio risk. Risk of a stock. Number 2, covariance between 2 stocks. Number 3, risk of a portfolio. Only 3 formula. Now how to find risk of a stock? Risk of a stock, sigma square P is equal to, remember here we have variance. Advantage of variance over standard deviation is I can add and subtract variances, but I cannot add and subtract standard deviation. So here we are going to have risk of a stock, sigma square P is equal to beta square P sigma square M plus sigma square EP. Sorry, I'll use S, the stock, correct? S. So this formula you must remember. Now in regular course usually I derive this also. Now this is total risk. This is systematic risk. This is unsystematic risk. So sigma square S equal to beta square S sigma square M, that is your systematic risk component, plus sigma square ES, that will be unsystematic component. Next is covariance between 2 stocks, sigma AB equal to beta A beta B sigma square M. So sigma AB, covariance between 2 stocks is nothing but the product of betas multiplied by the variance of market. And third is risk of portfolio. Sigma square P is equal to beta square P sigma square M plus sigma square EP. See, I have not changed anything. If you see, only the variables have changed. You can see S, I have written here P, S, P, S, P. This is systematic risk. This is unsystematic. This is total risk. So these three formula you must remember because it's extremely important. Formula number 1, formula number 2, formula number 3. Here we have two information. Beta P is equal to summation of Wi beta I. So this is a bit of portfolio formula. Then sigma square EP is equal to W1 square sigma E1 square sigma E2 square so this also you should remember. Okay, hope you are getting it now. Next we come to arbitrage pricing theory. APT, is a very important problem. Earlier they never used to ask, but now institute has started asking regularly. It's fairly simple, but a complex problem can also be created very easily. If you don't understand the concept, then the entire problem looks very, very difficult to solve. Now suppose I write like this: Capm formula ERS is equal to RF plus beta S into RM minus RF. Now we can see that we have only one factor, market. Now if I want to bifurcate into many factors, then it becomes what is called as a multi-factor model. Now we don't write, how we measure beta. We measure beta like this: beta S equal to sigma Sm upon sigma square m. So we are measuring beta of a stock with respect to market. So we are supposed to write actually beta Sm. We are supposed to write, but we don't write. Yes, beta means it is measured with respect to market. So beta, it is obvious that the second we are measuring the beta of stock, that is covariance of stock with respect to market. So it is done, means it is obvious that it is measured with respect to market. So therefore we don't write this. But if I bifurcate this factor market, now in market, let us talk about macro factors. Suppose we talk about macro factors. Or macroeconomic factors: interest rate, inflation rate, GDP, index of industrial production. So whenever I have created a diversified portfolio and the factors, or I'll say events happening in the company, in any one company, will not affect my portfolio, I have eliminated one risk, that is unsystematic risk. But when something happens in the market, we can take even the tax rate, like change in the tax rate, change in the interest rate, change in inflation rate, change in GDP, change in index of industrial production. Suppose any of these changes happen, it affects all the stocks in the market. It affects every stock. Then how to identify which particular factor is causing what change? The entire market. We measure entire market, that's all. We measure, with respect to market. But in this market, which factor has created change? We don't know. We don't know the bifurcation. APT provides that bifurcation, or it uses multi-factor model. So what we are going to do in APT, we write the formula like this: ERS is equal to RF plus. Now, there, generally if you see textbooks, they use another Greek letter, lambda. It's written like this. I am just using the same beta so that you can understand it. And I write, so we write beta 1. Let me write down this. Into RP1, beta 2 into RP2, etc. What is 1? 1 is factor 1. 2 is factor 2. Factor 1 could be interest rate. Factor 2 could be inflation rate, like that. RP1 is risk premium arising due to factor 1, like that. RP2 is risk premium arising due to factor 2. So here what was this in CAPM? It was risk premium of market. We used to call market risk premium. So here it is risk premium of factor 1, factor 2, like that. I am measuring the return of a stock. So I'll write here S. So whatever comes here will come here. So now you can see beta has got two things. One is factor, other is stock. So now beta in APT we have multi-factor model. We have two prefix, you can say, or two subscript. So this is the general formula for APT. Now, whenever we calculate beta of a portfolio, we write like this: W1 beta 1, W2 beta 2, W3 beta 3. But if we have to, this is a general formula we write, etc. Don't write this. Beta of a portfolio we write this. Suppose beta of stock A. Suppose I write beta of stock. 1 minute. Let me give you example. You will understand because it's very, very important. So I am writing consider, and please mark this, extremely important. So what we are going to write is this. This is also very important. And this one you can refer one problem solved. Refer problem solved. So you'll understand this totally clearly. Now this one, what I'm going to write, is very, very important. Just see. Suppose I have portfolio A, B, C portfolio. Consider portfolio with stocks A, B, C and D. How we write beta of the portfolio? Beta of portfolio will be WA beta A, WB beta B, WC beta C, WD beta D. This is how we write the beta of the portfolio. Now, if we have two factors, Remember, we are talking about multi-factor model. In APT, we have two factors. Factor number one, interest rate. Factor number two, inflation rate. Suppose I have two factors. Then what we'll have is, we will have two beta of the portfolio equations. One for factor 1, other for factor 2. So in CAPM we had only one CAPM, and in APT we have two factors, therefore two betas. Very, very important. I wrote CAPM also so that you understand. In CAPM we used to write beta P equal to WA beta A, WB beta B, etc. Here also you same formula, but you have to calculate two times. One using factor 1 data, second using factor 2 data. Just listen to this particular thing again, you will understand. So the entire APT, first one is solved in a problem nicely. If you go through it, you will understand. And this also you will easily. And nowadays they are asking, therefore it is very important, therefore I mark quite important. Then we have in this chapter, in this big chapter, what is called as asset beta, or we can say project beta. So beta of asset. Now if you take a balance sheet, so these are assets, these are liabilities. In liabilities we have equity, we have debt, and this is entire thing is asset. So beta of A will be equal to the how much equity you have upon total into beta of equity plus how much debt you have on total into beta of debt. Very clear. Okay. So asset, what proportion of equity is out of total? That is this. What proportion of debt is out of total? That is this. The proportion of equity. So this also you will see one problem solved, which was asked in the world syllabus, and this will help you know what kind of problems come in the exam. Usually this also mark important. Usually beta of debt is equal to 0. That is, we can assume if no other info is given. In old exam, that is in old syllabus exam many years ago, they did not give beta of debt. In many examinations, they don't give beta of debt. You should not wonder why they are not giving. You should just simply assume beta of debt equal to 0. Why beta of debt is equal to 0? Beta means covariance of change in debt value with respect to total value. Now debt, when you borrow certain amount, there is an obligation that you have to pay this much. So therefore there is no deviation, that doesn't change. Therefore, at this level, in rapid revision course, just remember the debt obligation which is supposed to be paid doesn't change once you have borrowed and the fixed amount, whereas the equity holdings keep changing with the share price in the market. So therefore beta of debt is considered as 0. Think this way, that's all. So this is asset beta formula. So we can see the problem which is solved, that can give you further insight. Now remember, in this chapter summary I am writing all the important formulae and I am telling you what are the things you should keep in mind. Then in the formula video you will see again revision of the formulae, exact only formulae. Then in the problem both will be covered, so it will be total preparation for you. Then project beta. Now whenever I have a company whose beta is to be found out. Suppose there is an aluminum company, I want to find its beta. Now how to find aluminum company's beta? No problem, go to stock market, find 3 aluminum companies which are trading in the market. Use their prices, use Nifty price, using stock prices of those 3 companies and using Nifty prices, calculate beta of the 3 companies. So when you calculate beta of the 3 companies which are listed in the market, you find the average beta. And once you find the average beta, assuming, as of now assuming that they all pay same tax and they have same debt equity ratio, which you can get from the exchange information from their financials, how much debt they carry and what is the tax they pay. So from that beta, this is the average beta of peer companies. Peer companies means similar companies operating in the market. Remember, I want to find a beta of an aluminum company. I don't know. So what I did, I go to stock market. I go to stock market and found 3 companies A, B and C. So I took A stock price, I took Nifty stock price, calculated beta of A. I took B stock price, took Nifty stock price, calculated beta of B. I took C stock price, Nifty stock price, calculated beta of C. Then I took average, beta A plus beta B plus beta C divided by 3. I got average beta. Assume that all the 3 companies were paying same tax rate. Because they are the same industry, we can easily assume that. Assume that all the 3 companies have same debt equity ratio. So this average beta of peer companies I write here 1 plus 1 minus tax rate what they are paying, debt equity ratio what they are having. So this is debt equity ratio of peer companies, the tax rate of peer companies. And if I do this, I get beta unlevered. This is unlevered. Unlevered means no leverage. This is levered. Now what is the use? Now I am going to find. Now just see. Now if same formula, I will cross multiply now. So using beta UL calculated above, I calculate beta L. Now this is of my company. Now I want to find out the beta of my company. So what I will do, I will take this beta UL multiplied by 1 plus 1 minus T. Now tax rate of my company, debt equity ratio of my company. Now you can see this. What I did, went to stock market, picked 3 companies, removed data, removed debt equity of them, removed tax of them. I got pure beta. Therefore this approach is called pure beta approach or pure play approach. So got pure beta. On pure beta I applied my tax rate. I applied my tax rate. I applied my debt equity ratio. On this pure beta I got levered beta. Levered beta of my company. Have they asked this? They have never asked, say in the last 20 years. But still, I'm just very simple. Just see how simple it is. So what they will give? They will give peer company. They will give peer company's debt equity ratio. They will give peer company's tax rate. So use and first find this. Then apply. Using this, you apply your tax, your debt equity ratio, and find this. This is what they will ask you. That's all. Simple question. Okay. Then we have two more things left in this chapter. Next we come to asset allocation. So we got three approaches. Now asset allocation means how I am going to allocate my equity and debt, which I am managing. Suppose I am having equity. Suppose I am having bond. Investor is coming and giving me money. Take this money. Please manage my assets. Please allocate my capital. Then I will take, look, I am going to adopt buy and hold policy. Now buy and hold means just buy equity, whatever you want to buy, say 70% and debt 30%. So 70-30 you invest, and when the market changes, goes up or down, you don't do anything, you hold for a long time. So number one, allocate to debt, equity. Number two, with changes in market, do not rebalance the portfolio. Buy and hold. How they will give an exam? They may give this person is doing this, so you will actually allocate. They will give Nifty changes up, Nifty goes down. Don't do anything. Just apply the value for equity and debt and calculate. No rebalancing. Do not rebalance. Next is constant mix. So sometimes they write proportion. Constant mix. So here allocate as per mix of debt and equity. Rebalance after every 3 months. Now, for example, 3 months or whatever value they will give. So I invest 1000 rupees, 700 in equity, 300 in debt. 3 months pass. Debt will not change. They generally will not give debt as change. So 300 will remain 300. But equity has increased by 100 rupees. So now it has become 800. 700 to 800. Now 800 is to 300. That is not 70-30 mix. 70-30 means 70% equity, 30% debt. Now after 3 months, it has become, initially I did 1000 I divided into 700 and 300. So it is 70-30. After 3 months, equity has risen from 700 to 800. Debt has remained there only. So 800 plus 300, 1100. Now 800 by 1100 is not 70%. So you have to rebalance. You have to sell some equity. When you sell some equity, you will invest in debt. So rebalancing has taken place. You can see a problem which is solved. That will help you to understand this. So rebalancing means restoring the original mix of 70-30. Because as market change, equity will keep on changing. You have to rebalance. Last is constant proportion portfolio insurance. CPPA. So here a floor is set below which portfolio value should not fall. So first, total value minus floor is first found out. This is called as cushion. Now this word you will not find in material study, but this is a word we use. So you find cushion, floor, total value of the money. Suppose investor has given me 1000 rupees and he has told, remember 800 should be floor. Your activity, you do anything, portfolio value should never fall below 800, means 800 becomes our floor. So first you subtract 800, so you have got a cushion of 200. Then there will be something called multiplier. So multiplier is say 2. So 1000 minus 800, 200 into 2, 400. So 400 you put in equity. So this is equity. Balance debt. So what do you do? How you invest in this form? Total investors money minus floor, cushion, into multiplier, put in equity. Remaining money, put in debt. That's all. Market will change. When market changes, this total value will change. Initially it was 1000. So after change in market, it will become 1200. Again you do 1200 minus same 800. Floor will remain constant throughout. Constant throughout. In absolute terms. Absolute means once you calculate 800, it will be 800 throughout the problem. Market may swing up, down. The total value will keep on changing up, down. But this floor which you have used initially will not change. So total value, so once it changes, again you do this activity. Perform 1. When you perform 1, you will know the value of equity would have changed. Now this particular thing, this is equity, this will change. Why? Because this has changed. So when you perform 1, the amount to be put in equity would have changed. And do rebalancing. And do rebalancing. So you can see that in this method, we are doing rebalancing. Here we are doing rebalancing. Here we are not doing rebalancing. So I covered the theory aspect also. So we have a problem, go through the problem where I have solved these two. So you'll understand. Just do the problem, it is enough. So this is asset allocation. Last we have EMA. Exponential moving average. Now what is moving average? Moving average, suppose I have a 5-day average, 10-day average, 20-day average. Okay. So if I find 20-day average and I plot a graph like this is days, this is price. Suppose there is a, let us take a stock like Tata Steel. So Tata Steel stock price of 20 days I take. So 20 days stock prices average. Suppose it plots here. Okay, this one particular day. Go to next day. When you go to next day, remove the first data and take a new data. So therefore, now we can see I have removed the, but I take 20 days anytime. 20 days average I have to take. But when I go as day passes, I remove the first data and insert a last data. So I keep on taking 20-day average price. So therefore the average keeps on moving. So when the average keeps on moving, so we get a line like this. This is called moving average line. Now the stock, the actual stock price will maybe like this. So you can see that this is a price line. Now you can see this point. This point is a point where the price line cuts the moving average line from above. You can see it is cutting from above. So this is a sell signal. And this point, it is cutting the moving average line from below. It is a buy signal. Remember, price line should cut the moving average line from above. For sell, price line should cut moving average from below. That is a buy. In the exam, in real world, moving average is difficult to calculate. Suppose I want 200-day moving average for 10 years, but I have only 5-year data. I have only 5-year data. I want to draw for 10 years. It becomes very difficult. So we are coming out with exponential moving average. So the formula is, so you have to remember the formula. Exponential moving average of today is equal to today's price into exponent plus previous days EMA into 1 minus exponent. Now let us understand each. Today's price, that will be given to you. What is the price? For every day you have to calculate. So they may give 1, 2, 3, 4, so up to 14 days they will give. So this will be day and price will be given. Now here these are holidays. When I am writing dash, it is a holiday. It is Saturday. It is Sunday. So there will be no price for holiday, Saturday, Sunday. So for those days there will be no EMA calculations. But for this day there will be EMA calculation. So EMA, now we will calculate EMA. So for this day, EMA will be calculated like this. So EMA today will be equal to today's price. So I will take this today's price into exponent. Now what is exponent? 30-day EMA means exponent equal to 2 upon 30 plus 1. 50-day EMA means exponent equal to 2 upon 50 plus 1. But you need not worry, this will be given in the exam. Suppose they don't give, I have given a formula. So 20-day exponent means 2 upon 20 plus 1. So they will give. He is using a 50-day EMA, 30-day EMA like that. So exponent is given. Previous day's EMA. Now I will be calculating every day. Now for first data, simple moving average will be given. So this is the first data, is it not? The first day. For this data, simple moving average will be given. Okay. I'll just write without trespassing this into 1 minus exponent. This is a very, very important formula. And you have to simply calculate. So you will have a price data. You will have a EMA data. Remember. So you have to see this particular thing what I said. You have to see where the price data is overtaking EMA. If it is overtaking, it is a buy signal. If it is going below, it is a sell signal. So extremely important. It has come 3-4 times. Now, a very, very simple thing. I'm just revising once again. You will be provided the day, you will be provided the price, you will be provided this for the first data, simple moving average. You will have to simply use this formula and calculate EMA. EMA will be calculated only for days where there are prices. Holiday, trading day, you will not calculate. Once you calculate EMA, you will have 2 columns, price column, EMA column. See the column where price is overtaking EMA. Means at a particular trend, price will be below EMA. Suddenly it will become more than EMA. So you can see it has become now price line has increased here. You can see price is overtaking EMA. So there you write on this day it gave a buy signal. Now till now they have given only buy signal in the exam. Next exam they may give sell signal. So see on which day initially price may be continuously above EMA. One day it will go below. If it goes below, sell signal, right like that. Okay. So we have covered everything in portfolio except sharp portfolio optimization. So that we cover, and then this chapter will be over. Let us see the last part of portfolio chapter, the one which is least likely to be asked. It is very much in the syllabus. It is appearing in your syllabus for many years. Not a single question has been asked. If I am right, it was asked in old syllabus before November 2008. We are not sure. In fact, I am not sure whether they will ask. It will consume a lot of time in the exam. But if we take November 2020 as a benchmark, where every question consumed at least 20 to 25% more time than required, because they were all different, reverse calculation questions, they can include this also. Now, what is this model? This model is about investing in right combination of stocks which carries least unsystematic risk, least systematic risk, and if it carries high systematic risk, you get reward. So the model filters out bad stocks automatically, and we are getting finally the right stocks for our portfolio. What is the first step? Now you will be given some 6 stocks or 10 stocks, whatever it is. You will have to calculate RA minus RF upon beta. So when you calculate RA minus RF, that is stock return minus risk-free return upon beta, you will get different values. The highest value rank 1 and the lowest value will be given the last rank. So what you should do, after you calculate, you will have to rearrange the table as per rank, because when you calculate, rank 1 could be the 6th stock or 6th row stock. So in the next table, 6th row stock which has rank 1 should be appearing in the first row. So rearrange the table based on ranks with highest rank at the top. Once you do that, your next objective is to calculate C. Now see You cannot calculate at one stroke. First you calculate RA minus RM. Then you calculate beta I upon sigma square EI. Then multiply them. And then take cumulative. Summation means cumulative. So you take cumulative. So as you progress down the table, you will be taking cumulative. And finally multiply by sigma square M. That is variance of market, which will be given. So that takes care of numerator. Similarly do for denominator. Remember, numerator has beta upon sigma square EI. Now sigma square EI is unsystematic risk, which will be given. Denominator is having beta square upon sigma square EI. So they are not same. So you have to remember that. And multiplying with market variance and adding 1 will give a denominator. Then you get C star, C, value of C. So our last row will have C. The value of C will actually increase and then decrease. So the peak value will be your C star. So you can see, identify C star, the highest CI. Select all stocks that lie above C star in the table. Reject the remaining which are below C star. So we may get 1, 2, 3, 4, 3, 2. So highest value is this. So this is your C star. So select this, and this. Reject this and this. Then once we have identified this, we must know what proportion of investment should be in each stock. So that proportion W is calculated as ZI upon summation ZI. Now what is ZI? ZI is beta upon sigma square EI, which you have already calculated here. Then RA minus RF beta upon beta, which you have calculated here. And C star. Everything is there. So ZI is there. Then you calculate proportion. There is ZI upon WZI. There is summation ZI. So that will get you what proportion you must invest in each stock. If you are extremely confident about the formula, remembering the formula, executing well, okay, in any situation, then only attempt the problem. If you are time consuming and any miscalculation or wrong writing of this complex formula can be dangerous. Okay, hope you understood this. With this, we have completed the chapter of portfolio management. Let us now see all the formulae in this chapter of portfolio management. This is one chapter where the number of formulas are very large in number. Students generally by heart the formulae. That is a wrong approach to solving problems in portfolio management. We have to understand the concept. So as I run through the formula, I will try to touch upon the concept wherever required. The most important thing is you must know whether the given data is historical data or not. Now this will decide which formula you will use. One, we have historical data, means data available from the past. Other is forecasted data or expected return of future. So that is data predicted to happen in future. So both are different. One is past, other is future, and we are calculating in the present. So if we have to find mean, we simply divide the total number of returns upon n. Here you have to be very careful that we are going to talk about only returns, not prices. So whenever prices are given, you have to first calculate return. You should not be taking mean of prices. Remember, I repeat, in this entire chapter of portfolio management, returns are significant. So we study standard deviation of returns, correlation of returns, covariance of returns. we take beta of returns, all returns only, no prices. So if prices are given, convert to returns and then calculate mean, etc. Now risk of a stock, other name is standard deviation. We find the deviation of returns, we find the mean of returns, then we find the deviation, then we square, divide by n and take a square root. So this is standard deviation. So by taking square, we are actually standardizing. We are making negative values and positive values look alike. I repeat, we have returns, we first take mean. After we take mean, we subtract this mean from each of the returns. So that is RA minus RA bar. So we get RA minus RA bar. That is this part. So this is the deviation. And now we are squaring, is it not? But squaring is standardizing. So I am squaring the returns. But when I square, the negative deviation will become positive. And positive will always be positive. So we have standardized everything to positive. And then we divide by the number of returns and we take a square root, we get standard deviation. Now standard deviation cannot be added or subtracted. Therefore we have variance. Now when you square the standard deviation, we get variance. Now variance can be added or subtracted. Next we come to covariance. Now the word co means between two. So we'll have only two at a time. So deviation of one stock, deviation of another stock. So product of deviation is covariance. So we write in symbol form sigma 1 2. And we have to take the product of co means 2. So variance between two deviations, like that. So we can see deviation of stock 1, deviation of stock 2 divided by n. Now covariance doesn't have a limit. It can extend from minus infinity to plus infinity. But if I want to have a very clear idea to what extent the stocks are behaving, then I need a boundary. Now that boundary is given by correlation coefficient. So this is your correlation coefficient. This formula is very important. Now we write correlation as rho 1 2. Rho 1 2 is equal to covariance upon product of deviations. Now sometime in the exam they will give covariance, you have to find correlation. Sometimes they will give you correlation, you have to find covariance. So it's a very, very important formula which comes in most exams. Now after having seen historical data, we now see what difference in the formula if it is a forecasted data. Now if it is a forecasted data, what are the differences we have? Now expected return. So you can see that in historical we divided the total returns by m. Here we multiply by the probability and the respective returns. So we have three situations: bear, normal, bull. So in bear, stock will give so and so percentage, but it has some probability. In normal, it will give some return, but it will have some other probability. So multiply by probability, multiply the probability with the respective returns. So this is your RA bar. So we can say this is similar to our RA bar, and that is what we put here. So we have RA minus RA bar and multiply by the respective probability, and we take the total of it and then take the square root. We get standard deviation. Now covariance is defined as product of returns. You can see product of this deviation. Sorry, I repeat, covariance is defined as product of deviations. So deviation of stock 1 return and deviation of stock 2 returns. So when you multiply, we get covariance, but every data will have its own probability. So therefore we multiply with the respective probability. So we have this formula. Correlation is defined in the same way. There is no change. So covariance by definition is correlation is defined by the same way. Correlation by definition is covariance upon product of deviations. Now these are the basic formula or formulae we can say relating to return, risk, covariance and correlation between two stocks of historical data and forecasted data. In historical data, they will not give you probabilities, etc. because it is past, already it has happened. So it is certain, already done. So we have no probability. But forecasted data, it is going to happen. So therefore, there is a requirement to give what are the chances it will happen. So there is a requirement to give probability. Okay. Now, if at all you want to form a two-stock portfolio, then let us see the following formula. First, how to find the return of the portfolio. We find the return simply what is the proportion you are investing. So Xi is the proportion of investment. Now we must have written the class Wi. So Wi is also okay. So just a proportion multiplied by the return. This is the return of the portfolio. Now risk of two stock portfolio. Now this formula has been given by Markowitz. So in the exam they ask calculate risk using Markowitz formula. So this is the formula. So this formula will give you stock two stock portfolio risk W1 square sigma 1 square plus W2 square sigma 2 square plus 2 W1 W2 sigma 1 sigma 2 rho 1 2, and we know that this is nothing but sigma 1 2. So we can as well write sigma 1 2 in place of this. I'll come to this formula after I go through the remaining part. We'll come back to this. Now this is Markowitz formula for two stocks. You can see two stock portfolio. Now if it is a three stock portfolio, so we have three stock portfolio, so there will be three variance terms. So W1 square sigma 1 square plus W2 square sigma 2 square, W3 square sigma 3 square. Then combination of 1 2, 1 3, 2 3. And see 1 2, W1 W2 sigma 1 sigma 2 rho 1 2. Then 1 3, W1 W3 sigma 1 sigma 3 rho 1 3. Then 2 3, W2 W3 sigma 2 sigma 3 rho 2 3. So this is also Markowitz formula only, and this has been asked many times. Now if the stocks are perfectly correlated, remember it is two stocks. So in the two stock portfolio, if it is perfectly correlated, so this will be 1. If this is 1, then this entire thing will become a plus b the whole square, and when you take a square root, it will be of the form a plus b. So we have sigma p is equal to W1 sigma 1 plus W2 sigma 2, and if they are perfectly negatively correlated, then we have this. There is no need to write that big formula substitute. You have a license to use this formula straight away. So whenever they are giving perfectly correlated, you can write, we know that sigma p is given by this. Now when two stock portfolio is created and I want to find that portion, I want to find that proportion of W1 and W2 which will carry least risk. When this will happen? Suppose you are deciding that you want to invest in 2 stock portfolio. So you go to a broker. Broker is giving you 2 stocks. And from that you are able to calculate sigma of both the stocks. And you are able to calculate covariance or correlation. So when the broker is recommending you 2 stocks, so you will have their prices. From prices you will calculate returns, and from returns you will calculate sigma, and you will also calculate sigma 1 to covariance. Then using this formula you can calculate W1 and W2, and this portfolio will carry the least risk. You cannot create a low risk portfolio than this combination. This has never been asked in the exam, but regularly it is appearing in the material, so you should be aware about this formula. Next we come to beta of the stock. Now beta is defined as covariance of stock with respect to market upon variance of market. Now we can also write this way, where sigma sm is rho sm upon sigma sm. So both this formula are very important. Formula number 1, formula number 2. You must know and remember that beta can be calculated either by using this or by using this. An institute has regularly asked calculation of beta by one of these. So you should be aware that this relationship helps you to give you 2 formula for beta. Now what is covariance? Now this is explained here. Covariance is product of deviations. We have seen that, divided by n. And what is variance? Variance is square of standard deviation. You have taken square, there is no square root. Now we can calculate beta by regression, and this is a formula. Remember, when we plot a graph, we plot stock returns on y-axis and market returns on x-axis. So x will be RM and y will be RS. So this y refers to RS and x refers to RM. Whenever they give you returns in decimal or even negative numbers, prefer to use this formula. Do not use this formula. Why? Negatives and decimals are dangerous. In the examination you are likely to do some silly mistakes, but in regression the task becomes very easy. Suppose you are given return 2.2, 2.3 and all. So here when you take mean, so you will have decimal, and then deviation becomes a horrible task. So prefer regression method when returns are in decimals and negative numbers also. Now portfolio beta, just proportion multiplied by the respective beta. The famous Capm formula is given by expected return of a stock is equal to risk-free rate plus beta into RM minus RM. Now alpha is something which institute has asked couple of times. So alpha, what is alpha? Now suppose I have created a portfolio and that portfolio is giving me a return of say 18%. So this is the portfolio return 18%. When I find the beta of the portfolio and substitute in Capm formula, Capm tells that for that beta it should give 17%. So the beta of the portfolio tells that the portfolio is expected to give or required to give 17% as per Capm, but actually I have earned how much? 18%. So therefore alpha is actual return minus required return as per CAPM, that equal to 1%. And remember, alpha is positive, means it is very good. The fund is good. Why? CAPM is demanding only 17%, but a fund manager using his skills has earned 18%. So alpha is actual return minus CAPM return. Very, very important. You must remember this. Concept of SML is a simple. Suppose you draw return versus beta graph, and the line what you get is called security market line, and that's what is written here. Suppose there is a point A here, A, and there is a point B here, there is a point M here. M represents market. So when you take slope, what is slope? Now this is, remember, beta is 0. So this point will be risk-free rate, because risk-free rate has 0 beta. So x-axis is 0 here and y-axis risk-free rate. So risk-free asset will have 0 beta and it gives some return, that is RF. And this is your RB. Suppose you have this beta. This is beta of stock B and this is RB. Similarly, this is beta of market, which is 1, and this is RM. Similarly, this is beta of stock A and this will be RA. Remember, it's a straight line and the slope of the line at any point will be same. You take slope here, or you take slope here, or you take slope here, it should be same. It can't be different. So therefore, what is the slope? Slope is given by formula y2 minus y1 upon x2 minus x1. This is the slope formula which I learned in 11th standard or 10th standard. So the slope of point B will be RB minus RF upon beta B. So that is the slope at point B. What is the slope at point A? RA minus RF divided by beta A. What is the slope at point M? RM minus RF. See, we are doing beta B minus 0. Is it not? And beta A minus 0. This is 1 minus 0. So you can see that we get this RA minus RF upon beta A, RB minus RF upon beta B, and R minus RF. So this has never been asked in the exam. Just thought we run through this small concept. APT formula is given by expected return of stock plus, or the expected return of stock as risk-free rate plus factor sensitivity into factor risk premium of first factor. So this is your first factor, second factor, third factor, and so on. We have a very good problem in this revision video series. Try to do that, and where these concepts will be discussed again. And you have to remember this, very important. The number of factor sensitivity will be equal to number of factors. 4 factors, 4 beta. Now we are still using beta. Some books use lambda. some another Greek letter just to differentiate between beta. Beta is generally used in CAPM when we calculate sensitivity with respect to market. Therefore, whenever you want to study sensitivity with respect to individual factors, you want to give a different name. Therefore, some books use lambda or other Greek letter. We continue to use beta, and we know that we are in the APT environment, so we do accordingly. Next is a very important concept in portfolio, that is sharp single index model. Three main formula. First is risk of a stock. Second is covariance between two stocks, and third is risk of a portfolio. Now this is systematic risk. So total risk of a stock, total risk is what? Variance is equal to, now you can see I am adding variances. We can't add standard deviations, I can add variances. So when I have total risk is equal to systematic risk plus unsystematic risk. So this is how we bifurcate. We have got problems in the video series explaining this very well, so go through that. Covariance is given by product of beta multiplied by market variance. So beta product, whatever is the product of first stock, second stock. Remember covariance, again co means between two, so we have got only two stocks. So multiply their product, multiply their beta, and then multiply with market variance. Remember covariance, what you calculated in the previous case will be different from this value. Then risk of the portfolio. Risk of the portfolio will be, see, same formula. Instead of I, we will have P. You can see instead of I, we have P. But we will have bifurcation. What is beta P? Beta P will be the same formula what you have learned, product of weight and respective beta, and sigma square EP. This is a very important formula. You should not forget. It is W1 square sigma E1 square. And those who are my students, I have derived the entire thing and given you proof also. Means the reasoning why we are getting this. Now this is the most important part of this chapter, sharp single index model formula. Next we come to sharp portfolio optimization. If at all you want to leave something in the last moment due to shortage of time, then this should be the one. What are the chances they will ask this? Quite less, but we have done this in a class and we have seen that it doesn't take that much time if you have remembered the formula correctly, but it involves a lot of decimals, so there is a chance of mistakes when you do this in the normal environment also. So in the exam you have to be extremely alert. So this is all related to sharp portfolio optimization. CPPI and constant mix along with buy and hold strategy. There are different strategies which we use to allocate the assets. When I say assets, we are treating equity and debt or bond. How I should allocate my money between equity and bond? Then there are three strategies: buy and hold, then constant mix, then CPPI. So CPPI, total money whatever you are handling less floor. Floor is a particular level below which the portfolio value cannot fall. So total money minus floor into multiplier, which is directly connected with the risk of the investor, will give you equity portion. The remaining money will be invested in bond. In constant mix, a proportion of say 70-30 will be decided in the beginning, and money will be invested in that manner. Though the market will change, fund manager will do the rebalancing. We have a very good problem in this video series where these concepts are tested. You have to do that. Next, come to asset beta. We have a very good problem on asset beta in the video series which uses this formula. Levered and unlevered beta has never been asked in the exam, and if at all I recollect, it should be almost 20 years back they had asked, and I don't think, and that also I'm not very sure, they didn't ask this, sorry, they didn't ask these two. So this we have written down in the class and solved problems also, and you can just go through it. It's not that important, but so since they are not asked for 20 years, I don't think they will ask, but this is part of the syllabus, so we have covered it. So this completes all the problems in the chapter of portfolio management. You have seen a lot of formulae, but at every stage I explained you the concept which we are using to remember the formulae. Best way is take the problems and solve. Hope you have understood all this. Let us read this problem. Using the following variance covariance matrix, calculate the portfolio risk of equal weighted 3 stocks portfolio. So matrix form information is given, and one has to know which is the variance and which is the covariance, and which formula one has to use to calculate the portfolio risk. Very, very important problem. Though it may not command 8 full marks, it will definitely command 4 marks, and it will come as part of a bigger problem. Let us see how we do this. We write sigma p is equal to square root of w1 square sigma 1 square plus w2 square sigma 2 square plus w3 square sigma 3 square plus 2 w1 w2 sigma 1 sigma 2 rho 1 2 plus 2 w1 w3 sigma 1 sigma 3 rho 1 3 plus 2 w2 w3 sigma 2 sigma 3 rho 2 3. And we also know that correlation coefficient and covariance, they are linked by this formula. So we can write rho AB is equal to sigma AB upon sigma A sigma B. Therefore sigma AB equal to sigma A sigma B rho AB. So covariance is nothing but product of two individual standard deviations and correlation coefficient. So we can see here that this sigma 1 sigma 2 rho 1 2 can be written as sigma 1 2. Similarly, this can be written as sigma 1 3, and finally this can be written as sigma 2 3. So our formula will simplify to sigma p is equal to square root of w1 square sigma 1 square w2 square sigma 2 square plus w3 square sigma 3 square plus 2 w1 w2 sigma 1 2 plus 2 W1 W3 sigma 1 3 plus 2 W2 W3 sigma 2 3. Now we are directly provided with this information in the matrix form. Now it's a variance covariance matrix. If you see the matrix 1, 2, 3, 4, 5 and 6. Now this 6 data is provided in the matrix form. Now what is sigma 1 square? Now sigma 1 square is given as A and A. You can see it is given as 630. So this is 630. What is sigma 2 square? B and B. What is common? B and B, where it meets 810. So this is 810. Sigma 3 square, C and C, 990. What is sigma 1 2? See the intersection of A and B. It is 540. Sigma 1 3. See the intersection of A and C. It is 450. And finally sigma 2 3. See the intersection of second and the third, that is B and C. B and C will intersect at minus 630. So this data is provided in the matrix form. So there is no requirement of correlation coefficient at all because we have this ready formula. Second point. Second point is it is equally weighted. Means there are 3 stocks equal weighted. Now if you want to divide one part into 3 equal, then you cannot use 0.33 because when you add 0.33 3 times, we don't get the total weight as 1. Therefore, we must do 1 upon 3. Now 1 upon 3 plus 1 upon 3 plus 1 upon 3 is equal to 1. So therefore, you have to remember this. In case you are not aware, you must mark this in your notebook. That whenever 3 stocks equal weighted portfolios are given, you have to take each weight as 1 upon 3. So therefore, W1 equal to W2 equal to W3 equal to 1 upon 3. Fractions are friends actually, provided we use them properly. Fractions simplify our task. Decimals are not. Decimals are dangerous because when you calculate, you have to struggle sometimes. So when we use fractions, it becomes so easy. Just see, I am substituting now. Sigma p is equal to 1 upon 3 the whole square into 630, 1 upon 3 the whole square into 810, 1 upon 3 the whole square into 990, 2 into W1 W2 both are 1 upon 3. So 1 upon 3 the whole square into 540, 2 into again 1 upon 3 the whole square into 450 plus 2 into 1 upon 3 the whole square into, now here you have to be careful because 630 is negative. So we always write in bracket so that this bracket will remind us this is a negative thing, and then we should not forget to put the square root. Now you can see that this 1 upon 3 square is common. Now when you actually do this, you can remove it out. So 1 upon 3 into square root. Now just see how beautifully it simplifies into a simple problem or calculation. So 630 plus 810 plus 990 plus 540, sorry, 1080 it should be, plus 900 and minus 1260. So when you actually do this in the calculation, you can see 630 plus 810 plus 990 plus 1080 plus 900 minus 1260, 3150. So this is 1/3 into 3150. So when you take a square root, we get 18.71% as an answer. We have to take a square root and then divide by 3. Ultimately, we will get 18.71% as the answer. Now, these fractions, just see how it has simplified our task, provided we used it properly. Otherwise, you will be dividing every time 1 upon 9, 630 upon 9. Luckily, it goes in table of 9. So that way also you can make it simpler, but sometimes the numbers are not divisible. It becomes quite complex. So better to take the squares out of the square root and then do the simple addition, subtraction, whatever it is, and then complete the solution. Now this problem usually comes in the exam as part of a bigger problem. If it comes in the compulsory section, it can come alone for 5 marks. Else it can be part of a bigger problem of 8 marks, where this will be required to be calculated. Hope you have understood this. Let us see this problem. We are given period of 10, we can say it as years, days, weeks, anything. Return on stock X is given in percentage, return on stock Y is given in percentage, return on market portfolio is also given. Compare the beta and overall risk of stocks X and Y. So this involves having a knowledge of calculation of standard deviation and beta. Though one cannot expect a 10 period problem in the exam, definitely 5 or 6 period can be asked, and it has been asked. Let us see how we do this problem. Now, which are the formula that are going to be used? How we calculate overall risk of any stock? For that, you must know whether we have historical data or forecasted data. Here we are having historical data, where 10 different periods are given. So if the historical data is given, the total risk or overall risk is sigma. So we can calculate sigma using this formula, summation of RA minus RA bar whole square upon n. And we have to calculate. So in case we want to write X and Y, we can write, but I generally tell my students that you can continue to use A and B if you want, but write on top A is stock X, B is stock Y. Otherwise, I can write like this also. Similarly, I can do sigma Y, summation of RY minus RY bar, the whole square upon n. And this will give us overall risk of stock X and Y. We have to find beta also. Beta can be calculated using the formula covariance of X with respect to market upon variance of market. So this will be summation of Rx minus Rx bar into Rm minus Rm bar divided by, now here we can, I'll just show you one step which you can omit, but we can write it upon n divided by Rm minus Rm bar whole square upon n. See, n gets cancelled, so you may omit that step also because it will be understood, but still this is more clear. So this will give us beta x. Similarly, beta y summation of Ry minus Ry bar Rm minus Rm bar divided by n divided by summation of Rm minus Rm bar the whole square by n. So this problem tests the knowledge of student, whether student knows how to calculate total risk and how to calculate beta. Now we are given returns. So what all we need? We need Rx minus Rx bar. See, it is used here also. We need Rx minus Rx bar and Rx minus Rx bar square. Similarly, we need Ry minus Ry bar. Again, we need Ry minus Ry bar and Ry minus Ry bar square. Finally, we need Rm minus Rm bar and Rm minus Rm bar square. So every deviation is required and square of every deviation is required. So Rx minus Rx bar, Rx minus Rx bar square, Ry minus Ry bar, Ry minus Ry bar square, Rm minus Rm bar, Rm minus Rm bar square. So 6. Now if you want to write so many columns in the narrow sheet, it looks very cramped. You will be short of space to write the value itself. So what we can do is, we need not have a column for Rx minus Rx bar square. We need not have a column for Ry minus Ry bar square. And we can modify it in the table. I'll show you now. So how many columns? Some of this is very important. I told you that to present in the previous one problem we did there, I said before you draw the columns in your paper, plan which are the columns you are going to make. It should not so happen that you introduce a column later on and everything gets cramped. And for short of space, you do so many things which makes the answer presentation look very dirty. So we write period Rx percentage now Rx percentage, the total will give us, will help us to sorry, will help us to calculate mean. Then once I get mean, I can calculate Rx minus Rx bar. Now I will not do Rx minus Rx bar. I will do directly square. I'll explain how we write this. Similarly, Ry percentage, Ry minus Ry bar square, Rm percentage, Rm minus Rm bar square. So we will not write the individual values. Now write the deviations. I won't write the deviation of this. I won't write the deviation of this. So these columns I won't make. I'll remove the cross here. So I will not be making columns for only deviations. I will make it for deviation square. But when I write, we will be able to track the deviation. Let us see how. And finally, we need Rx minus Rx bar, Rm minus Rm bar, and Ry minus Ry bar into Rm minus Rm bar. Now, when you present the solution in the paper, you will be writing the formula below this table. And I wrote this formula first to explain to you which are the columns you have to make. Now here also we can reduce the size. Just see here. Suppose I don't want to write like this. I want to narrow the column. What I do? I write into Rm minus Rm bar, Ry minus Ry bar into Rm minus Rm bar. So we can use all these techniques to use narrow space to write the values. Now let us see how we go about calculating. So 1, 2, 3, 4, 5, 6. What are the values? Let us write down the values of x. Negative numbers are dangerous. You have to be very careful. And y. And m. Now these are the values that are given. I need Rx bar. So Rx bar is summation of Rm divided by N, that is 10. So when you take the total of this, you will get 149. So this will be 149 divided by 10, so 14.9. Similarly, Ry bar, when you take the total, you will get 81. So Ry bar is equal to summation of Ry upon N is equal to 8.1. Similarly, I need Rm bar. So the total is 120. So Rm bar is equal to summation of Rm upon N equal to 12. Now Rx minus Rx bar square. Now here you should write in such a way that we are able to use this value here. Similarly, we are able to use this value here, and similarly we are able to use this value here. So 20 minus 14.9. So 20 minus 14.9 is 5.1. So I will be writing here 5.1 square equal to 26.01. Similarly, Ry minus Ry bar square, 10 minus 8.1, that is 1.9 square equal to 19 square is 361, 3.61. Then 22 minus 12, 10 square equal to 100. Now you can see we have carefully written 10. We have written 1.9. We have written 5.1. So we got 26.01, that is square, and we have carefully written this. So now I can use it here. So this will be 5.1 into 10, 1.9 into 10, 19. So like that you will be filling up all the table, entire table, and what we require. So I have to calculate sigma A, summation, sigma X, summation Rx minus Rx bar square upon N. So I need the total of Rx minus Rx bar. So this total I require. Then I will calculate sigma Y, summation Ry minus Ry bar square upon N. So I need total of this. Then I can calculate beta X, Rx minus Rx bar, Rm minus Rm bar divided by N upon summation Rm minus Rm bar square upon N. Similarly, beta y, ry minus ry bar, rm minus rm bar upon n, summation rm minus rm bar square upon n. Therefore, I also need the total of this, this, and this. So when we fill the table the way we are done for the first one, so next is 22 minus 14.9, that is 7.1 square. So I'll just fill up the values, what you will be getting. While I do the calculations, you can verify each value, or you can pause and then do the calculation. $79.6 minus 37.8. Here I want to caution you, when you do calculation of covariance, be extremely careful with the negative sign, because covariance can be negative. So you have to see, okay, if I am going to multiply this Rm minus Rm bar, now here in this case you will be getting 18, and Rx minus Rx bar. Now Rx minus Rx bar is 17 minus, you can just see this, minus 18, just see here, minus 18 square, and here 17 minus 14.1 is 2.1. See, this is positive, whereas this is negative. So we are getting minus 18 square. So we have to be very careful here. So when you do covariance calculation, I request you to reduce the speed slightly. So this is what you will get when you calculate, and then when we substitute, so we get sigma x is equal to square root of 514.9 upon 10, that is 7 point, no sorry, this is 1142.9 upon 10 and square root. So that will give us the answer 10.69%. Similarly, sigma y will be square root of 514.9 upon 10 is equal to 7.18%. Beta x is covariance upon variance, 349 upon 10 divided by 706 upon 10. Zero 0.4943 or 0.494. Similarly, beta of y is again same because covariance and variance both are same. So we can find that overall risk of stock X is more than that of Y. So overall risk of stock X is more, and beta of stock X and beta of stock Y is same, and that is the required answer. So in this problem you are required to know these formulae 1, 2, 3 and 4 and be slow and perfect in calculation. Then only you are likely to get the most probable 8 marks. This question usually carries 8 marks and you are likely to get that. So you have to be very careful, especially I have to remember one thing in covariance, that negative sign is quite dangerous. You have to be very careful there. That is a common mistake. Otherwise you should get this right. Hope you have understood this. Let us see this problem. We are provided with following data for stocks A and B: state of economy, probability of occurrence, RA, RB, RM. Knowing that RF equal to 5, should we invest in stocks A and B? Assume CAPM to be true. Very, very important problem. This will give you an insight into calculation of beta using probability, calculation of standard deviation when probabilities are given, and finally comparing the information, that is the expected return and CAPM return. So it involves use of CAPM also. Very, very important problem, slightly time consuming, but you must master this. Let us see how we do this problem. See, they have given forecasted returns of A and B. So we can find forecasted return of A, that is RA bar, is equal to summation of PI RAI. Similarly, I can find RB bar is equal to summation of PI RBI. You multiply the probability with respective returns, you get RA bar and RB bar. This is the expected or forecasted return. Now what does CAPM says? how much return stock should give? It depends on beta. So as per CAPM, so we can write here expected return. And now we can write here required return. As per CAPM, expected return, or I'll use the word required return as per CAPM will be risk-free rate plus beta A RM minus RM. And required return for stock B will be risk-free rate plus beta of B RM minus RF. So what we are supposed to do is we are supposed to compare RA bar with ERA. Now stock A will give or is expected to give RA bar, but CAPM says it should give ERA. So if the stock is giving what CAPM is demanding, or it is giving more, then it is worth investing. But if the stock is not giving what CAPM is demanding, then it is not worth investing. So we will write we will invest if expected return is greater than required return as per CAPM. Now we have to calculate beta A and beta B. Now beta A, beta B will be useful to calculate ERA and ERB. So therefore beta A formula we should know summation of PI RAI minus RA bar RMI minus RM bar summation of RMI minus RM bar the whole square. Similarly, beta B will be summation of PI RBI minus RB bar RMI minus RM bar, that is the covariance. So this is nothing but covariance of market, stock with market upon variance of market. Similarly, this is covariance of stock and market upon variance of market. So summation of PI, you should put PI into RMI minus RM bar the whole square. So for calculating beta, we want to know RAI minus RA bar. We want to know RMI minus RM bar. We want to know RMI minus RM bar the whole square. We want to know RBI, this one. Then we should know the product of 1 and 2. So very lengthy calculation. So let us calculate beta first and then substitute in CAPM formula and get ERA, ERB. And this we compare with RA bar and RB bar and make a decision. So let us calculate now. To make it legible, I have got this pasted so that we can fill it up and calculate. First we calculate for stock A. Now 4.5 into 0.2, that is 9.9 2.16. So this will be in line. RA minus RA bar will be 4.5 minus 9. This minus 2. This is 3. Similarly, let us calculate for RB. So minus 5 into 0.2. So this will be minus 1. 0.3 into 10, that is 3. 26 into 0.5, that is half, that is 13. This will be 15. RB minus RB bar, minus 5 minus 15, 10 minus 15, 26 minus 15. So first we calculated RA minus RA bar, RB minus RB bar. Why? That is required later on. Then we go to calculate for RM. Now this is expected 2 into 0.2, 2.7 and 15.8. Half of 16 is 8, so 7.9. RM minus RM bar, 2 minus 11. Square 81 4 4.8 square 23.04. Pardon, 8.04. But this total is not required for us. We want PI into this. So PI into 81 into 0.2 M plus 16.2 then 4 into 0.3 1.2 23.04 into 0.5 11.52. You get 28.92. Now let us calculate. Now this takes care of the denominator. You can see PI RM minus RM bar square. We have calculated this now. PI RM minus RM bar square. Now this is over. Now we are going to concentrate on this and this. So this will be RA minus RA bar minus 4.5, RM minus RM bar minus 9. So product 0.2 into 4.5 into 9. Positive sign 8.1. Then next RA minus RA bar is minus 2. RM minus RM bar is again minus 2. So 2 to the 4, 1.2. Next is 3. RM minus RM bar is 4.8. So 0.5 into 4.8 into 3. 7.2. Total will be 16.5. So this will give me beta of A is equal to summation of PI RA minus RA bar into RM minus RM bar divided by summation of PI RM minus RM bar the whole square. 16.5 divided by 28.92 will give you 0.57. Now let us fill RB minus RB bar is minus 20 minus 5 11, and this will be minus 9 minus 2 4.8. So 20 the 180 into 236, 5 2s are 10, so 3, 11 into 4.8 into 0.5, 26.4. $65.4. So therefore we can get beta B is equal to summation of PI RB minus RB bar RM minus RM bar. You can write this I, which is perfect representation. If you don't write, it's okay. Summation of PI RMI minus RM bar the whole square equal to 65.4 upon 28.92. 65.4 divided by 28.92, 2.26. So we can see that ERA is equal to required return is equal to risk-free rate is given as 5%, 5 plus 0.57 into, now market return is 11, you can see here 11. So 11 into 11 minus 5, this will be 6 into 0.57 plus 5, 8.42%. ERB is equal to required return equal to 5 plus 2.26 into 11 minus 5 will be 6 into 2.26 plus 5, 18.56. Now how it compares with RA bar? Now this is less than RA bar, or I will put the other way, that is the correct way to write expected return. So therefore expected return, which is 9% greater than ERA, therefore invest. And it is 15%. Capm is telling stock B is required to give 18.56, but it is giving only 15. You can see here B is giving only 15, A is giving 9. Capm says it should give 8.42, but it is giving 9, so therefore we invest. So here we write therefore expected return 15% less than ERB, therefore do not invest. Do not invest. So final answer is invest in A do not invest in B. Now you can see it takes quite a long time. We have to draw these 4 tables. You have to draw these 4 tables, right? And you have to be systematic in writing. Even if you show a little bit of hurry, answer could be wrong. So mark this problem for time consumption. Select this problem with great care, seeing the time available at your disposal. Hope you understood this. Let us read this problem. The following are returns in percentage of securities A, B, and the market in excess of the risk-free rate. What is the equation of characteristic line for securities A and B? Very important problem on characteristic line, and this will help you to calculate beta also. And for your information, this line in excess of risk-free rate should not be confused with, because in the practical world we draw with respect to in excess of risk-free rate and calculate beta. Okay, though we can draw without also. Let us see how we solve this problem. Suppose I draw a graph of stock return minus risk-free rate versus market return minus risk-free rate. Suppose I plot all the points, say for 100 days or 200 days, as the case may be, and then I fit a line, and this is called your characteristic line. So y-axis is stock return over risk-free rate, that is RS minus RF. X-axis is RM minus RF. And we can draw a graph of RS versus RM also. In this problem, it is given that returns are in excess of risk-free rate. So this is what is drawn. So we are supposed to find the equation of the line. Now equation of the line is y is equal to mx plus c. Now y-axis is your RS minus RF. So here what we do is, whatever returns we get, we take the mean of the returns is equal to the slope of this characteristic line is beta, and x is your RM, that is mean. So we have so many data. So what we should take? We should take RS bar and RM bar plus this is called alpha. So this will be the equation of line. So they are asking us to find this equation. I told you that characteristic line can also be plotted using RS and RM. Now we can think that we are getting this particular equation from this line. Now we are given RS, that is our stock A. They are asking for 2 stocks. So let us take stock A. Returns are 12, 15, 18. So we get RA bar 33 plus 12, 45 divided by 3, 15. Now we need beta of a stock. For beta we need, our beta of a stock is given by the formula sigma AM upon sigma square M. We are having historical data, so we use that formula, summation of RA minus RA bar, RM minus RM bar upon 3 divided by summation of RM minus RM bar the whole square upon 3. So RA minus RA bar, so minus 3, 0, 3. So we need this, and we also need RM. So RM is given as 14, 16, 18. So RM bar is 16. So RM minus RM bar will be minus 2, 0, 2. So we need a product of RA bar, RA bar, RA minus RA bar, RM minus RM bar. So we need a product. So when we take product, we get 6, 0, 6, 12. And we also need, so we have got this. Now we need this. So RM minus RM bar, the whole square. So that will be 14 minus 16. So we have got minus 2 the whole square, 4, 0, 4, 8. So therefore beta of stock A will be 12 upon 3 divided by 8 upon 3. So 12 upon 8. So we get beta of stock A as 1.5. Similarly, we find beta of stock B. Now, once you find beta of stock, so we can write characteristic line equation. RA bar is equal to beta A RM bar plus alpha. RA bar is 15, beta A 1.5, RM bar is 16 plus alpha. Therefore, alpha will be 16 into 2, 40, 24, 15 minus 24 is 9, minus 9. Therefore, equation is RA bar equal to 1.5 RM bar minus 9. Now, you can see that they are given 1.5 M minus 9. So, the equation of characteristic line is this 1.5. So, this can be written as or 1.5 M minus 9, where M is market return. So, we got the answer for A. It is 1.5 M minus 9. You see, it's written in this form. Now, similarly, we have to calculate for B. Before that, let us see what we did. We wrote stock returns, took the mean, we took deviations, then we wrote market returns, took the mean, we wrote deviations. We had a product of two deviations that gave us the numerator here. So this 12 came here, and we took square of market deviation. This came here, and we got beta. Once we got beta, we substituted in the formula and got this. Let us do for stock B. RB bar, first we write RB, that is 16, 18, 20. So RB bar is equal to 18. RM 14, 16, 18. So RM bar equal to 16. RB minus RB bar, 16 minus 18 minus 2, 18 minus 18 0, 20 minus 18 2. Rm minus Rm bar, 14 minus 16 minus 2, 0, 2. Now product Rb minus Rb bar into Rm minus Rm bar, 4, 0, 4. We want the total of this, which is 8. Rm minus Rm bar square, which is again 4, 0, 4. Again total is 8. So beta of B is equal to summation of Rb minus Rb bar, that is product of deviations, divided by 3 upon summation of Rm minus Rm bar square divided by 3. 8 upon 3, 8 upon 3, 1. So the characteristic line is given by, characteristic line is Rb bar is equal to beta of B Rm bar plus alpha of B. Rb bar is given as 18 is equal to 1 into Rm bar is 16 plus alpha B, or alpha B is equal to 2. So when we substitute, therefore equation is Rb bar equal to 1 Rm bar plus 2, or M plus 2. So we can see that we are getting the equation as M plus 2. And here we got 1.5M minus 9. So the correct characteristic line equation is 1.5M minus 9 and M plus 2. Fairly simple problem. Numbers can be directly, answers can be directly calculated without using the calculator. But we should be knowing the concept, and it's a good problem to know the concept of characteristic line. Hope you understood this. Let us read this problem. The following information has been compiled: stock predicted return, standard deviation, that is our sigma, systematic risk, and diversifiable risk, that is our unsystematic risk. Now you can see carefully that systematic risk and diversifiable risk are given in decimals. They are not expressed in numbers. Rho AB, rho AC, rho BC, that is correlation coefficients, are given. Market variance is also given in decimal. If investor is deciding to invest in the above stocks in the ratio of 60:30:10, what will be the predicted return of the portfolio? What will be the portfolio risk as per Markowitz model and Sharpe single index model? So this is how we calculate portfolio risk. There are only two methods we have learned, and both the methods are covered in this problem, a very important problem. Let us see how we do this. Whenever I am going to use, let us written down, let us go through it. I am going to use return and standard deviation in percentage only. So if they are given in decimal, I will use it in percentage. I am going to state weight and probability in decimals. So here it is given 60:30. I am going to convert decimal. I am going to state covariance, variance, SR and USR in number. So if they give in decimals, I am going to number. Now how to convert decimal to number? You can see I have written down below. If SR, USR, covariance or variance are given in decimals, convert to number by multiplying by 10,000. Because variance is square of deviation, standard deviation. Standard deviation, say we write sigma A equal to 3%. So sigma square A will be 3% into 3% is equal to 3 upon 100 into 3 upon 100 equal to 9 upon 10,000. But we write simply as a number. So if I write in decimal, it will be 0.0009. But we are familiar with writing variance as a number. So we write sigma square A as 9. We don't write in decimal. So you can see that if they give in decimal, we multiply with this 10,000 and convert to number. So what we have done is we have written that stock A, B, C return. They are given in decimal. I wrote in percentage. Standard deviation is already given correctly. Systematic risk is nothing but beta square sigma square m, and USR 200, 500 and 200 respectively. And they are given row AB, row AC, row BC, and they are given variance of market. Again, they are given in decimal. I multiply by 10,000, I get is 400. And weights, I wrote in decimal. So what we have done is we have restructured the data according to our preference, so that we can straightaway substitute in formula and get the answer. Now what is it they are asking? First they are asking portfolio return. So portfolio, predicted return of portfolio. So predicted return of portfolio is summation of WI RI is equal to 0.6 into 20 plus 0.3 into 25 plus 0.1 into 15. So 12 plus 7.5 plus 1.5 equal to 21%. So we get portfolio return. Next they are asking what is the portfolio risk as per Markowitz model. Now what is Markowitz formula of a 3-stock security or 3-stock portfolio? Sigma P is equal to W1 square sigma 1 square, W2 square sigma 2 square, W3 square sigma 3 square, 2 W1 W2 sigma 1 sigma 2 rho 1 2. So here we are writing stock A is equal to 1, stock B 2, stock C equal to 3. Better to write in the exam so that we can straight away use 1 to 3 in the formula. Plus 2 W1 W3 sigma 1 sigma 3 rho 1 3, 2 W2 W3 sigma 2 sigma 3 rho 2 3. Now W1 is 0.6 square into 11 square, 0.3 square into 20 square, 0.1 square into 15 square, 2 into 0.6 into 0.3 into 11 into 20. Now row AB is 0.32 into 0.32 plus 2 into, now 1 and 3 combination, 0.6 into 0.1, 11 into 15, AC is 0.74, 2 into, now 2 and 3 combination, 0.3 into 0.1 into 20 into 15 into 0.58. Luckily all are positive, otherwise correlations sometimes become negative, and there you have to be very careful. Preferably write the value in bracket before calculating. So when we actually do it, so 0.6 After multiplying everything, you should store in memory and then use memory recall and finally take square root. You get 11.4998 or 11.5%. So this is a portfolio risk of this is a portfolio risk as per Markowitz formula. So we can write this Markowitz portfolio risk. Now we have to calculate portfolio risk as per Sharpe single index model. Sharpe single index model portfolio risk. What is the formula? Formula is sigma square p is equal to beta square p sigma square m plus sigma square ep. Now what is beta p? Beta p is equal to summation of wi beta I, which is, now we have to calculate beta p first for each stock. Now for that we can write, now you can see that beta is given here. Now we know sigma square m. This is sigma square m. This is sigma square m. So we substitute the sigma square m with this value and systematic risk is given. So we can get beta square and from there we can get beta. And then using the weights I can calculate beta square p. So that is this part. Sigma square m is given 400. Now we need sigma square ep. Sigma square ep we are given this individual sigma square e, a, e, b, e, c, and we know the weights, so we can calculate that. So let us proceed. Stocks A, B, C. Systematic risk. So they are given systematic risk 50, 100, 300. So we can calculate beta square is equal to systematic risk divided by sigma square m. Why? Because systematic risk is beta square sigma square m. Therefore beta square is equal to systematic risk upon sigma square m. So if I remove this, we can directly get beta. So we can put an asterisk mark here. So I have to take, now what is sigma square m? Sigma square m is given as 400, 0.04 or 400. So I should be doing 50 upon 400 square root. 50 divided by 400 square root 0.354. Then 100 divided by 400 square root 0.5. Then 300 divided by 400 square root 0.866. Now weight is given 0.6, 0.3, 0.1. So we can calculate Wi beta I. The total will be your beta of the portfolio. So 0.6 into 0.354, 0.212, 0.3 into 0.5, 0.150, 0.1 into 0.866, 0.087. So 0.449 or 0.45 you can take. Okay, so 0.449 we got. So we can calculate this part now because this part is complete. Now we need this part. So the formula is sigma square EP is equal to W1 square sigma E1 square, W2 square sigma E2 square, W3 square sigma E3 square. So W1 square is 0.6 square into sigma E1 square. So they are given 200. W3 square, sorry, 0.3 square into 500. 0.1 square into 200. $119 we get. So therefore sigma square P is equal to beta square P sigma square M plus sigma square EP. Now beta square P sigma square M, the beta P is 0.449. So 0.449 square into 400 plus 119. So 0.449 into 400, 80.64 plus 119, 199.64. Therefore sigma P is equal to square root of 199.64, that is 14.13%. Approx. So you may get 14.14, 14.13. I told you that when we are using decimal, had I used 0.45 square, possibly would have got 14.14. So this you should not worry about in the exam. They will not see the third and the second decimal point. They will see what is the formula you have written, how you have substituted it, and what decimal, because it's very difficult in finance to tell at every step how many decimals you should take. So therefore need not get worried that your final answer doesn't match exactly. Instead of 199.64, had I used 0.45 square, I would have got 14.14. So we can accept this answer. So the required answers are %, which is portfolio return. Then sigma P as per Markowitz is 11.5%. And finally sigma P as per Sharp 14.13 or 14.14. Very good problem for practice, and as I told, problem is not that difficult. Hope you understood this. Let us read this problem. The following particulars are furnished about three mutual fund schemes P, Q and R. So we have got dividend distributed, capital appreciation, opening and NAV and beta. A certain risk scheme should not be invested based on alpha. If Government of India bonds carry an interest rate of 6.84% and Nifty has given a return of 12.13%. Now this question is a mixture of portfolio management concept and mutual funds. Now since this is a revision course and at this point I am assuming that you know the basics of mutual fund returns and also the basics of portfolio, that is CAPM. So very important problem where we use alpha. Now alpha is excess of stock return over that required by CAPM. This is, we use Jensen's alpha in mutual fund performance. So absolutely similar thing. So we have to find out which scheme should be preferred. Let us see how we do this problem. Suppose we have a stock or index. How we calculate return? So I'll use the word P. So I do P1 minus P0, that is change in price, plus D1, that is dividend given divided by P0 into 100. End price minus beginning price plus dividend got between this beginning and ending period divided by the beginning price. This is how we calculate stock index return. So this we calculate stock return. Sorry, I'll write here stock return. Now how we calculate index return? Now index does not give any dividend, but there is a dividend yield available. Formula is slightly modified. So index return, if we write index as a proxy for market, so we can write RM percentage is equal to end index minus beginning index divided by beginning index into 100. So this will give me percentage change in index, end value minus beginning value, plus dividend yield percentage. You can see here, since dividend is known absolute form, we are adding here. Since in this case dividend is given in percentage annualized form, therefore we are first annualizing it, or we are first finding the return and then adding. This is extremely important to know. Now in this case we are given three schemes. Now let us write what is alpha. Now alpha is defined as excess return of stock, or I can write RS percentage, over required return of stock as per CAPM. Now if stock S has to be evaluated for alpha, first find out what is the return that stock should give as per CAPM. Then you find out what is the actual return given by that particular stock. So actual return minus required return will give you alpha. If alpha greater than 0, the stock is good. Stock is good for investment. If alpha less than 0, stock is not good. So we will be rejecting that stock whose alpha is less than 0. If alpha is equal to 0, you can be indifferent. So alpha is your return, what you are going to get from the, or what the fund is going to give, minus what it is expected to give as per CAPM. So for the 3 schemes, we will calculate this. So it is given that scheme P scheme Q, scheme R. Opening NAV 32, 27.15, 23.5. Dividend plus capital appreciation will be 1.75 plus 2.97. So 3.72, 4.72. So 1.75 plus 3, 4.75 and 3 less. Next is 3.53. And the next is 3.29. Which is a sum of 1.99 plus 1.3. So 2 plus 1.3 is 3.3, 1 less 3.29. Now what is the return it gives? 4.72 upon 32 into 100. 3.53 upon 27.15 into 100. 3.29, 33.5 into 100. So when you do this, 4.72 divided by 32, 14.75. 3.53 divided by 27.15. 13. 3.29 divided by 23.5. 14. So now this is the actual return. So this you can write actual. Now we have to calculate CAPM return and then compare. CAPM return is equal to risk-free rate is given as 6.84%. So write the formula first. RF plus beta into RM minus RM. 6.84 plus beta is 1.46 and RM is given as 12.13 minus 6.84. So 12.13 minus 6.84 into 1.46 plus 6.84. 14.56. Similarly, here it will be 6.84 plus 1.1 into 12.13 minus 6.84. This will be 12.13 minus 6.84 into 1.1 plus 6.84. 12.66. and finally this will be 6.84 plus beta is 1.4, 12.13 minus 6.84. Into 14.25. Therefore, alpha is, now you have to see this. This is actual return. So alpha is actual return. Alpha is equal to 14.75 minus 14.56. So we are getting alpha as plus 0.419. You should write plus and minus for alpha. Minus alpha means not worth investing. Plus means good for investing. So we can see that the green highlighted one is 14.56. That is the return the scheme should give as per Capm. But how much it is giving? 14.75. So therefore it is good to invest. So this fund is good to invest. Good to invest since alpha greater than 0. Then let's take alpha for this one. So alpha will be actual return minus Capm return equal to plus 0.34%. Again alpha positive, therefore good to invest. Now coming to the last one. So we have got alpha is equal to actual return 14% minus Capm return since alpha is negative, scheme R is not worth an investment. So we can see that scheme R, we are getting alpha negative. Okay, actual return is only 14. Capm is telling that it should give 14.25. For the remaining two schemes, P and Q, are giving returns more than Capm return. But R is not. Therefore, R is a fund you should reject. Hope you understood this. Let us see this problem. The company has just paid a dividend of ₹1. It will maintain this dividend for 2 more years. Then it will pay ₹2 and ₹3 subsequently for the next 2 years. After that, it will pay ₹3 forever without any increase. The company's equity beta is 1.5, whereas RF is 5% and market return is 15%. If the shares are trading at a market rate ₹12, what is your comment on the share price? Use 3 decimals while using P factors. So here it is a combination of finding out the price using DDM. But for finding out the price using DDM, we need expected rate of return K, and that is provided by our CAPM. So we use CAPM, calculate K, substitute in DDM formula, calculate price, and then comment on the share price. Let us see how we do this problem. Expected return from a stock is equal to risk-free rate plus beta into RM minus RF. Now expected return from a stock. Now this is the rate which we use to discount dividend to find the value of equity share. Now Gordon has given dividend discount model, which says that present value of an equity share, that is P0, is nothing but future dividends discounted. So future dividends discounted. Now I have to discount all future dividends. Remember, it is future dividend. So I will have to discount from the year 1. So D1, D2, D3, D4, etc. Now I have to discount. Now how we find the value of share? We find the value of share by discounting dividend. With what rate? With the rate at which we expect return from the share. How much return we expect from the share? We expect return based on CAPM formula, that is ER is equal to RF plus beta into RM minus RF, which we also write it as K. So I will have to discount using this rate. So I discounted first dividend 1 time, second dividend 2 times, and so on. So like that we write. Now we have learned one more concept in dividend discount model, that if we are getting perpetual dividend, means dividend forever, that is constant dividend approach. So there, under constant dividend, approach, P0 is equal to D upon K. So whatever constant dividend we are going to get forever, so we will be discounting that D with expected rate of return K. Now let us use all these concepts and try to build the price of an equity share. The best way to do such kind of problems is to draw a timeline diagram. So this is time 0, then time 1 year, 2 year, 3 year, 4 year, 5, and so on. Because we are not drawing beyond 5 since they are given data up to 4 years. So the company has just paid dividend 1. So this is dividend. So it has just paid dividend 1. It will maintain this dividend for 2 more years. So it will maintain for 2 more years. Then it will pay 2 and 3 subsequently. So it will pay 2 rupees and 3 rupees subsequently. After that it will pay 3 forever. So it will pay 3, and so on. So we can see that we have what is called as a 2-stage growth approach. Means there is a first stage where dividend is going from 1, then 2, 3, and second stage 3 forever. So we can actually see if we can actually do this by 2 methods, but I will take one of the methods and I will then explain how it can be done by another method. So if we draw this stage 1, so this is stage 1 for us, and from here this is stage 2. So stage 1 where they have actually given 1, 1, 2 and 3. So we write it as P0 is equal to first dividend D1, discount once, second dividend D2, discount twice, third dividend D3, discount thrice, fourth dividend D4, discount 4 times. Now we have taken care of first dividend, second dividend, third dividend and fourth dividend. Now we can see that at this stage, from here it is constant forever. So we write it as simply plus P4. Now P4 means price of a share which accounts for dividend from 5 till infinity. Okay. P0 means, see, this is P0. This is P0. P0 means price of share today accounting for dividend from year 1 to infinity. P1 means price of share at the end of year 1 accounting for dividend from year 2, that is available at the end of year 2 till infinity. Similarly, P4 means D5 which accounts for dividend D5 till infinity. So we have already taken D4 till D4. So this P4 will account for dividends D5 till infinity. But D5 till infinity is 3 rupees constant. So therefore we can say that P4 is nothing but D5 upon K. So whatever is going to be D5 is going to be same forever. So P4 is D5 upon K. But I am calculating P0 today. Therefore we have to do one more rectification. So this will be into 1 upon 1 plus K raised to 4. Why? Because we are calculating P4. When P4 is calculated 4 years from now. But are we calculating for P4? No, we are calculating P0. So therefore we have to discount P4 4 times. So P4 will be D5 upon K into 1 upon 1 plus K raised to 4. So if we substitute this, we will get P0 is equal to 1 upon 1 plus K, 1 upon 1 plus K square, 2 upon 1 plus K cube, 3 upon 1 plus K raised to 4 plus P4, which we will write it as 3 upon K into 1 upon 1 plus K raised to 4. Now we have to find K, and we know that we have to use Capm formula. Using Capm, our expected return is equal to K is equal to risk-free rate plus beta into Rm minus Rm. Now risk-free rate is given as 5% plus beta is 1.5, Rm is 15% minus 5%. So 10 into 1.5 is 15 plus 5, 20%. So we have got K is equal to 20%. and we can see that we are going to discount for 4 years. So we need P factors for 20%. So we write that because we need to show the calculation to the examiner what P factors you use. So this year PVIF 20 comma n, so 1 2 3 4, so 1 upon 1.2, so we can calculate at 0.833. I am taking only 3 decimal because they are given in the problem, and then you can calculate 694, 0.579, 0.482. So 0.833 is nothing but 1 upon 1.2 raised to 1, 1 upon 1.2 raised to 2, and so on. So this is 1 upon 1.2 raised to 1, 1 upon 1.2 raised to 2. And we have to take only 3 decimals. So now what we do is we write this P0 is equal to 1 upon 1.2, 1 upon 1.2 square, 2 upon 1.2 cube, 3 upon 1.2 raised to 4, plus 3 upon 0.2 into 1 upon 1.2 raised to 4. So this will give us 0.833 plus 0.694, 1.158, 1.446, 3 upon 0.2, 30 upon 2 is 15, 15 upon 15 into 0.482 will give you 7.23. This comes to, memory recall, 11.36. So this we are getting as 11.36. Now this is the theoretical price as per dividend discount model, and the market price is given as rupees 12. So theoretical price is equal to P0 is equal to rupees 11.36, market price is equal to rupees 12. Therefore share is overvalued in the market because it should be quoting not beyond 11.36. If theoretically we calculated, it is worth only 11.36, but in the market it is quoting at 12. That's what they are given. So therefore the share is overvalued. The correct answer is share is overvalued. Now this can be modified slightly. We can do in a slightly different way, this manner. So this complete the solution. So I'm just trying to draw the next the alternative method. So we have time 0, 1, 2 years, 3 years, 4 years, and so on. Dividend is 1, so there will be 1, 1, 2, 3, 3. Now when you do this, so we are getting, we can actually divide into 2 parts. This is stage 1, this is stage 2. So we can see that stage 2 we can take it because it is constant from year 4 itself. So we need not have done from year 5 the way. It is alternative method, method 2. So in this case what we do is, we do P0 is equal to D1 upon 1 plus K, D2 upon 1 plus K square, D3 upon 1 plus K cube. So we took this dividend, and this dividend. We individually discount because there are different values. Now we are having forever same. So we simply write P3, that's all. So it is getting constant from year 3. So we individually after year 3, sorry. So we write plus P3. What is P3? P3 is equal to D4 upon K is going to get, we are going to get 3 rupees forever. So D4 is same as D5 is same as D6 and so on. So or we can write, this is 3 upon K. But we have to discount. So we write that P3 is calculated at the end of year 3, right? At the end of year 3. P4 is calculated at the end of year 4, like that. So here I discount 3 times. 1 plus K cube. So we write the answer. So substitute the values. 1 upon 1.2 plus 1 upon 1.2 square plus 1 upon 1.2 cube. Sorry, 2 upon 1.2 cube plus, now dividend D4 is 3 upon 1.2, sorry 0.2 into 1 upon 1.2 cube. So this will give you 0.833 plus 0. Second factor 694 and 2 into 0.579 is 1.158 plus 15 into 0.579. So when we add this in the calculator, 0.833 plus 0.694 plus 1.158 plus 15 into 0.579, we get approximately 11. 37. This is very close to 11.36, the actual answer. So the round of difference would come. So this is the second method of doing the same problem. So you can do either by this method or by the first method. Both are acceptable. Both use the same concept of dividend discount model devised by Gordon, which says that price of a share is nothing but future dividends discounted. And what concept we have used from portfolio management chapter? We have used the concept of capital asset pricing model formula, that is this. RF is equal to expected return R equal to RF plus beta into R minus RF. Okay, I hope you have understood this, and this is a very important problem. Most of the exams you have one question where we are supposed to use the concept of DDM. Let us read this problem. A stock has just paid a dividend of rupees 2.50. This is expected to grow at 8% per annum over the next 4 years and then 3% forever. An investor is thinking of investing in the stock at the current market price of rupees 35. Nifty return has been stable at 12% and the investor has found that the stock carries same risk as that of Nifty. Should the investor invest? Now this problem is a mixture of the concepts from the valuation chapter, concepts using concepts of Nifty, and ultimately we have to tell whether the stock is worth investing. So very important problem, as it will actually give you insight into the concept of DDM and what we call as Nifty. Let us see how we solve this problem. Now Nifty is a proxy for market. Now market consists of so many stocks. If you go to NSE, almost 2000 stocks are listed. Suppose I want to track the 2000 stocks daily with prices, and to find the return risk is quite cumbersome. So what we do? We take very popular index which account for more than 50% of the market capitalization and which consists of leaders of all major segments contributing to the GDP of the economy, and that is nothing but Nifty. Nifty has got 50 stocks. It has got leaders of all the top businesses. So tracking Nifty is considered to be tracking market. So Nifty is a proxy for market. Now beta of market is 1. Therefore you can say beta of Nifty is also 1. Similarly, it is given that Nifty return has been stable at 12%. An investor has found that stock carries same risk as Nifty. The same risk here, not only they are telling about beta, they are telling same risk means total risk. So total risk of stock is same as total risk of Nifty, that's given. Now when the total risk is same, what about return? Therefore return of stock should be equal to return of Nifty. So return of stock should be equal to return of Nifty. Risk is same, therefore return should be same. So therefore we are given expected return. Therefore expected return of stock is equal to Nifty return is equal to 12%. So this is how they are given your stock return as 12%. So therefore in our valuation exercise, K is equal to 12%. Now which is used to calculate the price of share using dividend discount model. Now here we have stock which has paid dividend of 2.5. Expected to grow at 8% for next 4 years. 1, 2, 3, 4. So when you take 8% of 2.5 and round off to 2 decimals, you get 2.7. So what you should be doing is, you should put 1.08 first in the calculator and then into 2.5 equal to 2.7 equal to 2.92 then you should put 2.92 in the calculator into 1.08, or if you do 1.08 into 2.5 equal to, but the round off problem might come, so we should be taking only 2 decimals. So when you do it, you get 3.15 3.40. So we got these dividends for years 1 to 4, and then 3% forever. So year 5, 3.40 into 1.03, 3.502. So we take only 3.50. So now price of a share is nothing but future dividend discounted. So I'm not going to take this because future dividend I want. So we start from D1 upon 1 plus K, D2 upon 1 plus K square, D3 upon 1 plus K cube, D4 upon 1 plus K raised to 4. Just see, we have taken this, and this. Now from this period it is perpetual. So what we do is, from where it is perpetual, we just write P4. Now what is P4? P4 is the price of a share accounting for dividend from year 5 till infinity. Now we have got P0 is equal to D1 upon K minus G. What is P0? Price of share today accounting for dividend from year 1 till infinity. Now if I remove P0, I write P1, it will be from 2. What is P1? Price of share at the end of year 1 accounting for dividend from year 2 till infinity. So therefore what is P4? Similarly, therefore P4 is D5 upon K minus G. Now P4 I don't want. Actually I have to discount. I want P0. So that P4 has to be discounted 4 times. So P4 upon 1 plus K raised to 4. So P4 is calculated at the end of year 4. So I have to bring it back to year 0. So P4 upon 1 plus K raised to 4. Now P4 is this. Now what is D5? So this is 3.5 divided by 0.12 minus 0.03. Remember, dividend is growing in the perpetual period at 3%. So when you do this, 3.5 divided by 0.09, 38.89. So therefore P0 equal to 2.7 upon 1.12, 2.92 upon 1.12 square, 3.15 upon 1.12 cube, 3.40, 1.12 raised to 4, 38.89, 1.12 raised to 4. Now we need the PE factors. So we calculate and write down here. You need to show what PE factors you have used. So we write 1, 2, 3 and 4. So 1 divided by 1.12 equal to 0.893, 0.797, 0.712, 0.636. So this will be equal to, P0 will be equal to, so 2.7 into 0.893, So we round off 2.92 into 0.797, 3.15 into 0.712, 3.40 into 0.636, 38.89 into 0.636. Therefore, P0 will be equal to rupees 33.87. So this is the intrinsic or theoretical value of share. This is theoretical price or fair price. What is market price? The market price is rupees 35. Since market price is more, market price greater than fair price, share is overvalued. Overvalued in the market. Therefore, do not invest. Hope you understood this. Let us see this problem. We are provided with period RA percentage, RB percentage, RM percentage. Using the above data, comment on SR, that is systematic risk, USR, unsystematic risk, and beta of the two stocks. So, very popular problem involving sharp single index model. Question can be asked in various forms. Now here, this is, you can say it is a primer or the introduction problem where we use sharp single index model formula and compare the risk of both the stocks A and B. Let us see how we solve this. First of all, sharp single index model tells us that, now remember we are talking about a stock here. It is not about a portfolio. So sigma square S is equal to beta square S sigma square M plus sigma square ES. Now this is your systematic risk. This is your unsystematic risk. And this is your total risk. Now unsystematic risk of a stock, we don't have any formula. I repeat, unsystematic risk of a stock, we don't have any formula. What we do is, we need to know total risk of a stock, that is variance. We have to calculate systematic risk of a stock, that is beta square S sigma square M. And when we subtract systematic risk from total risk, we get unsystematic risk. Therefore, USR is generally evaluated after knowing TR and SR. USR of a stock, I repeat, USR of a stock, not portfolio. So USR of a stock is generally found out after calculating TR and SR. So we can say that USR will be total risk minus systematic risk. So we have to evaluate between stock A and stock B, which has got more unsystematic risk or which has got more systematic risk. In other words, we have to calculate one, 2 and 3 for A and B, stocks A and B, and then make our final decision. Now, we are given returns. Using returns, what we can calculate? Using returns, we can calculate standard deviation. Then, if we are having two stocks, then we can calculate covariance. Now, we can calculate covariance. Now, here we want to know what is beta. So, beta of stock, covariance of stock with respect to market upon variance of market. So we have to calculate beta of a stock. Now what is covariance? Covariance is given by product of deviation. Now here I am writing S. I will write here RS minus RS bar, RM minus RM bar upon N. Remember, we are having historical data here divided by number of data, summation of Rm minus Rm bar square divided by N. Now this will help us calculate beta. We have to calculate for stock A and stock B separately. So we will be having beta. So beta square will be known. We can calculate variance of market using market return. So SR will be known. Then we can calculate standard deviation of stock. This will help us calculate total risk. So TR will be known, SR will be known. Then finally we calculate USR. Like this we have to do for both the stocks A and B. And that will give us the final answer, which is having more SR or USR. Okay, so let us start calculating. First, let us write down. Now we are going to do this for, first we will do for stock A. Remember, we need beta. For beta, we need covariance of stock with respect to market. We need variance of market. That is for beta and variance of market. That will give us SR. We also need standard deviation of stock because we need variance of stock. So what are all the columns you have to draw? I advise you all to write down in the rough sheet or on the side. Don't draw the column straight away. Sometimes what will happen, you will draw one column, then you need to introduce some space. So you can actually write down. So first I need period, then stock return. The stock return column will give me stock mean, then deviation of stock, then variance of stock. So this will take care of total risk of stock. Then stock market return, then deviation of market return, then square of market return deviation, square of market deviation, that will give us market variance. Then product of deviations, that will help us calculate beta. So we write period. They have given us stock returns. They have given us market return. So we can calculate RA minus RA bar. Then we need square of deviation. This will give us variance of stock. So this total will be useful to us. This total will be useful to us. This total will be useful to us. Then we are calculating RM minus RM bar. Rm minus Rm bar the whole square. So this total. Now this will take care of market variance. And finally Ra minus Ra bar into Rm minus Rm bar. We need this total. So the last column total will take care of covariance. So we have got 1, 2, 3, 4. Returns that are given are 6, 10, 24 and minus 4. Market returns are 8, 12, 9 and minus 1. So the total will be 34, 40, 36. So Ra bar is equal to 36 upon 4 equal to 9%. And Rm bar will be 20, 29, 28 upon 4 is equal to 7%. Ra minus Ra bar, so 6 minus 9. Total will be 404. Rm minus Rm bar, so 8 minus 7. Square it will be 94. Now product of deviations, so we will be taking this column and this column. So minus 3, 5, 30, 104. You have to be very careful with the negative sign. So 136. Therefore beta of stock A is equal to sigma AM upon sigma square M. This is summation of Ra minus Ra bar, Rm minus Rm bar upon N, summation of Rm minus Rm bar the whole square upon N. So that this will be 136 upon 4 upon 94 upon 4. So this will give you 1.45. So we are getting 1.4468. So we need not write all the decimals. Remember, beta are restricted to decimals. So now SR is equal to beta square A sigma square M. Now sigma square M is 94 upon 4. Now beta square A is 1.45 square. (94 upon 4). So when we do this, (49.41). Now when we calculate sigma square S, or in this case sorry A, this will be total risk. So which is given as 404 upon 4 is equal to 101. So this is your total risk. So what is total risk? Total risk is, how we got this? Let me write one more step between this. This will be summation of RA minus RA bar the whole square upon n. So from the total, so we can see this 404 and there are 4 data is equal to 101. So we will get TR is equal to SR plus USR. So 101 is equal to 49.41 plus USR. Therefore USR is equal to 101 minus 49.41, which will be 51.59. Now in a stock, total risk is 101. What percentage is SR? So percentage of SR, percentage of SR in total is equal to 49.41 upon 101 into 100 will give you 48.9%. Percentage of USR in total will be balance, that is 51.1%. Now this is for stock A. Now the same thing we have to do for stock B and then compare. So now we do for stock B. Stock B. Let us write the data similarly. Period RB, RM, RB minus RB bar, then RB minus RB bar the whole square, then RM minus RM bar, which is same as the previous one, RM minus RM bar the whole square, and RB minus RB bar into RM minus RM bar. When you do the calculations the way we have done for stock A, you would be getting a similar table as it is shown here. Now we find that beta of stock B is also same as that of stock A, and systematic risk of stock B is beta square B sigma square m. So 1.45 square into again same 94 upon 4. So numerically systematic risk of stock B is also same. I say numerically, so 49.41 is what we get. In stock A, you can see that here we are getting systematic risk of stock A 49.41 and systematic risk of stock B 49.41 here. So you are getting same. Now total risk of stock B is summation of RB minus RB bar square upon N. So that is 340 divided by 4, that is 85. So total risk of stock A was 101, whereas total risk of stock B is 85. Now total risk is nothing but systematic risk plus unsystematic risk. So we get 85 equal to 49.41 plus USR. Therefore we get USR as 35.59. Now what is the percentage of systematic risk in total? So total is 85, systematic risk is 49.41, so percentage is 58.13. So we are getting 58.13 percentage. What is percentage risk? Percentage of unsystematic risk to total? So the remaining, so 41.9%. So we can see that percentage of unsystematic risk in stock B is 41.9%. Now, though beta of stock A and B are same, the percentage, suppose I write systematic risk, unsystematic risk, percentage of stock A and stock B, and we write beta. Beta is 1.45. Same. What is percentage of systematic risk in stock A? So we got that as 48.9. 48.9. Balance 51.1. What about B? We got 58.1. Balance 41.9. So though the total risk, the total risk of A is 101. What is the proportion of unsystematic risk? 51%. So A has got more unsystematic risk. What is unsystematic risk? Unsystematic risk is that part of risk which is contributed by company specific events. So in stock A, suppose you are investing in stock A, your returns are going to show more deviation due to company specific events. And whereas in stock B, the proportion of USR is lower. So the deviation of returns of stock B is more guided by the market. So our required answer is stock B, the proportion of unsystematic risk in stock B is 41.9%. So this was the correct answer which was to be written. So the remaining, the answers that are given, they are incorrect. So 41.9% is the total risk, or the percentage of total unsystematic risk in stock B. So we are getting, now we can write one more column here to enhance our understanding. So we got here total risk, this was 101 and this was 85. Now systematic risk, we got 49.41. Here also 49.41. You can see numerically systematic risk is same in stock A and B, but percentage wise, since total risk of stock B is only 85, the proportion of USR is lower. Okay, hope you understood this. Let us read this problem. Two funds are selected for investment: total equity TE fund and half equity half debt HED fund. The particulars are given as follows. Return, standard deviation and correlation with market is given. Treasury bonds provide a return of 5%, Nifty 16%. Market variance is 16. Comment on the covariance, systematic risk and return of TE and HED. So they are asking three parameters: covariance, systematic risk and return. Can we say that covariance with market of TE is less than covariance with market of HED? Can we say that systematic risk of HED is more than that of TE? Or can we say that TE provides lower return as per CAPM? So they have asked you to compare the three parameters and they have posed a question. So we must be clearly telling what we have to say after calculating. This involves use of sharp single index model and other information which we have learned in CAPM in the portfolio management chapter. So let us see how we solve this problem. Now first is covariance of a fund, say I call it as S, with market. How to calculate covariance? So we can use correlation coefficient, it is given. So correlation coefficient into sigma S, sigma M. Because we know that correlation is given by sigma SM, sigma S, sigma M. So from this we get this. So we can calculate covariance like this. Then how to calculate systematic risk? Now as per sharp single index model, systematic risk is beta square S, sigma square M. Now beta is not given in the problem. We can use covariance to calculate beta, where beta S is equal to covariance upon variance of market, or I can also calculate as rho SM sigma S sigma M. Both the formulas can be used. So this is how we calculate covariance. So comparison can be done. This is how we calculate systematic risk. And finally, how to calculate CAPM return. Expected return of CAPM is equal to risk-free rate plus beta of the stock or fund RM minus RM. So we can calculate this as formula 1, formula 2, formula 3. And we have to find out these three for PE fund, HED fund. Now the three formulas what we have written, you have to write and then you have to show the calculation. So let us first write down now. Let us write these three which are given to us, 1, 2, 3, and then we can write this. So rho SM 0.7, 0.3, sigma S 10%, 5%, sigma M. Now they are given market variance equal to 16. So this is 4%, 4%. So therefore we calculate the next one, that is covariance as per formula 1. So we have to multiply all this. So we get 0.7 into 10 into 4, 40. 40 into 0.7, 28. 20 into 3, 6. So this is our first covariance. So we can see that covariance of total equity fund is much more than covariance of HED calculated with respect to market. Next, we have to calculate systematic risk. For systematic risk, what we want? We want beta. So let us calculate beta first. So beta of stock. So here we write beta of stock covariance upon variance. So is equal to covariance is 28, variance is 16. So 28 divided by 16. 1.75. Then 6 divided by 16. 0.375. Now what is systematic risk? So that is our next requirement. Number 2, systematic risk. So the formula is written here. So systematic risk equal to beta square as sigma square. Now this is sigma square m 16. Now beta square, so 1.75 square into 16, 49. Then 0.375 square into 16, 2.25. So this is the second one. Let us write the Capm informations. RF is given as 5%. Beta we have already calculated, and RM is given as 16%. So here we write RM is equal to Nifty return. So therefore we have the third one now. Capm return. This will be equal to ER is equal to RF plus beta is RM minus R. So we write this is 5 plus 1.75 into 11. By 1.75 into 11 plus 24.25. And the next one, 5 plus 0.375 into 11. So we get 9.125. Now we can see that covariance of PE is greater than covariance of HED. Systematic risk of HED is less than systematic risk of TE, and TE provides greater return than HED in Capm terms. So therefore we can see that all the three statements given are not correct. So these are the correct values. This problem is a simple problem involving three formulae, and you have to be alert while selecting the correct answer. Hope you understood this. Let us read this problem. Mr. Sampson has categorized the stock market into 4 types: large cap growth, large cap value, mid cap growth, mid cap value. He has also estimated the weights of the above categories of stocks in the market index. He has the following data available about the sensitivity of these stocks with respect to 3 factors: 1, 2 and 3. So there are 3 factors given and the weights in index of each of the categories are provided. Rate of return on treasury bonds is 4.5%. As per APT, that is arbitrage pricing theory, what will be the expected return on the market index? Now, market index according to Sampson is a combination of these 4 categories, and they are given 25% should be weightage should be given to large cap, 10% should be large cap value, like that. So it's a very simple problem, but we have to do very carefully. There are a lot of numbers are there, and the concept is quite plain and simple. Okay, very important problem in APT. Let us see how we solve this. Now, in fact, it uses just simple formula, and we are supposed to use that formula 4 times and then finally multiply with the respective weights. Let us see which formula. According to arbitrage pricing theory, the expected return is given by risk-free rate plus, so we have got factor sensitivity multiplied by factor risk premium. How many factor sensitivities are there? 3 are there: factor 1, factor 2, factor 3. How many risk premiums are given? 3. So we will let factor sensitivity let us call it as beta, though we can safely use lambda or any other Greek letter. Textbooks use lambda also. We can be safely using the known factor sensitivity which we are using in Capm. So we called it beta. Beta factor sensitivity 1 multiplied by risk premium 1 plus beta, that is a factor sensitivity 2 multiplied by risk premium 2, factor sensitivity 3 multiplied by risk premium 3. So each factor sensitivity multiplied by risk premium. Now when you see this formula, just this part, you can understand that it is risk-free rate plus risk premium in Capm. In Capm, what we do? Expected return equal to RF plus beta into RM minus RF. So RM minus RF is market risk premium. But here there are 3 factors. In Capm, we have just 1 factor market. Here we have 3 factors. So which are the factors? 1, 2 and 3. So we have RP1. So beta 1 into RP1, beta 2 into RP2, beta 3 into RP3. Now this is the general formula. Now we should calculate for each factor. Now first we can calculate for large cap. Large cap growth. Expected return will be risk-free rate 4.5 plus, now just see large cap row only, 0.8 into 6.85 plus 1.39 into minus 3.5 plus 1.35 into 0.65. Now this will give you return. Now we have to identify every return. So what we can give? We can give a prefix for this. We can write large cap growth, ERLG. So ERLG will be, let us calculate this. .8 into 6.85, 1.39 into 3.5 negative, 1.35 into 0.65, and finally plus 4.5, 5.99 to 5. So we can write 5.99%. Similarly, we can calculate large cap value. E bracket R large cap value 4.5 plus, now second row, 0.9 into 6.85, 0.75 into minus 3.5, 1.25 into 0.65. So let us calculate this. 0.9 into 6.85 m plus 0.75 into 3.5 negative m plus 1.25 into 0.65 m plus memory recall plus 4.5, 8.85. The next mid cap growth, ER mid cap growth 4.5 plus 1.165 into 6.85, 2.75 into negative 3.5, 8.65 into 0.65. $1.165 into 6.85 m plus 2.75 into 3.5 negative m plus 8.65 into 0.65 m plus memory recall and we have got this plus 4.5, 8.48. Verify this once again. 1.165 into 6.85 m plus 2.75 into 3.5 negative m plus 8.65 into 0.65 m plus memory recall plus 4.5, 8.48, correct. Last is mid cap value, ERMV 4.5 plus 0.85 into 6.85, 2.05 into minus 3.5 and 6.75 into 0.65. So 0.85 into 6.85, 2.05 into 3.5 negative 6.75 into 0.65 memory recall plus 4.5, 7.54. Now each of these have their own weights. Now these four comprise of your market. Now this is your market index. Samsung has considered these four with the weightages of 25, 10, 50 and 15 respectively as market index. So we are asked to calculate what is the expected return on market index. Therefore, expected return on market index will be 0.25 into ERLG plus 0.10 into ERLV, 0.50 into ERMG plus 0.15 into ERMV. So this will be equal to 0.25 into 5.99 plus 0.10 into 8.85 plus 0.50 into 8.48 plus 0.15 into 7.54. So 0.25 into 5.99, 0.1 into 8.85, 0.5 into 8.48, 0.15 into 7.54, 7.75. So this is the required answer. We have to use this formula, should be understood. This formula is expected return is equal to risk-free rate plus risk premium arising out of individual factor sensitivities. If you have three factors, so we have three: beta 1 RP1, beta 2 RP2, beta 3 RP3. We have four factors, we would have got plus beta 4 RP4 and so on. Hope you understood this. Let us see this problem. A company named KGF Limited, KGFL, has equity worth 410 crores and debt worth 170 crores. It has two divisions: printer division, spares and consumable division. So the contribution is given and asset beta is given. Assuming debt beta to be 0.24, calculate equity beta. The company has now decided to buy back equity and raise debt, so the debt equity ratio increases to 1.9. Assume that the present debt beta is 0.35, and for any further funds raised by way of debt, we'll have beta, that is beta D2 of 0.4. Assuming that the overall asset beta does not change due to this capital restructuring, ascertain the revised equity beta. If I recollect correctly, this was asked in the old syllabus examination. It is a very good problem to calculate asset beta, and ultimately we are going to very good problem incorporating asset beta and calculating equity beta. Okay, so let us solve this problem. It involves use of just a couple of formula. Let us see that. Now asset beta is given by, that is, what we are trying to say is, suppose we have a balance sheet and we have assets of the project funded with equity and debt. We have assets of the project funded with equity and debt. Then beta of this proportion can be calculated as weight of equity, that is E divided by D plus E into beta of equity plus weight of debt D divided by D plus E into beta of debt. Now here E is the value of equity and D is the value of debt. Now equity value is given as 410 crores and debt value 170 crores. Beta of asset is given indirectly and beta of debt is given. Now what is beta of asset? Now this beta is the entire beta. Now we can think of this is beta printer division and this is beta of spares division and this printer division is 74%, spares division is 26%. So 74% into 1.45 and plus 26% into 1.2. So this will give me total asset beta. So this is printer division 74%, spares and consumables division 26%. So we can write beta of asset is equal to proportion, that is weight of printer division into beta of printer division, weight of spares division, beta of spares division is equal to 0.74 into 1.45 plus 0.26 into 1.20. So this will come to 0.74 into 1.45, 0.26 into 1.2, 1.385. So beta of asset, instead of giving for just one entity, full entity, they are given in the form of division. So we multiplied the percentage, that is the proportion the division is contributing with their asset beta. So 1.385, therefore 1.385 is equal to equity 410 upon 170 plus 410 into beta of equity plus 170 upon 170 plus 410 into beta of debt, and beta of debt is given as 0.24. Therefore beta of equity will be equal to, so we can take it 170 divided by 580 into 0.24. .859, so we can write 1.86, 1.8597, so 1.86 we can write. So this is the first they have asked. First part what they have asked is what is the equity beta. Now what the company is going to do, company is going to buy back equity, so this is going to reduce. and for the purpose of buyback they are going to use debt. So this is going to increase. So what you are going to do is, I am going to raise debt and announce buyback. When I announce buyback, equity shares will be extinguished. So weights of equity will come down, weight of debt will go up. And they are given one condition here. The debt equity ratio increases to 1.9. So now desired debt equity is equal to 1.9. So we can always write 1.9 upon, for every one equity it will be 1.9. So what is the total weight? So total weight is 2.9. Now what is the total asset value? Debt plus equity, current total asset value 170 plus 410 equal to 580. So 580, we should have 1.9 part of debt and 1 part of equity. This should be debt and this should be equity. So therefore value of debt equal to 1.9 upon 2.9 into 580, and value of equity equal to 1 upon 2.9 into 580. This will go 200, 380. It is crores. This will go 200, equal to 200 crores. So equity should be this much, debt should be this much. Oh, but current debt is how much? Current debt is only 170, but so this is desired, but current debt is only 170. Therefore raise further debt equal to 380 minus 170 equal to 210. So you have to raise debt. So how we are going to do it? So actually we are going to reduce equity. We are going to buy back. So raise debt, use it to buy back. Therefore equity reduces by 210, that is 410 minus 210 equal to 200. So what we have got now is, we have got equity 200, debt first tranche, that is earlier what we were having, that is 170, and the second tranche, that is 210. So let us write that. So we can say that it is given this way. First equity, so we can write finance or source of finance, investment, weight, beta, and weight into beta. So source of finance equity, how much it is? 200. Debt 1, how much it is? 170. Debt 2, it is, so we need 380 of debt and 200. So this total comes to 580. Now let us calculate the proportion. 200 divided by 580 0.345. Then next 170 divided by 580. 0.293. 210 divided by 580. 0.362. Better to check so that we avoid round of errors. Now beta of equity. Now beta of equity we have calculated previously. Sorry, beta of equity we want to calculate, so let us call it as X. And beta of debt 0.24 first trans. Now they have written take beta as 0.35. So we take 0.35. After restructuring, they are told clearly take 0.35 for the first debt and 0.4 for the second. So this will be 0.345x. This will be 0.35 into 0.293, 0.103, and 0.362 into 0.4, 0.362, 0.145. So this will be now we want to find this. Now they are given that total beta, that is, let us read the exact sentence. Assuming that overall asset beta does not change. Now the asset beta, what we calculated 1.385. You can see here. We calculated asset beta 1.385. Now this overall asset beta does not change. So this entire thing will be 1.385. So since overall asset beta does not change, we can write 0.248 plus 0.345 x is equal to 1.385. X equal to 1.385 minus 0.248 equal to divided by 0.34. 3.296. This is the revised equity beta. This problem will not be easy for you to implement in the exam. Better practice 2 or 3 times. Definitely have a look on the last day. In this problem, initially we calculated total asset beta using the asset beta of the individual divisions. Then using asset beta and debt beta, we calculated equity beta. Then we saw the revised condition that debt is to equity should be 1.9 is to 1. So 1.9 should be part of debt and 1 should be part of equity. So 1.9 plus 1 is 2.9. So therefore proportion of debt will be 1.9 upon 2.9. And that helped us. So that proportion helped us to calculate value of debt. 1.9 upon 2.9 into 580. And this will be 1 upon 2.9 into 580. So once we got value of debt and equity, then we drew the table, this one, and arrived at the required answer. Hope you understood this. Let us read this problem. An investor is desirous of investing a portfolio of equities and bonds. The amount available is rupees 50 lakhs. Instead of investing in direct stocks, he would prefer to invest in Nifty, which is currently quoting at a level of 10,000. Bonds have zero beta with Nifty. He plans to adopt either the constant mix 70-30 in equity and bonds strategy or constant proportion portfolio insurance CBPA strategy with floor 70% and multiplied 2. After 3 months, Nifty fell to 9,500. The current Nifty is 10,000. After 3 months, it is falling to 9,500. Evaluate which strategy is better for the investor. Now, if you are provided with the information that Nifty will fall to 9,500 after 3 months, which method, constant mix or CPPI, would have been beneficial for investors? It's a very important problem in asset allocation of portfolio chapter. So where the most important two methods, that is constant mix and CPPI, are compared. Let us see how we solve this. But let us first understand the problem by writing down some details. Now money available is rupees 50 lakhs. Now this need to be invested in equity, that is it is given as Nifty. Nifty is a index comprising of 50 stocks maintained by National Stock Exchange. So when you are investing in Nifty, you are indirectly investing in 50 stocks. You are having a diversified portfolio. So this investor who is having 50 lakhs want to invest some in Nifty and some in bonds. Now beta of Nifty is 1 and beta of bonds is given as 0. Means when market changes, Nifty also will change by same quantum, because Nifty is a proxy for market. But bonds will not change in value because bond beta is given as 0. Now two alternatives are given. First is constant mix. So let us do constant mix first. And the proportion is 70-30. 70 is to 30 in equity and bonds. So I am going to invest 70% of 50 lakhs in equity. So therefore initial equity investment is equal to 70% into 50 lakhs, 35 lakhs, and initial bond investment 30% into 50 lakhs equal to 15 lakhs. Now currently Nifty is at a level of 10,000. At the end of 3 months it is going to fall to 9,500. So current Nifty 10,000. After 3 months 9,500. Therefore, fall in Nifty 9,500 minus 10,000 upon 10,000 into 100 minus 5%. So fall of 500 on 10,000 is 5%. So Nifty is going to fall by 5%. So what is going to happen to your equity? Equity, you are investing in Nifty, so it will also fall by 5%. Therefore, new equity value is equal to 35 lakhs into 1 minus 5%. This will be 33,25,000. What about bond? New bond value. There will be no change because bond has 0 beta. So bond will remain same as 15 lakhs. Therefore, total portfolio value $48,25,000. Now the total value has changed. The word constant mix means you have to constantly keep a mix of 70-30. But total value is now 48,25,000. Now when you take 70% of it, you are supposed to keep 33,77,500. So desired equity value. After fall in Nifty is 70% into 48,25,000 equal to 33,77,500. So if you want to maintain that mix, now you should be having this much, that is 33,77,500 in equity. Then only it will be 70% of the new total value. So what about the balance? Therefore, balance bond will be 48,25,000 minus 33,77,500. So bond should be having 14,47,500. So we can see that the current equity after fall, this is current equity after fall, will be 33,25,000. Desired is 33,77,500. Similarly, bond after fall, bond doesn't change, so it is 15 lakh only. But what is desired? Desired is 14,47,500. So desired minus current. So this will be 52,500 plus. This will be 52,500 minus. So your equity should be higher by 52,500 and your bond should be lower by 52,500. So what you do? Sell bond, buy equity as part of rebalancing. Therefore, rebalancing will involve selling bonds worth rupees 52,500 and buying equity of the same amount. Now you have seen that market has fallen. You are investing in equity. So in constant mix, you have to remember this. In constant mix strategy, market fall, invest in equity. Market rise, sell equities. Means when market falls, you do bargain hunting. And when market rises, you do profit booking. So this is a feature of your constant mix strategy. So therefore we got this only carries maximum mark. Sell bonds of 50 to 500 and buy equity of the same amount. So this completes our constant mix strategy. So in the answers, actually you can find that as part of rebalancing strategy, investor would buy equity worth 50 to 500. So that statement is correct actually. Now let us do constant proportion portfolio insurance. Now CPPI, constant proportion portfolio insurance, CPPI. In this, a floor is decided first, and you straightaway subtract the floor from the total amount to be invested. Now total amount to be invested is 50 lakhs. Now we have to subtract floor. Floor calculated in the beginning will remain constant in absolute term throughout the problem. Suppose I calculate here 70%. Now 70 floor is 70%. So 70% is 35 lakhs. Now these 35 lakhs will remain constant throughout. You will not calculate 70% of the new amount. No. 70% of the initial total amount to be invested will be the floor throughout the problem. So throughout the problem, our floor is 35 lakhs. So when you subtract this at 15 lakhs into multiplier, and multiplier they are given as 2. So this will be 30 lakhs. And this will be put in equity. Therefore, bonds equal to 50 lakhs minus 30 lakhs equal to 20 lakhs. So this is the initial position. So initial position is equity 30 lakhs, bonds 20 lakhs. Now market is going to fall by the same level, that is 5%. After market fall, equity will be equal to 30 lakh into 1 minus 5% equal to 28.5 lakhs. And bond, there will be no change. What is the total? Total is 48.5 lakh. So after market fall, the total value is 48.5 lakh. Now we have to apply floor and multiplier on this. and calculate desired equity and bond value. So calculating desired equity slash bond. So get total value after Nifty fall, 48.5 lakhs, less floor. Floor, we said that it will be constant throughout. It is given as 70% of 50, that is 35 lakhs. So this will give you 13.5 lakhs into multiplier. This will give 27.0 lakhs. Now this is the new floor, or this is the new equity value. So therefore new equity value So what is the current equity bonds? Currently, what is the value of equity? Now we have to find out. Currently you are holding 30 lakhs and 20 lakhs. But after the market fall of 5%, equity is 28.5 lakh and bond remains at 20 lakhs. So total is 48.5 lakhs. Now what is the desired? Desired is 27 lakhs. And 48 minus 27 is 21.5 lakhs bond. So we can find that this will be negative 1.5 lakhs. This will be positive 1.5 lakhs. So we can say that in order to maintain CPPI, we have to sell equity worth 1.5 lakh and invest in bonds. Therefore, rebalancing will be selling equity worth 1.5 lakhs and invest in bonds. So here in CPPI, when market rises, you do investing. When market falls, you sell. So we can see that it is exactly opposite strategy of constant mix. In constant mix, just I am minimizing it. Market fall, you invest. And here market fall, you sell. On market rise, you sell. Means you do profit booking. Here market rise, you invest. Now when the market falls in CPPI, you sell. Means you are anxious that you will make more losses and therefore you will be selling. And CPPI will give you exact opposite strategy that of constant mix. Okay, so we have seen how CPPI and constant mix strategies are to be worked out if they are given a problem. Hope you understood this. Let us go to the next chapter, hedging of equity portfolios. It is part of derivatives, but after acquiring the knowledge of beta in portfolio management, then only you are supposed to do this chapter. Therefore, this part has been taken separately. Now, usually, we get one question on hedging equity portfolios. I can say once in 3 attempts or 4 attempts. Now, first of all, before we begin this chapter, let us understand some of the financial jargons. First of all, let us talk about bullish. So these are the terms which will be used when they give question in derivatives. Now, what does bullish means? Bullish means view or expectation, or we can say sentiment that prices will rise. I am bullish on RIL, means I am expecting RIL price to go up. I am bullish on RIL futures, expecting RIL futures to go up. So I am bullish. Now, what is the opposite of bullish? Bearish. So view, expectation or sentiment that prices will fall. I am bearish on ACC. Expect the price of ACC to go down. I am bearish on LNT futures. So like that, the term will be used. Now, if you are bullish, so you are expecting price to go up. Suppose this is 0, this is 1 month, and you are expecting price to go up in 1 month time. So you would be, if at all you want to make money, you will buy here and you will sell here. So buy at a lower price, sell at a higher price. So buying initially is called going long. So when I buy initially, initial trade, if it is a buy, see there are 2 trades. One is, you are opening a trade. Opening a trade. Here you are closing a trade. Opening a trade means it is my first activity. What is that? I am buying. So when the first activity is buy, we call it as long. I went long on RIL, and after it went up, I squared my position. So squared means sell. Provided you are gone long, nobody will say I squared. Then somebody will ask, did you go long? So only if you have gone long, you can square. So you don't use the word, I squared without nothing. So first of all, you go long, means you have bought, and then after some time you square. When you square, it doesn't mean the prices have gone up only. No, the prices could have gone down also, who knows. Your view was bullish. You are not God that your view will come true. So the prices could have gone down also. So you thought the price will go up. Therefore you bought or you went long. So you are bullish. You went long. After a month, the prices went up. So you squared. So long square. Now this is for when you are bullish. If you are bearish, this is 0, this is 1 month, the price would have fallen like this. So if you are bearish, you expect the price to fall. This is 0 period, the price is up. 1 month period, price is down. So what do you do? How to make money? Sell at higher price and then buy at lower price. So here you do the first trade is sell. Now you would ask me, sir, how to sell if I don't have anything? You can borrow quantity from a friend or a custodian or from the market and sell. And once it goes down, you buy at a lower price and return the stock. The gain what you have made is yours. So selling first is called going short. And after it comes down, you buy. That is called cover. So long squared, short you can write covered, or you can just say square, cover. You can remove the past tense. Square. Now initial sell trade is short. Initial buy trade is long. Initial, the first trade. You see, this is the first trade you are doing, which is short. This is the first trade. Now this is also sell. Just see. This is also sell. This is also sell. But what is this? This is not the initial trade. It is a second trade after going long. That is called a square. If it is an initial sell trade, it is called a short. I went short. And when it came down, I covered my position. So the statement will be like this. So this again you can say we'll write this is an opening trade. Opening trade is a sell. Closing trade is a buy. Here opening a trade is a buy. Closing a trade is a sell. So depending upon the view, your opening trade will be a buy or sell. So you will write a statement like this. I was bullish on RL. I went long at 1925 and later I squared my position at 2050. So you can see I was bullish, means expect price to go up. Therefore your first trade will be buy. Therefore you went long. And later opposite of long is square. I squared. Never use oppositely. Long, square. Short, cover. Now the certain terms are used in the market. Close out. Close out means close the opening trade. Now here opening trade was what? Here opening trade was buy. So close out here means it is a sell. Here opening trade was sell. Close out means buy. So close out could mean buy or sell depending upon what was the opening trade. So we can say close out means opposite of the opening trade. Close or opposite of the opening trade. If the opening trade is buy, close out means sell. If the opening trade is sell, close out means buy. So sometimes they use close out, then they will use offset. E offset is position. So these terms will be used in the question paper. So this will be very useful, important to understand. In Forex, this long square, short cover will be frequently coming. So you should be aware what is bullish, bearish, long square, short cover, close out, offset. Sometimes they use a word, he reversed this position. Reversed. If the opening was buy, what is the reversal? Sell. Okay, so this is about jargons. So without the knowledge of jargons, very difficult to understand some of the questions. Now when we talk of hedging, we are going to talk about hedging equity using futures. Remember, I am talking about future. Using futures, sorry. Suppose I have created a portfolio. Pay attention. I have created a portfolio of 100 crores. Last year, the value of the portfolio was only 50 crores. Over 1 year, I put a lot of effort and I bought stocks in such a way that my portfolio value, which was 50 last year, has become 100 today. Now, today it is 100. What is my motive? I should maintain this 100. I should not allow it to fall below 100. If I am able to make further money, it is okay. But one thing which I cannot accept is this 100 value should not fall. Means I must protect this 100 crores. So hedging means protecting the current value. Protecting the current value of portfolio. Suppose you have portfolio 100 crores. You expect 10% fall. That is minus 10 crores. In hedging, what we do? We use futures. Remember, portfolio, assume that it is diversified. Therefore, I will use diversified futures of Nifty because Nifty has got 50 stocks. So, which is fully diversified. It is spread across so many stocks. Means one particular bad news in Tata Steel will not crash Nifty. Okay, there are so many other sectors that will go up. So Nifty is a well diversified market portfolio. Nifty has a beta of 1. So Nifty is well diversified. So diversified portfolio will be hedged using diversified futures. Now, if I have a portfolio, what is the view? View is price will fall. Therefore, what we should do? Therefore, sell. Remember, fall. Sell. If it is fall, sell. Rise, buy. So, therefore, you will sell Nifty futures. You can see example 100 crore portfolio, beta equal to 1.2. Market falls by 10%. So what will be loss of portfolio? Loss of portfolio will be equal to beta into beta portfolio into loss of market into value of portfolio. So whatever is the loss, see, we have learned this. Beta of the portfolio is defined as delta portfolio percentage upon delta market percentage. Therefore, what is delta portfolio percentage is equal to beta P into delta market percentage, and this is what we are using here. A very important formula. So what will be the loss? Loss will be 1.2 into 10%. You can put a minus if you want to have more clarity, into value of portfolio 100 crores minus 12 crores. So I am going to lose 12 crores in the portfolio. I am expecting market to fall by 10%. Now what is hedging? I want to avoid this loss of 12 crore. Means I want to gain 12 crores in Nifty futures. I want to gain 12 crores in Nifty futures. I am going to sell futures. So how to sell? Suppose if I sell 120 crores of Nifty futures, then when market falls, Nifty future will also fall. Is it not? Nifty has got a beta of 1. Nifty future has got a beta of 1. So when market falls, Nifty future will also fall. In that case, how much my loss will be? My loss will be beta into same delta M percentage into I am selling 120 crores. But remember, I am shorting, so there is a minus sign. So I am selling, is it not? So I am shorting means I am selling 120 crores. So what will happen is this will be equal to beta of Nifty is 1 into minus 10% into minus 120 crore equal to plus 12 crores. So you can see here minus 12 crore of portfolio is offset by 12 crore gain in Nifty futures. So have I lost anybody? No. Did the market fall? Yes. Did your portfolio fall? Yes. Did your Nifty future fall? Yes. But since you shorted, you made money. Shorted means you sold at a higher price and you covered at a lower price. So how I found this, that I should sell only 120 crores to make it exact? For that we have a formula. How to find value of futures to be sold. Now we use this formula, portfolio value into beta of portfolio plus N into underlying into F equal to, now this is a value of portfolio, this is value of future, sorry. So this is portfolio, this is futures. Now I want 0. What is 0? I want gain of portfolio, sorry, loss of portfolio, and gain in future should be 0. Means all the losses are erased. Yes, I am not making any. Suppose my view goes wrong, market has not gone down, market went up, then portfolio will go up. but I lose money in futures. Remember, you are shorting the put futures only for protection, not to make extra money. For extra money, you will not do this. The aim should be to protect, that is hedging. Aim is not to make any extra money. So don't look for extra money when the market is going up. When the market goes up, portfolio will gain, but your future will eat away all the gains. It will not show two colors when market rises and market falls. So in this case, I write 100 crores into beta portfolio 1.2 plus number of contracts. I'm just writing n into underlying into f equal to 0, or I will replace it with value of futures. This is a formula for value of futures. Therefore, value of futures will be equal to minus 120 crore. So minus tells that I must short, and this is the value to be shorted. And this is what we got, and this is what we wrote here. Sell 120 crores. So this 120 crores was found using this formula. So this formula is the main formula. So whenever you are given a problem in the exam, you will use this formula. You will write the portfolio value, you will write beta of the portfolio, you will write underlying units of future contracts, you will write future contract price, and you will be asked to find N. Find out N so that it is perfect hedging. Now this 0 means perfect hedging. Perfect hedging refers to complete offset of loss. So that we'll write perfect hedging refers to complete offset of loss in portfolio. Then what is imperfect hedging? Imperfect or partial hedging refers to partial protection of portfolio. So I want to hedge only 50%. I want to hedge only 40%, like that. So that I'm going to write the formula. Just let me complete one more thing. Now this particular formula can be written like this. If the target beta, which I can call it as beta star, is given, then the formula is portfolio value into beta P plus N into underlying into F is equal to portfolio value into beta star. Now means what will happen is they will give like this. The fund manager is holding a portfolio with beta equal to 1.2. He want to convert the beta to 0.8. So then we should write here 0.8. So for our example, if we want target beta to be 0.8, then 100 crore into 1.2 plus n into underlying into f is equal to 100 crore into 0.8. Therefore, n into underlying into f, which is value of futures, will be minus 40 crores. Therefore, now minus means short. Therefore, short 40 crores. So when you short 40 crores of Nifty futures, the beta of the portfolio, which is 1.2, now will behave like 0.8 beta portfolio. So this, whenever they give target beta, you will write this. Suppose they give percentage hedging. Now if we are given percentage hedging desired, then the same formula, portfolio value into beta p plus n into underlying into f is equal to portfolio value into beta p into 1 minus percentage hedge required. So whenever they give fund manager wants 40% hedging, so then you should try to see the same thing. This is same, remember. Now this portfolio value, beta p, same. But only thing is into 1 minus. So here it is not, here it is, here you can see it was beta p, but here it is beta p star. Here it was beta p star. So beta p is current beta. Beta p star is target beta. Suppose they give target beta directly, then use this formula. If they give percentage hedging required, use this formula. Okay. Then there is a concept of using the same formula. We can write value of portfolio. Okay, we can write imperfect hedging. Value of portfolio into beta p plus value of futures is equal to 0. The perfect hedging means 0, is it not? This should be 0. Therefore, beta p is equal to minus value of futures upon value of portfolio. Now what is futures? It is a hedge. So minus hedge value upon portfolio value is nothing but hedge ratio. The numerator is hedge, denominator is underlying. So this is called hedge ratio. Now, but hedge ratio is equal to beta p. Therefore, beta p is called hedge ratio only for perfect hedging. You can see, we have put 0, no? Only when we put 0, we are getting this, is it not? So this beta p is equal to hedge ratio is only in perfect hedging. Now beta, sometimes they will give calculate example, calculate hedge ratio. in perfect hedging. And they will give sigma of C is equal to 10%, sigma of M equal to 8%, rho of CM equal to plus 0.5. Therefore, beta of portfolio is equal to rho beta of whatever commodity or anything will be equal to rho CM into sigma C upon sigma M. 0.5 into 10 upon 8 equal to 5 upon 8. 0.5, correct? So we got beta equal to 0.625. So like that they can ask a very simple problem. Okay. Now another thing. Remember, hedge is created to protect against uncertainty and market fall. Now you believe market is going to fall, so you do hedging. Now once your view is not there, now you don't think market will fall, what do? You remove the hedge. How you see, I'll write down, just watch the sentence. We expect market to fall. Therefore, we hedge by selling futures. Is it not? We sell futures. Now we hedge by selling futures. After a month, we do not expect market to fall. So now means removal of uncertainty. Removal of uncertainty. So you think now the uncertainty is over, now market will not fall. Therefore, we have to remove the hedge. Meaning, close out or reverse hedge trade. That is, buy futures. Or we will say we should cover futures because we already sold. That is, cover, or we can say buy back sold futures. So suppose you sold 25 lots, or say 25 lots of Nifty futures. Now you should buy 25 lots of Nifty future. So initially you shorted, now you covered, now you don't have any hedge. So once the uncertainty is removed, hedge should be closed out. Therefore, once uncertainty is removed, reverse hedge trade. This may result in gain or loss in futures market. Is it not? Suppose you shorted future at 13,000 Nifty, and after a month when Nifty came to 12,000, you feel now it will not fall further. So you cover back your position at 12,000. So now you have made a gain. So you shorted at 13,000 and you now cover back at 12,000. So shorted means, if at all, so I am selling like this, I'll put an arrow. So I shorted at 13,000. Shorted means inflow, so plus. Sell means inflow, therefore we write plus. And you reverse the trade, means you buy. Buy means outflow. Okay. So minus 12,000. So you will get 1,000 gain. Sometimes it can be loss also. So when you see uncertainty is removed, it has gone up. So you have to do at 14,000. So once uncertainty is removed, reverse hedge trade. This may result in gain or loss in futures market. So this can be asked. If the trader is actually covering back, what is the loss or gain? They have asked a couple of times. Okay, so this concept is very important. Now, as when you are preparing for this chapter, as I told you, they ask one question in 3 or 4 attempts. It will contain typical hedging problem, will contain a typical problem, typical hedge problem. First, it can contain calculate beta portfolio. So they will give 5 stocks. They will give value. Sorry, quantity, price. So you calculate value, you calculate proportion, multiply by beta, you get beta portfolio. So out of 8 marks, 2 marks will be for beta portfolio. Then they will ask calculate contracts to be sold. Usually they will expect market to be volatile, so he want to hedge. So you are having portfolio. So how you hedge? What is the view? View is fall. Therefore sell futures. So you have to show contract to be sold. Now when you calculate contracts to be sold, number of contracts, very important. Number of contracts will be rounded off to integers. Decimals not allowed. Now example 14.2, suppose you are getting number of contracts. So how will you get? Let us take an example. Let us take an example. Example, portfolio 50 crores. Beta 1.2. Number of contracts, question 1. Futures 13,000 to 50. Underlying 100 units. Calculate N for perfect hedging. Suppose they give like this. So our formula 50 crores into 1.2 plus N into 100 into 13,000 to 50 equal to 0. Remember perfect hedging, therefore 0. Therefore N will be equal to minus 50 crores into 1.2 divided by 100 into 13 to 50. So let us do this. 50 crores into 1.2 divided by 100 divided by 13250. So you're getting 45.28. So we will write the value 45.28, but this is not the answer. So we'll write a or 45 contracts. Remember, it is minus. Therefore, short 45 Nifty future. Assume that it is Nifty future. 50 Nifty future contract. So you must round off. If N was 45.79, then N equal to 46. Very important. So round off, normal round off rules, but only integers. Integers, I have written here integers. Okay, so this is all about hedging. I have one problem. Generally that kind of problem when it comes in the exam. You must know one more thing: pricing. How all the price. So generally, what they will ask beta of the portfolio. They may ask contract to visible, and you may get one question here: calculate price of futures. So in the derivative chapter, we have seen how to calculate the price of futures. So this could be a sub question 2A and then 2B. Typical problem will be like that only. 99.99% of problem will be this only. Okay, hope you understood this. Let us see the formula in the chapter of hedging. This is restricted to hedging of equity and index portfolios. We are going to use futures. Now, what is hedging? Now, when I say hedge, the meaning that should come to your mind is protect. Protect what? Suppose I have created a portfolio and it has got some value. If the market changes, the value of the portfolio can go down or the value of portfolio can go up. Yes, when it goes up, it doesn't bother me, but when it goes down, it bothers me. I can make a loss. Suppose I am in a situation where I don't want gain, neither I want losses. Please understand, I don't want gain, neither I want losses. Means I want to protect or maintain the value of the portfolio which I have created. In that case only, we go for hedging. Suppose you want to have upside, you don't want downside. That is not possible. So if you want to protect your downside, even upside will be removed. There will be no upside. So hedging aims at protecting or maintaining the value of the portfolio that is created. Hedging uses another asset, usually derivatives. Now, here I written down the basic strategies. If you have stock portfolio, I am invested in a single stock, then short stock futures. If you have well diversified means this portfolio does not carry any unsystematic risk. What is unsystematic risk? Unsystematic risk is that part of risk which is caused by company specific events. It will affect only one company in question. It will not affect all the remaining stocks of the portfolio. Only one stock will be affected. That is your unsystematic risk. What is the other risk? That is systematic risk. It will affect all the stocks in a portfolio. While company-specific events cause unsystematic risk, the events happening in the market, economy, etc., they cause systematic risk. They affect all the stocks in a portfolio. Suppose you have created a well-diversified portfolio, then you have eliminated unsystematic risk. Means your portfolio is having only systematic risk. Suppose you want to hedge that kind of portfolio, then you must short index futures. Now, this is the strategy of hedging. Now, you have learned that hedging means protecting or maintaining the value of portfolio. And this is a strategy you would adopt. Now, how to calculate the number of contracts? For that, you must understand the difference between portfolio value and portfolio position. Portfolio value means number of shares into market price, and you take the summation of all the stocks in the portfolio. So this will give you portfolio value. What is portfolio position? So you have to multiply with the respective beta. So when you multiply with the respective beta, we get portfolio position. So you can see that we are having portfolio into beta. So how to find the number of contracts? First calculate portfolio position. Then find out which feature you are going to use. If it is a well-diversified portfolio, you will always use index futures. If it is a single stock portfolio, you will use same stock futures. Suppose I have RIL stock as my portfolio, only one stock. Then I will use RIL futures. Suppose I have a well-diversified portfolio, then I will use index futures. So find out the value of the futures, find out how many contracts you have. How many units you have in a single contract. So this you will be getting. So this is calculated. Now find out what you want with the portfolio. Do you want complete protection? Means you want to maintain the value perfectly, completely. Then it is called perfect hedge. In the case of perfect hedge, you can see here we have written portfolio value on the right hand side and there is beta star. In the case of perfect hedge, beta star will be 0. Means entire thing can be substituted for 0. So whenever they give complete hedge or perfect hedge, the right hand side should be 0. Please understand, currently I am having this. Current position is this. This is the targeted position. Currently, the portfolio may have say 1.5 beta. Target, I want to make beta as 0. Means you are talking of perfect hedge. So we are having certain beta. We want to modify it to 0 beta. When it is 0 beta, it is called as perfect hedge. Sometimes fund manager will say, no, I don't want 0 beta. I want 1.1 beta. Then right hand side will be portfolio value into 1.1. So whatever you have will be on the left hand side. Whatever you want will be on the right hand side. In the middle you will have N into underlying into futures price. So substituting everything, we will be calculating N. So this will be calculated, number of contracts will be calculated. So this is how we find out the number of contracts. So once you calculate the number of contracts and you go to market and do that transaction. So first we calculate portfolio value, and you can do this straight away, so that we want portfolio position. So you are automatically doing this. And exam they will give 50 crore portfolio, beta 1.2, beta of the portfolio into value of the portfolio. So these two are taken care of. They will give futures price, they will give you underlying units, and they will specifically say whether you want perfect hedging or not. If nothing is mentioned, by default it is perfect hedging. Still, if you have doubt, you can write. There is no mention about the percentage of hedging required. Therefore, I am assuming perfect hedge. Therefore, beta star equal to 0. So the entire thing can be written as 0. Suppose hedging is not perfect, then we call it as imperfect hedging or partial hedging. In that case, they will usually give percentage hedging required. Then the formula on the left hand side doesn't change, but on the right hand side, instead of beta star, we write this. We keep the same beta here. You can see beta is same. Only thing is we multiply by this 1 minus percentage hedging required. We have derived this in the class. We have seen how we have got this. So it's not very difficult. Even without seeing those derivations, you can remember this. Whenever they give percentage hedging required, use this formula. So this is important. So also this. And note, first find the value of portfolio position. Understand that it is different from portfolio value. Then in the exam they will ask you what is hedge ratio. Now hedge ratio is nothing but beta. Now just see, let me write down perfect hedging equation in a different way. Let me write down perfect hedging difference in this equation in a different way. So I am going to write this. So this, in this case I am writing 0. So this it is perfect hedging. So I will rewrite the equation. This will be beta is equal to n into underlying into f. Remember there is a minus sign, divided by portfolio value. Now you can see that numerator is value of portfolio. Numerator is value of derivatives or futures. Numerator is value of futures. Denominator is value of portfolio. Now it is in the form of ratio. See, this is, I can call it as A and I can call it as B. So it is A upon B format. Therefore it is called ratio. And what is this ratio? This ratio tells me for the portfolio what you are holding, how much hedge you have created. Because when I am using derivative, I am actually hedging. I am protecting. Therefore, futures you have created only to hedge. So numerator is futures position created, denominator is portfolio value, therefore it is called hedge ratio. And what is it equal to? This is hedge ratio, but it is equal to what? It is equal to beta. Therefore beta is called hedge ratio. So whenever they ask hedge ratio in exam, calculate beta. What is the formula for beta? We have learnt rho correlation coefficient into sigma s upon sigma f. Now here, instead of market, they will give futures. If it is a diversified portfolio, then they will give, we will get beta of the portfolio is equal to correlation of diversified portfolio into market, sigma portfolio upon sigma market. If it is of a stock, then it will be rho sm sigma s sigma m. Now remember that futures are proxies for the underlying, means futures don't have their own value. They go up or down tracking the value of the stock. Means suppose Reliance stock price goes up, Reliance futures also go up. So they track. If Reliance stock price comes down, Reliance future also will come down. So there is no harm in using F instead of M. So sometimes they will give you spot value and futures value. That's how you can see here spot futures. So this is a general formula. So whenever they ask hedge ratio, you have to calculate beta. Now this they have never asked. If you have money and you are expecting market to rise, go long on futures. This never been asked. But when they ask in the exam, if at all they ask, suppose there is a mutual fund, it has collected money, say 50 crores, and now it is waiting for all the money to be collected from registers. In the meantime, it is getting the news that the market is going to zoom. Now it is waiting. The research department is not ready with the stocks to be bought. It has to build up the portfolio. If it waits, then the market will zoom and the fund manager will underperform the market. What to do? No need to worry. Immediately go long on futures. What you can do is you can buy futures and keep it. And when the stocks are identified by the research department, reverse the futures position and use the money to buy stock. So when you are having money and you want to exploit the situation that market is going to go up, what you should do? You should go long on futures. Now this is what is generalized in these two very important strategy. If the view is price rise, you can apply this blindly. In the exam, read the question. If the view is given, the fund manager is thinking price will rise, no problem, buy futures. Fund manager is thinking price will fall, sell futures. So this rule you can apply it blindly. So if I am expecting price will fall, sell futures. If I am expecting price will rise, buy futures. General rule. So in this chapter you have two general things. One is this. And another is this master formula. Now using these two, now this is a modification of this formula. So if I want to summarize the entire chapter, now these are the four things you have to remember. So this is the summary of the entire chapter. Now we can apply this same concept for commodity futures or commodity derivatives. Suppose you want to hedge. Rising price scenario buy commodity futures. Suppose you want to hedge falling price scenario, sell commodity futures. So same thing, what this only we are written here. So when the view is price will rise, buy futures. When the view is price will fall, sell futures. I hope you understood this. Let us go to the formula of the next chapter. Let us read this problem. We are provided with security, price, number of shares and beta. So these 5 stocks are given A, B, C, D, E. A fund manager is maintaining the above portfolio. Index futures are trading in the lots of 200 at 8774 in the market. But the theoretical value is 9485 as calculated by the fund manager. How many contracts the fund manager should go long or short for perfect hedging? Now there is a problem on hedging using index futures. This problem involves calculation of portfolio beta first. And remember, you are going to hedge in the market. So you require market price of futures. Now they have given market price of futures. They have also given theoretical price of futures. You should not do a mistake of using theoretical price of futures. Let us see how we solve this problem. First is portfolio beta formula. Summation of Wi beta I means proportion of each of the stocks in the total portfolio in value terms multiplied by the respective beta. So we have to calculate beta the portfolio and value of portfolio. So this would incorporate knowledge from the chapter of portfolio management, which we will do first. So let us write down. So we have security, price, then number of shares, beta. Now we need value of shares. We need to take the total. This will help us to calculate proportion. And finally, proportion. So this will be our proportion and this will be our beta I, proportion into beta I. So these two total. So this will be portfolio total, portfolio value. This total will be portfolio beta. So we need these two. And using these two values, we will proceed ahead. So when you get this problem in the exam, though it is a simple problem, a little bit of pause, thinking should be there. What columns I have to draw, how we have to calculate. Some pause, there should be a pause to think. This will help you avoid any silly errors. So we now write the information given. Now value of shares, price into number of shares. So when we multiply this, we get like this. When we take the total, you actually store in memory and use a memory recall. That is the fastest way to do. Now we have to calculate the proportion of each with respect total. So 15,07,500 divided by 16,514,750. So that will give us the value. So what I am telling is this divided by this, so will give us the values when we take proportions. You would wonder up to what decimal I must take. Whenever you write in percentage, 2 decimal. Whenever you write these proportions in W like this, you should write 4 decimal. Why? Because when you multiply by 100, convert into percentage, you will get 2 decimal. So we write in 4 decimals. Now when you do round off, the total should be 1. So you are usually, you can change the last one. You see, you can say 3 plus 2, 5 plus 9, 14, 22 plus 9. So we are getting, so this you make it as 8. So automatically this will be 1.0000. Okay. So you have to just, I generally, round off that last one. Okay. So ultimately it doesn't change the answer because we are running into the 4th decimal. So the total has to be 1. Now Wi into beta I. So first one, now the proportion Wi beta I will give us beta of the portfolio. So you can see this formula. So this actually you will get it here. So beta of the portfolio we generally try to do in 2 decimals. So depending upon this, let us see what we are getting here. So 0.0913 divided by 0.0913 divided by, multiplied by 1.15, 0.0, 105, 0.1050. Similarly, the next one, when you do 0.4 into 0.1702, you get 0.0681. Then we do 0.9 into 0.2989, 0.26 0.90, then we get 0.3256, then we get 0.0824. When you take the total, 6 plus 4, 10 plus 1, 0, 2, 8. So we take only the two decimals, so we get beta of the portfolio as 0.85. Now these two calculations involved knowledge from portfolio management chapter. Now our question is, how many contracts you should go long or short? In derivatives we have a very simple formula, a master formula to calculate number of contracts. Now we need perfect hedging. What is the meaning of perfect hedging? The meaning of perfect hedging is, when the market changes, that is it goes up or down, the change in the value of portfolio, that is this portfolio, should be exactly offset by the change in the derivative which you are going to use. Here we are going to use index futures. So the index future change should offset all the changes in the portfolio. We use a very simple formula. If n is a number of contracts, if n is the number of contracts, then we can find n by solving portfolio value into beta of the portfolio plus n into number of underlying units in each contract into futures price. Now here you have to be careful. We are not supposed to take theoretical value. We are supposed to take market value. Now market value is given as 8774. Fund manager is calculating 9485. We should not take that, because you are going to ultimately do the trade in the market at market price. So we need market price. We can't use the theoretical price. So you have to be very careful in substituting here. Now this should be equal to portfolio value into beta star. I'll explain this. Now this formula, you can see left hand side, my beta is 0.85. Value is 16514750. So 1 crore 65 lakhs, 14,750 is the value of the portfolio. The beta is 0.85. I want perfect hedging. Perfect hedging means all the changes in the portfolio should be offset using index futures. So therefore the target beta should be 0. So I will write here is equal to 0, since target beta, that is beta star, is 0 due to perfect hedging. Now if the hedging is not perfect, means I don't want my beta to be 0. I don't want my target beta to be 0. Suppose I want target beta to be 0.5. Then I am asking for imperfect hedging or partial hedging. Partial hedging means I don't want to remove all my losses in the portfolio. So if I want to offset or remove all my losses in the portfolio, all, then it is a case of perfect hedging, then beta star is 0. If not, then as they give in the problem, we have to use it. So in this case, perfect hedging is given, therefore beta star is 0. So when we substitute this, we get 16 into 0.85 plus n into 200 into 8714 equal to 0. Therefore n equal to, so when you actually calculate this, we will get 16514 750 into 0.85. We got is divided by 8774 divided by 200 will give you 7.995. So we are getting n equal to minus 8 approx. Now minus sign tells that I have to short. Had we got plus sign, we would have gone long. So the answer is, therefore, answer short 8 contracts of index futures for perfect hedging. So summarizing, this problem comprised of 2 parts. One involved use of knowledge from portfolio management chapter, and the other involved use of knowledge from derivatives chapter. From the portfolio side, we had to calculate value of portfolio. Remember, we had to use market prices. Then we had to calculate the beta of the portfolio, for which we need to know the proportions of each stock in the total portfolio. So once we get beta of the portfolio and value of portfolio, we move to the second part. We use this formula which we wrote here, that is portfolio beta, value into beta of the portfolio plus n into underlying into f is equal to portfolio value into beta star. By substituting the required values, we got n equal to minus 8. You know, minus tells that I must short. So therefore answer is short 8 contracts of index futures for perfect hedging. I hope you understood this. Let us now see the chapter of commodity futures, or in fact I can say commodity derivatives. Earlier commodity derivatives were not there in the old syllabus of SFM, then now it has been added in the new syllabus, and a few attempts have gone and questions have come. Very important part of derivatives, so you can include it under derivative section, and usually a question combined with pricing of futures or simple hedging strategy is asked. So let us see. Commodity, we can write hedging. Mostly questions on hedging comes. Now when we examine real options in capital budgeting, there we will see, you know, pricing which is included along with the execution of project. There also we are going to use derivatives pricing model, and here it will be more of hedging questions. So therefore I wrote the heading commodity hedging. Now commodity refers to all those physical assets which are actually bought or sold in anticipation of price rise or price fall. Suppose a gold trader believes that the price is going to rise, so we can write view is price rise. If the view is price rise, then what is the hedging strategy he would do? Now hedging strategy would be to benefit from the rise. So therefore you go long commodity futures. Now assume that there is a demand for gold in 3 months time when Diwali is going to approach. And a trader is worried that the price is rising. Why is worried? Because he is going to buy gold and he has to sell it to his customers. So if the price of gold increases, his input cost increases. So what he will do, he will go long on gold futures today, and at the end of 3 months, if the price really rise, he will make money there. So which will offset his purchase cost of gold on the Diwali eve. So when the view is price rise, go long. When the view is price fall, go short. Short on commodity futures. So this is the most important thing you must remember whenever you are asked problems on commodity hedging. Now the second part, this is the first one. The second thing you must remember is how much you have to hedge. Now for perfect hedging means what? Perfect hedging means all the anticipated losses in the underlying will be offset by the gains from the futures. So the intention is all the anticipated losses in the value of the underlying will be offset by purchase or sale of futures. That is perfect hedging. Now when perfect hedging can happen? When hedge ratio, what is hedge ratio? Value of hedge divided by value of underlying. Divided by value of underlying means what? Suppose I am going to have 100 kg of gold as an underlying. So I want to hedge 120 kg of gold futures. So value of derivative is 120 kg worth gold futures. Okay, whatever is the price. And what is the value of gold? 100 kg of pure physical gold. So this is called hedge ratio. So in perfect hedging, so if for perfect hedging, if the hedge ratio has to be equal to, for perfect hedging, hedge ratio should be equal to beta of the commodity. C stands for commodity. So in the exam you can get a question where how much the trader would go long or short for perfect hedging. Then you must write he would go long to the extent of beta times. Now so this hedge ratio should be equal to beta. So let us substitute just here. I will answer that question. Therefore beta of C should be equal to value of H upon value of underlying. So this I am writing as underlying. Therefore value of H should be equal to beta times value of underlying. So this is the required condition for perfect hedge. This is the required condition for perfect hedge. So one question was asked in CA final exam, old syllabus, but you are likely to get it 100% anytime soon. So how much quantity he must hedge? He must hedge beta times the value of underlying. Suppose I am having 100 kg of gold as the underlying, then I must hedge for perfect hedging. Okay, for perfect hedging only this rule holds good. So then so whatever is the value of 100 kg of gold multiplied by beta of the commodity. So they will not give beta of the commodity directly in the exam. So that is our third thing which you should remember in this chapter. So they will give beta indirectly. Now beta will be given like this. So beta of C is equal to rho CF sigma C upon sigma F. So this is a popular formula which we have learned in portfolio management chapter. Now instead of M, we have futures. So F is the futures data replacing market. So they will give you standard deviation of copper or commodity, whatever, gold, let us say gold. So they will give standard deviation of gold returns. So you got sigma C. They will give you standard deviation of gold futures. So that will be sigma F. They will give you correlation of returns between gold and gold futures. So that will be rho CF. So all the three will give you beta C. So this beta C will be substituted here. Value of underlying will be known. Then you can get value of H for perfect hedging. Okay. Two good problems are included in this course after this. And when you go through that, you will understand. Now, for this and all, this is obviously so very, very important. So, hope you have written this. And the two problems plus these two, what I have marked, suffice for any exam. Hope you have got this. Let us read this problem. A silver merchant requires 3000 kg silver in 3 months ahead of wedding season. He expects price of silver to increase. In spot, it sells for rupees 5100 per kg. Each contract of silver futures covers 50 kg. Silver futures are trading at rupees 5200 per kg. The merchant wants to hedge half his requirement and wants to leave the remaining uncovered. If at the end of 3 months the spot is rupees 5250 per kg and the futures is rupees 5400 per kg respectively, what will be the effective price per kg of silver purchase for the merchant? Very popular problem in the exam, CFL exam. They ask similar problem involving rice, and this kind of problems have come in other exams also. Very important problem on commodity futures hedging. Let us see how we do it. If the view is commodity price will increase, then you buy futures. If the view is commodity futures will decrease, you sell futures. Please understand, a consumer of a commodity, who is also called the prospective buyer of the commodity, will face risk if the prices increase because he is going to buy. So he will hedge by buying futures. Similarly, a producer of a commodity who is holding the commodity for sale will face risk when he expects price to decrease. He will hedge by selling futures. In this problem, we have a silver merchant who wants to buy 3000 kg of silver. When? 3 months from now. Currently, silver futures are quoting at rupees 5200 per kg. So we'll have to first write silver merchant is expecting silver prices to rise. Therefore, he will hedge by buying silver future contracts. This is a very important statement which you have to write. So he is going to buy silver future contracts, quoting at rupees 5200 per kg. Now, how many contracts he will buy? It is given that he want to hedge only 50%. He want to hedge half the requirement. So what is the requirement? The requirement is 3000 kg. Half the requirement will be 1500 kg. So each contract 50 kg. Therefore, number of contracts is equal to size of exposure to be covered divided by size of contract is equal to 1500 kg upon 50 kg equal to 30 contracts. So silver merchant will buy, therefore the merchant will buy 30 contracts at 5200 per kg. So he would do this, then 3 months will pass. At the end of 3 months, now he need 3000 kg. So at the end of 3 months, actual purchase cost of 3000 kgs, what is the rate given? 5250. At the end of 3 months, spot is 5250. So this will be equal to 3000 into 5250. 1 crore 57 lakhs 50,000. 1 crore 57 lakh 50,000. So this he will actually purchase because he needs it. He has purchased derivatives also, 30 contracts, and he bought at 5,200. Now, what is the price of futures? 5,400. Now next is gain from futures. is equal to number of contracts into underlying into delta F. 30 into each contract is 50 kg into rupees upon kg. Settlement price is 5,400 minus 5,200. So this will get rupees 30 into 50 into 200, rupees 3 lakhs. So minus rupees 3 lakhs. So net will be 1545 . Now this is the effective price actually, or this is a total price. Effective price per kg will be divided by 3000 kg. So effective price per kg 154, 50,000 divided by 3000 kg. You can see numerator is rupees, denominator is kg. So we will get the answer rupees per kg. So 5150. So effective price per kg is 5,150. Fairly simple problem. The trap here is you are hedging only 50%. So you have to be very careful in doing this part. The requirement is 3000, but he want to hedge only half the requirement. So therefore we are getting 30 contracts. Otherwise you would have got 60 contracts. Hope you understood this. Let us read this problem. An oil company needs 1000 barrels of crude oil after 6 months. The current price per barrel of crude oil is rupees 3,300. It is expected that after 6 months, the price per barrel of crude oil is likely to touch rupees 3,700. The company wants to hedge against the rising price for its requirement after 6 months. The 6-month future contract price is now traded at rupees 3,500 per barrel. The size of future contract is 100 barrels. The cost of capital, insurance and storage put together is 15% per annum. How are the futures valued now? Assuming that a company decided to hedge through futures, find out the effective price it would pay for crude oil if at the time of lifting the hedge, the spot and future prices are rupees 3,420 and rupees 3,600 respectively. Now, very important problem yet to be asked in CA final exam. Very popular problem in other examinations. It requires knowledge of comparing the benefit or advantage or disadvantage of hedging. Let us see how we do this problem. Now, oil company needs 1000 barrels. So today time 0. At the end of 6 months, need 1000 barrels. Now, what is the price? Spot price. Spot is 3,300. So this is 3,300 And today the futures are quoting at 3500 and expectation is it will touch 3700. Now the company wants to buy 1000 barrels at the end of 6 months. Today it is saying forward. What is the likely price? 3700. But futures are available at 3500. First, we are asked to find out whether the futures price, which is quoting today, that is 6-month futures price, which is quoting today at 3500, is it more than the theoretical value or less than the theoretical value? Means whether it is overvalued or undervalued. So how to find theoretical value? So theoretical value of futures will be F equal to S plus S into R upon 100 into T upon 12. Now please understand here. Storage is not given separately. Had it been given separately, I would have done another one. S into small s upon 100 into T upon 12. But they have clubbed everything here. So they are given all costs of carry, cost of capital, insurance, storage, everything is 15%. So only this much formula. So this will be equal to 3300 plus 3300 into, now let us see what is given, R, 15% T, 6 months. So 15 upon 100, 6 upon 12. Three five four 7.5. Now this is the theoretical value, but market value of 6-month future is equal to 3500.00. Therefore, futures are undervalued. So the first part of the question is fairly simple. Had they given exponential value, we would have taken F equal to S e raised to RT if CCRA is given. But they are not given that, therefore we have used simple interest. The futures are undervalued. Now they are asking how the company will hedge. Now what is the view? Oil company's view is that oil price will rise. Therefore, it will hedge by buying futures. Remember, when the view is price will rise, buy future. When the view is price will fall, sell futures. Very clear. So therefore, highlighted this part. Oil price will rise. So this is a view. The view is oil price will rise. Therefore, buy futures. Now, this is a derivative. So how many contracts? Therefore, number of contracts. In fact, this is a future. Even for options, we have to calculate number of contracts. So number of contracts is equal to size of exposure divided by size of contract now. What is the size of exposure? How much it wants to buy? 1000 barrels. What is the size of each contract? 100 barrels equal to 10 contract. So oil company will buy 10 contracts at the rate of 3,500 per barrel. So this is the hedging strategy oil company will adopt. Now they are asking what is the effective price. Now at the end of 6 months what happens? At the end of 6 months you buy 1000 barrels at the prevailing market price. Part 1. Part 2. The 10 contracts which you are buying today will result in gain or loss. So that has to be settled. So 2 parts. So at the end of 6 months, A, actual purchase cost of 1000 barrels at prevailing price. And what is the price they are given to us? Prevailing price of rupees 3420 per barrel. So this will be equal to 1000 into 3420. So this will be the actual purchase price. Now we have bought 10 contracts at what rate? 3500. What is the price of futures at the end of 6 months? 3600. So we bought it 3500. Now gains from futures. Now we can give this heading only after seeing at what price we bought, what price we sold. Otherwise, we would have written losses from futures. So gains from futures. Futures bought at 3500 per barrel. Futures price on settlement date. $3,600 per barrel. Therefore, gains equal to number of contract into underlying into delta, that is change in futures. Number of contract 10 into 100 barrel into rupees upon barrel, 3600 minus 3500. And see the barrel is cancelling, we get the answer in rupees. So 100 so 1 lakh rupees. So gain we are writing gain in bracket because it is cost. Now this problem is involving cost. I am buying a oil company is buying crude. So that cost will get reduced because of gain. So therefore I have put gain in bracket. So this will be rupees 33,20,000. Therefore effective price per barrel $33,20,000 divided by 1000 barrel, 3320 per barrel. So this 3320 per barrel. So the answers are the futures are undervalued and the effective price per barrel is 3320. fairly easy problem, but still you have to present it well. Hope you understood this.